to earth. Since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries.
Good morning and welcome. This is NDTV Profit. My name is Mihika Barve and you're watching All You Need to Know. Over the next half an hour or so, we'll tell you everything you need to know to start the day on the right note. Let's start with the headlines first. India economy beats its own record. GDP grows at 8.4% in the third quarter. SEBI asked mutual funds to stress test every small and mid-cap scheme to safeguard investor interests. That's an NDTV exclusive. Yes Bank likely to acquire Paytm's merchant accounts. That's an NDTV Profit exclusive as well. Adani Group reports record EBITDA growth of 63% in Q3. The 12-month EBITDA stands at rupees 78,823 crore rupees. Bill Gates says India has opened the digital window to the world, praises scale and success in an exclusive interview. Now let's start with a quick global check. US stock futures were under pressure after both the S&P 500 and the Nasdaq indices closed at record levels. The two benchmarks ended February with the fourth consecutive monthly advance, and this was buoyed by the latest US personal consumption expenditure index data that met consensus expectations. Now, the annual increase in inflation was the smallest in 3 years, keeping a mid-year interest rate cut for the Federal Reserve on the table. Brent crude was on track for a marginal weekly gain but opened 1.9% lower at $82.07 per barrel as market gauges continue to show signs of strength, with OPEC Plus set to decide whether to extend supply cuts or not. Also, do remember that Russia has ordered a 6-month gasoline export ban from today to keep prices stable amid rising demand. Additionally, tightening enforcement of US sanctions is denting India's oil trade with Russia. And lastly, as for the early risers, Asian equities headed for a cautious start. Australian and South Korean indices traded lower while Japan showed some strength. Moving on to India, India's economy grew better than expected in the third quarter as GDP grew 8.4% in the October to December quarter, boosted by a jump in mining, manufacturing and construction activities. My colleague Pallavi joins us with the fine print.
Hi, that's right, Mehika. India's GDP growth came in as a big surprise and with a lot of revisions as well to the past data. GDP grew by 8.4% in the October-December quarter, and to just put that in some perspective, economists polled by Bloomberg were expecting GDP growth for the same quarter at about 6.6%. Now, GVA, that excludes indirect taxes and subsidies, grew by 6.5%, which is not too far from what was expected. The divergence between both is because of a surge in the growth of net indirect taxes to a 6-quarter high of 32%. Now, this figure, this pace of growth in net indirect taxes is of course unlikely to be sustainable going forward, which means that we will see, or are at least expected to see, a reduction in GDP and GVA growth rates post this figures release. Still, with the upside surprise in Q3 as well as upward revisions in both Q1 and Q2 as well, GDP growth for the full fiscal year is now pegged at 7.6%. This compares to a first advance estimate of 7.3%. Now, that's not the only figure that's been revised as mentioned. Numbers for previous quarters and previous fiscals too have seen a revision. Let's take the first 2 quarters for instance. GDP growth in Q1 is now estimated at 8.2%. That's compared to a previous estimate of 7.8%. Likewise, GDP grew by 8.1% in Q2. That's compared to a previously forecasted figure of 7.6%. Now let's turn to look at some industry-wise trends as well. Agriculture declined by 0.8% in Q3. That's important to note because that does leave us with questions regarding the recovery in rural incomes and whether that's taking place at all. Manufacturing growth was strong at 11.6%. Construction continues to remain strong. Trade, hotels, transport also fairly resilient, growing by 6.7%, while financial sector growth came in at 7%. Looking at some expenditure-wise trends, again important, private consumption remained lackluster, growing by 3.5% in Q3. Government final consumption expenditure fell by 3.2%. This means that investments once again continue to do the heavy lifting, growing by 10.6%. But we'll continue our coverage on the GDP figures over the course of the day, so do stay tuned in.
Thank you so much, Pallavi, for those details. But now we have Agam standing by to break down the FNOQs for today. Agam, what is the futures and options data telling you about the markets today?
Right, well, we are coming out of a very volatile expiry, and what we're going to keep an eye on is the March futures as we move into a new one. And it's going to be an interesting one because this is also going to be running up to the general elections. Well, a lot of trends, but not bereft of volatility. That said, when it comes to the March futures, we saw the Nifty advance by around 0.1% and the 33% increase in open interest. Of course, a lot of this is most likely just an addition, not necessarily towards longs or shorts at the moment because it's still early days in this, the expiry. The Bank Nifty, the picture won't be very different. We had a 0.3% up move there eventually towards the end of the session, and around 34% added in open interest there as well. As far as your Nifty options data is concerned, at the moment we're looking at the most amount of writing around the 22,200 mark. That's where we are continuing to see stiff resistance on the higher end, and of course on the lower end a lot of traction around 21,500, 21,700, 21,800. 21,800 has a lot of accumulation in puts, but it is the 22,000 puts is the one with the max OI. And as far as calls are concerned, 22,200. This is just a 200-point range. It's less than 1%. Of course, it's going to continue to change, through the course of the next 1 week as we move in. And finally, coming down to stocks, and I'm sure there'll be a lot of traction there. So we're looking at longs in Canara Bank and Chambal Fertilizers, and shorts in Z Entertainment, ABFRL and MRF. And in terms of stocks, which saw unwinding, and there won't be too much unwinding. We've just seen 3 stocks because it is a new series. We are keeping an eye on something like an ICICI Lombard, which saw longs unwinding, but short covering for Gujarat Gas and Indus Tower. But all said and done, Mihika, the WIX is well over the mark of 16, which also means that we can in fact expect volatility in this particular month as well.
Thank you so much, Agam. Well, there you have it. The FNOQs today, some volatility expected this month. But now moving on is the top story of the day. Now, sources tell NDTV Profit that SEBI has now asked all asset management companies with small and mid-cap schemes to undertake a stress test of their portfolios at the earliest. Now, Sajid joins us with the details. Sajid, what else are you picking up from the sources?
That's right. The market regulator is very clearly monitoring the small and mid-cap space, especially in the mutual fund industry. To give you a perspective, how big is this? There are nearly 27 schemes in the small cap, nearly 29 schemes in mid-cap. So we are looking at monitoring happening on 56 of these schemes in the entire industry, and total of that would be 5.24 lakh crores in portfolio. So there's a huge portfolio that needs to be monitored, and the market regulator regulator now wants the mutual funds and AMFI to lead the way in doing a stress test of every scheme that they hold, so that to ensure that there's no potential risk which is there in the portfolio. It also wants to ensure that the trustees of these mutual funds undertake this potential periodic and monthly stress test on all the mutual fund schemes, and these schemes needs to be displayed on the website of the mutual fund as well as AMFI. AMFI, which is a regulatory body for mutual funds, is supposed to come out with uniform parameters for all the mutual funds, so that the potential risk can be compared across schemes by the potential investors who are entering into small and mid cap schemes there. In the last 1 year, we have seen net inflows coming into small and mid cap to the tune of nearly 65,000 odd crores. There is also an important thing which is coming in from the regulator is the communication that needs to be sent out to the investors as part of the information memorandum and on the website of these mutual funds. This potential risk has to be put out, especially the stress test results have to be put out and explained in a very simple manner and not in any jargon, so that investor understands the risk of investing in small and mid cap, and that could also mean that what is the risk he is taking while investing his money into that. The purpose is very simple. There is a lot of new investors who are coming into the market, and they're potentially going into the small and mid cap space, and the market regulator wants to ensure that the trust of these investors is retained and they don't get burned when in case there is a market volatility which is coming in. The SEBI is also looking at some kind of measures that should be taken voluntarily by the mutual fund industry, especially for small and mid cap with respect to exits. It is to ensure that the short term duration investment does not impact the long term investors who are invested in small and mid cap schemes, and that means that there may be some exit load that may be coming in for some of the investors who are looking at exiting in a short duration, 6 months or 1 year, and it could be dynamic in nature, and that needs to be spelled out to all the investors so that the investors are remain invested for a longer duration of time.
Thank you so much, Sajid, for those details. Moving on, we have one more NDTV Profit exclusive for you. Paytm has likely signed a deal to move its merchants account to Yes Bank, according to sources. We have Pragati joining us to shed some more light on this. Pragati, what are you gathering from your sources?
That's right, Mahika. NDTV Profit broke this news last evening that sources told us that 197 Communications of Paytm has likely signed a deal with Yes Bank to acquire the majority of the merchants' accounts. Now, let's remember that a lot of banks were in the front running for the acquisition of the merchant accounts because that's a significant chunk of Paytm's business. But sources are telling us that the deal has likely been signed with Yes Bank, and they'll be the ones having the majority of merchant accounts, because once the merchant accounts get transferred to Yes Bank, the VPA, that is the @VPA that merchant accounts had, would also change to that of the Yes Bank. Now, but the story does not end here. We also have another deal. Sources are telling us that Paytm has likely applied for a third-party application provider license or a TPAP license in collaboration with Yes Bank and Axis Bank. But what happens exactly after NPCI gives its approval, which is also expected shortly, possibly in a day or two, that's what sources told us. What exactly happens after this is that both these banks, or depending on which bank gets the approval first from NPCI, which is Yes Bank and Axis Bank, become the payment service provider or PSPs for Paytm's UPI transactions. So, as of now, sources told us that only 2 banks have been finalized, but let's remember that on 23rd February, if we take a step back, the RBI asked NPCI to examine Paytm's request to become a TPAP, and it also asked NPCI to examine or approve the certification of 4 to 5 banks. So while 2 banks have been finalized as of now, sources are telling us that there may be more banks coming up in the future. Now, if I have to quickly look at the context of what happens once Yes Bank or Axis Bank acquire or become the banking partner for this, the ramifications are going to be huge, because Yes Bank, if you quickly look at the numbers as well on the screen for our viewers, Yes Bank is the leader in terms of UPI transactions and also backs Phone Pay, and if it takes on Paytm, that would be a significant addition to Yes Bank's UPI transaction volume. Even Axis Bank, which has Paytm's nodal account, is going to be a significant beneficiary, because in terms of volume or the number of pay and other transactions, Axis Bank is also a leader. We'll bring you the more details as and when we have them.
Thank you so much, Pragyat. It'll be interesting to see how the story pans out. But it's time for a quick break now, but I'll leave you with what Bill Gates had to say about India's digital economy. Here's a slice of the exclusive conversation. We'll be right back.
Well, there's no doubt that being able to register citizens and get government payments to them directly, they don't have to go to a bank branch, nobody's asking for their part of that cash. The pandemic is a wonderful example where actually going to branches wasn't going to work no matter what. And so the amount that's been saved, and now the amount that the government's interacting in a rich way with citizens. For example, I saw an Odisha where they'd registered the farmers and they understood their land and their crops. And so they're sending them a regular bulletin and they're communicating about pests and what you need to do. So this is a case where India's been out in the lead. India did this thing at scale. They made it work, and the Gates Foundation has been involved in some of those projects. But we're also involved in helping India show other countries. So right now, there's 15 other countries at various stages of adoption, which a lot of that was kicked off by the way that Modi made that a centerpiece of the G20 meeting.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than rupees.
Good morning and welcome back to NDTV Profit. I'm Mihika Barve and you're watching All You Need to Know. Moving on, let's get you the key stocks to watch out for in trade today. We have Mahima joining us to give us an overview.
Right, Mihika. So the first one on my radar today is CG Power, where they've initiated a setup of a semiconductor unit in Gujarat, and the approximate investment that they're making is approximately 7,600 crores. Now, this will be a testing facility for semiconductors, and the capacity per day will be around 15 million units. Moving on, we have Dilip Buildcon also in focus, where the company has received an order worth rupees 1,955 crores. Now, this order is received from National Highways Authorities of India, and the order is for construction of 4-lane Urga Pathaglon in Chhattisgarh. Then we have Adani Group stocks, which will be in focus today because the Adani Group overall has reported an EBITDA of growth of 63.6% year on year, and the 12-month EBITDA stood at 78,800, which is 37% more than the FY23 figures. Now the cash balances stood at approximately 44,000, and the EBITDA was majorly driven by their core infrastructure platform that generated around 66,200 crore of EBITDA. Their airports operated also increased by 23% year on year, and the domestic cargo handled by Adani Ports also jumped 23% year on year. And lastly, we have Chalet Hotels, where the company has acquired its partnership stake in Ayushi and Poonam Estates LLP, and the acquisition is for approximately 315 crores. So all these stocks will be key stocks to watch out for in trade today.
Thank you so much, Mahima, for those details. But we have some breaking news coming in about 197 Communications, which is Paytm. Paytm and Paytm Payments Bank discontinue various intercompany agreements. Now, Paytm Payments Bank shareholders to simplify shareholder agreement to improve the governance. According to the exchange filing, they've mutually agreed to discontinue various intercompany agreements between the two entities to further support the shareholders. They've also announced earlier that they would sign up new partnerships with other banks and take measures to provide seamless service for its customers. And that's what we have on Paytm. We'll get you additional more details further during the day. But we also have some more stocks that we have to keep an eye on, and my colleague Varsha joins us with the details. Varsha, good morning. What are you picking up?
Good morning, Mihika. So first, let's start with Pharma Pack. We do have few companies, starting with Suven Pharmaceutical, wherein Suven Pharma and Cohance Life Sciences have announced merger. Now, transaction is expected to conclude over the next 12 to 15 months. Cohance shareholder to get 11 equity shares of Suven for every 295 shares held in Cohance. Also, the proposed merger is expected to be double-digit EPS accretive from first year itself. Now, why they are doing merger? The one is to create a diversified CDMO platform with your pharma CDMO, with your specialty chemical CDMO and API. Also, if you see, let's look at the Cohance platform overview, what they've done with CDMO. Their CDMO contributes almost 32% of sales in 9 months FY24 versus 18% in FY20, and contributes 44% of gross margins. Also, if you see their API contributes almost 68% of sales as on 9 months FY24 versus 82% in FY20, and contributes 56% of gross margin. Then we have Biocon, wherein they've signed a settlement and license agreement with Janssen Biotech to commercialize its BMA-B1200, a proposed biosimilar to Stelara. Now, this drug is used to reduce symptoms of arthritis, basically. Now, company will launch its drug in US in Feb 2025 once approved by US FDA. Also, this Stelara had sales of almost $7 billion in 2023. Then lastly, we have Aurobindo Pharma, wherein they've inspected injectable facility of Eugia SEZ Private Limited. Inspection was conducted from 19 to 29 Feb and closed with 7 observations.
Thank you so much, Varsha, for those details. Moving on, another set of stocks in focus today is going to be the auto pack to the likes of Maruti Suzuki, Hero Motors and Bajaj Autos, as the Feb auto numbers are set to come out. We have Vinay joining us with the key monitorables ahead of the auto sales data.
Yeah, so the highlight of the day could be the two-wheeler segment, because the analysts are expecting that it could be a double-digit growth for the industry, and this will be led by the mass segments within the industry, because mass segments sales were quite muted in last few years, and after we have seen that there has been some recovery in previous months, that recovery is going to continue in February as well. So there has been no price hikes in the segment in the last 3 months, as against if we see at the passenger vehicle or commercial vehicle segment. So this has aided affordability of the segment. So this will aid the industry of two-wheelers. Coming to the passenger vehicle sales, the growth will be led by SUVs. The growth could be in double digit for some company and in single digits if we come at the Maruti Suzuki, which is the market leader. The higher wholesales than retails means that the inventory has also gone higher at the dealership level. The discounts have inched up and the waiting periods for popular models have either remained stable or have fallen. In the commercial vehicle segment, the sales will remain weak as order inflows have also slowed down before the general elections. The freight demand has also weakened down, but prices have remained stable. Right. So this shows that how the commercial vehicle industry is holding on to the margins. The tractor sales are also going to be weak in February.
Thank you so much, Vinay, for those details. And with that, it's a wrap on today's edition of All You Need to Know. But do stay tuned. India Market Open is up next.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards...
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
There are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you?
Welcome. It's the 1st of March. You're watching India Market Open, and what a day it's been yesterday. We started with caution from the SEBI, ended with a very strong GDP number, and of course markets did a U-turn. So we start March on a 50-50 note, I'd imagine.
Yeah, I'll pour some cold water at the end of all of this, but yeah, the cues thus far, guys. You couldn't have asked for a better setup for Friday, right? Global markets, GDP, our markets ending on a high. That was perfect.
Yeah, and that's great because Feb has otherwise not been a very exciting month for Indian equities. It's been volatile, and generally you have the IDs of March. So there's a lot of trepidation going into March, but definitely after those rocking, there's no other word, rocking GDP numbers yesterday, we're looking set perhaps for a better March, and we'll come to it in more detail.
Taman, I think it's still a divided house, right? Because a lot of people say the numbers only justify current valuations. Now, whether this is going to give the next leg up to the rally is anybody's guess. I have my doubts, but we'll discuss that.
And okay, so from market's perspective, yes, but the fact that India is growing at this pace, despite everything,
from the Barclays to the city, everyone seems euphoric, but we'll talk about that over the course of the next hour.
Of course.
Quick check on implied Nifty before I toss it over to Tamana for global cues. It looks like it's going to be a good start. So I think we're taking heart from the fact that the markets, after a very smart recovery in the last hour of trade, are indicating to a gap up this morning. Small gap up, but nevertheless, and it's also Friday, so I think there'll be lots of factors playing out today.
And superb cues from the US overnight, if that's something that the market is looking out for. Feb has been fantastic for Wall Street, no doubt. The Nasdaq ended on a record high, closed on a record high. You've had the S&P also close at a record high, so that's been great. One second, mic's a little, so that's also been fantastic. So the tech stocks rally continues unabated is one way to put it, and we'll just pull up what's happened through the month, through February for the US market. So that's the Feb for Wall Street, at least Nasdaq up 6%, 5% on the S&P 500, and the Dow up 2%. So important data came out yesterday. PCE is something that the Fed watches. It's the personal consumption expenditure, sort of gauge of how people want to spend. So it rose 0.4% as per expectations. It's also an inflationary gauge. So the 2.8% figure that it ended up at, so not higher at least, but it's still above Fed's comfort level. And that then has now definitively pushed the cut expectation to summer, so June maybe, not before that. So, not too much of crying over it though anymore, and that's the important bit. So you saw the US 10-year inched up very, very slightly because of this at 4.26%. Crude has also been up in the month of Feb. I'm just going to give you the Feb picture to understand what's happening next, because OPEC Plus is going to meet expectedly. For another quarter, we'll have production cuts, and that might go on through the year actually. So crude want to keep an eye out on. Asian markets are looking good, broadly looking good. Definitely. China data came in on their manufacturing, and that's slightly lesser than expected. But on the other hand, if you just pull up what's happening in Asian markets, not too bad at all. Nikkei, of course, the continuing champion. We should do a deeper story, really, what's happening there. Quick look at fund flows before I hand it to Neeraj for the trade setup today. And we were talking about how the close was decent, and you had buys from FIs to this extent after a while. So about 3,500 crores from FIs, DIs 230 crores. DI is a whole different story, because I think a lot of the industry, from what I'm hearing, is still trying to figure out what's happening with their small cap and mid cap funds and where they go next.
Yes, indeed. But just what happens in the US when the US sneezes, the world catches cold, and vice versa. And for me, when Ray Dalio says something, I stand up and take notice. Most people should. And so much talk around what the US markets are doing. Ray Dalio in a LinkedIn post says, and I think we have his quote made, wherein he says that when I look at the US market using these criteria, there's some criteria that he follows. There's a hyphen. We've done a comma here, but nevertheless, he says which is the US markets, and even some parts that have rallied the most, which is, he's referring to the tech stocks, he's saying it does not look very bubbly. So Ray Dalio, of all people, is saying that US markets does not look out of whack, which is a tall statement from a tall finance veteran coming in. So maybe, just maybe, if indeed some behemoths don't believe that US markets is in a bubble. And if the US market stays steady, we might have some good news to follow as well, because we don't have global stress to deal with. Now, the trade setup for the day today, well, global cues, strong GDP data will all aid the mood today. So no surprise there. I already mentioned the implied Nifty open, which is about 47, 48 odd points. Yesterday, we spoke about how PCR was at 0.66, and that led us to believe that markets may not really fall too much, and they didn't. Now the PCR has jumped to 1.09, by the way, in a single session. So expiry-related moves keep on happening. But the point is, quant indicators still indicate upside possibilities. So watch out, maybe, just maybe, the chances of an upside relative to the downside are a lot higher. So that's the other thing to keep in mind. Yesterday, we spoke about how autos may have a good outing, considering the expectations that people have from what the Feb data will be, and we'll talk about that too. So autos revved up on expected lines, but I reckon that if the monthly sales numbers come out as expected or better, you might actually have the auto index continue with its momentum. So that's also to be watched out for. But guys, in speaking about Feb and March and what the moves happen in either of these months, here's some data. The last 4 years, and even if you discount the COVID year, the last 4 years, we've seen a temporary top form in February and a fall come in March.
Yeah, the IDs of March, that's what I was saying.
So look at this, and it's true for the last 4 years. Feb 2020, the high was 12,246. The March low was 7,511. Now that was a 38% fall, and you can argue that, chalo, that was the COVID year, so it was to be anticipated. 2021, Feb 2021 high, 15,431. The April 2021 low, 14,151, which is about an 8% downtick. 2022. Feb high, 17,794 on Feb 22nd, by the way. And March 2022, which was, I think, on March 8th, the level was 15,671, which is a 12% fall. And 2023 as well, 18,134 was the Feb 2023 high. The March 2023 low, 16,828, about a 7% fall. We've done about 22,217, if I'm not wrong, in Feb. Now we just hope that the history doesn't repeat, the 4-year history doesn't repeat, and you don't have a lower level.
Great. Feb wasn't that great.
But still we had the high.
I think the good chances Treasuries usually close books in March, and hence the profit or taking money off the table. Well, we don't even know what happened before 4 years. These markets were not as deep as they were, and we probably didn't even care too much. There was a very small portion of equity that probably found its way into Treasury. So one reason you see then the March effect is year-end. Treasuries do take some profits off the table, and we've gained about 3 months, 10% in the last 3 months. So let's not forget that. While Jan wasn't too strong, the months preceding that haven't actually been too bad. So we shouldn't be too disappointed, is all I'm saying. And we've talked about consolidation, we've talked about time correction extensively, and that could be playing out in this series. So it's going to be a difficult March, but nevertheless, we'll take you through all the stocks you want to watch out for this morning. Neeraj mentioned how automakers will be in focus. So counters like TVS Motors, Bajaj Auto, Tata Motors, Maruti and Hero Honda will be counters to track on back of auto numbers. PV sales might be seeing a recovery in this month, and that could be the knight in shining armor for some of these auto stocks. Well, moving on from there, let's take a look at stocks that beyond auto counters will be in focus. Yesterday, healthcare providers got hit bad. Today, pharma companies are back in focus. You've got Biocon, you've got Aurobindo and Suven Pharmaceuticals for various reasons. Let's start with Biocon. They've signed a settlement and license agreement with Janssen Biotech. The agreement is to commercialize its BMAP 1200, which is a proposed biosimilar to Stellar. Well, apart from that, that's of course the good news. Stellar's revenues are close to $7 billion in the US, and this was in 2023. Along with this, that's of course the good news. In terms of negative news for that the markets may potentially react to is Biocon had a US FDA conducted their inspection. They've issued 4 observations under Form 483. These observations do not impact manufacturing and distribution of products. That's what has been confirmed, but the stock might react sentimentally to that news flow. Well, Aurobindo Pharma, that's the other one, where the US FDA conducted inspection. They inspected the injectable facility of Eugia SEZ. They have come out with 7 observations. The Unit 3 of the Pharma Specialties, which is a wholly owned subsidiary of Aurobindo Pharma, is where these inspections were conducted. They've restarted production terminally sterilized product lines at this facility, but with those 7 observations, it'd be interesting to see what the markets feel about that. In some other acquisition news, you had Suven Pharma as well. They've concluded their merger with Cohance Life Sciences. The transaction, they've announced that merger. The conclusion of that will be over the next 12 to 15 months. Cohance shareholders are expected to get 11 shares of Suven for every 295 shares held up. This will be double-digit EPS accretive to Suven Pharma. So good news on it. We will be talking to the management and, of course, take you through the rationale, what this is going to do to its top line, synergies for the company, and, of course, the conclusion of the deal as well. So that's Suven Pharma for you, and Aurobindo and Biocon. So, guys, those are the 3 from the pharma pack that'll be active. But I know healthcare generally got hit really badly yesterday. So.
Yeah. Just for Suven, I mean, just the fact that Advent's stake now becomes the way it is, right? 67% is a big deal. I mean, yes, on anticipated lines, but that's from 51 to 67. So Advent, such a large presence through Suven is arguably a big thing for Suven as well. So could be a very interesting one to watch out for today.
Yeah, we'll be hearing from them ahead in the day, and that's going to be interesting. But just on the point of healthcare and programming reminder, we're going to be, breaking down with Narayana Hridale, what the impact is for hospital stocks. You saw quite a tumble yesterday because of a Supreme Court order that says that there has to be sort of a limit in terms of the cost of procedures, which from the point of view of, the average citizen, all right, important, but you have to understand the other side of the story, that how these hospitals can continue to give quality and, of course, from a stock market perspective, profitability. So we'll be talking more about that. But solar stocks are the other one that I want to highlight. So we know that the Prime Minister had announced a scheme on, solar rooftops, and 1 crore households will be given these solar rooftops. Now, the modalities of that scheme have become clear. Yesterday, the cabinet has cleared it, which is an important step to actually, taking it forward. So I would keep an eye on a Borosil Renew, Avari, a whole host. Borosil more than anything else because actual sort of impact in terms of making those parts, that's important. So what has happened is that they have made it clear 75,000 crores odd is what they are going to spend. The government of India is going to spend to make it happen. And that always gives confidence to the market because then there's clarity of the scheme. There are details also out of subsidies which are going to go directly into people's accounts if they choose for this. Loans will be given. Collateral-free loans at 7%. So this is going to be actually a starting point because even if you're not in that first cut of people who are getting government subsidies, once this becomes a system which is in place, the potential upside for solar rooftops is really sky's the limit. So this is one I would watch. The other one is Star Cement. Just quick mention because cement has also been an interesting space, a lot of movement, but Star Cement has received an LOI, about 11% up in a month. Not bad compared to the broader market. It's received a letter of intent from Coal India. 3.12 lakh tons of coal per annum is what they will get. This fuel supply agreement is for 10 years. So Star Cement one. 197 Communications. So 2 pieces of news there. One, of course, is an NDTV Profit exclusive, and the other, just came out a few minutes ago. So the exclusive story that we have is that Paytm is likely to move their merchant accounts to Yes Bank, and UPI transactions will be moving to Axis Bank. But apart from that, also an announcement a short while ago that Paytm and Paytm banks are going to discontinue various inter-company agreements, and shareholders of Paytm Payments Bank will be simplifying the agreement, the shareholders agreement, to improve governance. Now, this is a stock which has had a wild swing down, of course, 33-34% in the month. Obviously, since exactly a month ago, the news came up, but it has recovered from its lows. So we have to see what this plays out for them because clearly the books, in a sense, are being squared for Paytm Bank and those loose ends getting tied up. A lot more, but I'll come back to that after you're done, Neeraj.
Yeah, no, so for 197 communications, the other piece is what NDTV Profit exclusive was yesterday, right? So that it will be interesting to see both of these things play out. So watch out for that one. Watch out for Dilip Buildcon. We have a management conversation coming in later today, but they've also received an order worth 1955 crores from NHAI. So that's the second one in terms of the stocks on my radar. In addition to, of course, healthcare. Remember, we've spoken so much about it. Also adding to the healthcare luster is the US Jan data, which has been so strong that almost all generic makers could actually see traction in the session today. So watch out for Dilip, aside of Pharma and Paytm, Dilip Buildcon. And a small stock, I don't know too much about this one, viewers, so be careful. But Think Inc. Pictures. Now, I had not heard about this name until I saw the bulk deals, and it's a P-note transaction. In SocGen's case, it might be a prop buying as well, but SocGen has bought about 837 shares, and BofA Securities Europe about 307,654 shares. It's a 275 crore market cap company. I do not know anything about it. I doubt too many people know much about it. The volumes are okay, and there's been significant buying happened yesterday. Let's see if the stock reacts. It'll be interesting to try and research a bit about this. But if it reacts, you should know why it is reacting. The reason is possibly this P-note buying that has happened, and significant 6 lakh shares bought for delivery. And that's very large for the stock of that size and that volumes. So keep an eye out for this one as well. There is more, but I'm sure you have more.
Just a quick one on Dilip Buildcon. We are going to talk to the management. So of course, you'll find out more about that order win and the fact that they are going to be debt-free. For an infrastructure company to be debt-free in 2 years is something that's noteworthy. Just a quick mention on 2 IPOs, Exicom Telesystems. This, of course, closed for subscription yesterday. But talking about liquidity and talking about how flush opportunities or lack of opportunities in the market, this one was subscribed 129 times. So commendable amount of money still flowing into the IPO market, and that's obvious with the kind of subscription that some of these IPOs are getting. So just a quick word on that one. The portion of non-institutional investors was booked about 153 times, while QIB quota was booked 121 times. That is, of course, an IPO subscription that's closed, but Bharat Highways InvIT, this one's also been on the radar for a lot of investors. It's a great proxy if you're looking to play the infrastructure story in India. You can either do it through equities or through InvITs. This one also closes for subscription today. They're looking to raise 2,500 crores. They've already raised 827 crores through anchor investors, but that's the other one that I wanted to mention, guys.
Yeah, just a couple of stocks and areas you should look at. Adani Group stocks I wanted to mention because their Q3 for the year, the group has recorded has put out a record EBITDA growth, and there were notes on this as well yesterday talking about it. Standard disclosures, of course, but 63.6% has been the record EBITDA growth year on year in Q3 FY24 for the Adani Group, and this is driven by its core infra business. So this is one set of stocks that I would watch out for. Vedanta is the other one, a setback, and quite a crucial setback for it. And I'm picking up Vedanta because you had a very clear bull versus bear case a couple of days ago after their analyst call. Some brokerages felt a level of comfort in terms of debt reduction, etc. But the fact that the Supreme Court has dismissed Vedanta's plea to restart their Sterlite copper plant is definitely going to be seen as a negative. So that's one stock perhaps that you should track. Clutch of brokerage notes, but we will come back to those ahead in the show as well.
Yeah, I mean, the City on IT note is interesting. Tech Mahindra and Wipro, some downsides. Just before we go to editor's cut, I mean, there's also Gujarat Gas, but the auto estimates and just the numbers are interesting before we go to editor's cut. Bajaj Auto and TVS Motors are expected to show growth of 21 and 22% respectively. So those are to be watched out for. So that's the first piece. There is strength in Ashok Leyland anticipated, about a 34% growth expected on a YOY basis. So watch out for that one. And for Tata Motors and M&M, their cars business will do very well, but CV business and tractor business respectively would disappoint. So keep an eye out for those combined numbers. But can't take focus away from the fact that arguably the biggest talking point of last evening was the GDP data. So What were the intricacies and what should you watch out for? That is the first piece that we'll talk on Editor's Cut. And of course, top of mind for everybody for the last few days has been SEBI and its verdict on small caps. Sajith has an exclusive out there. But Vishy, multiple ways, multiple news stories, none bigger than the GDP data.
Yeah. Neeraj, so this 8.4% Q3 GDP, that sort of blew all discussions out of the water simply because it's just unexpectedly high. It's about 180 basis points higher than the highest estimate out there in the market. You're seeing strong growth on the manufacturing side, mining, construction, all of these various sectors showing an improvement year on year. Of course, last year's numbers have been revised to much lower. So obviously there is some amount of base effect playing in. Having said that, the growth number is still sort of shocking, and that's where the people are coming from. What is more interesting is the GVA, the gross value added growth, which is a net of all these of basically indirect taxes. You're seeing, and subsidies, you're seeing that portion coming in at 6.5%, which is absolutely where the estimation has been. So then what is this gap between the GDP and the GVA? Well, essentially taxes. The taxes. So that's up about 6 quarter highs, 32% higher, the growth rate. That's obviously going to push up the headline GDP number. What is more interesting is also agri. I think the contraction, this is the first contraction in 5 years, not even during COVID did we have a contraction on the agri portfolio, agri side of the story. It also sort of ends this discussion whether rural economy is under stress or not. I mean, it's very clear it is under stress. There is a monsoon issue which has played out in the agri sort of growth. What the government seems to suggest is that there is improvement in monsoon coming in FY25. Receding El Nino, better sowing of crops, all of these things are going to sort of improve on the agri front. FY25 is going to look significantly stronger. The government is also pitching for a better sort of outlook from multilateral agencies, IMF, World Bank. All of them are much below RBI's 7% estimate for FY25. So, we need to see what exactly those multilateral agencies do. Of course, the government's job is to pitch for a higher rating. But that's where we are at this point in time.
Yeah. So, I mean, Vishy, the standout feature, obviously, the taxes uptick or the tax buoyancy is leading to this. Suffice to say, though, that one shouldn't extrapolate this to what will happen in the next 4 quarters.
Not a stable source of optimism.
Yeah.
But
very quickly, Sajid.
If I can come in here.
Very quickly.
Manufacturing growing at 10%, which is good. But consumption at 3.5%, which is bad.
Don't steal my thunder.
But
don't steal my thunder.
But let me say that if the consumption remains the same thing, then you're going to see a moderation in manufacturing because there will be a high supply coming into the market, and that would have.
Sorry, why?
Because manufacturing, there has to be a consumption, right?
A lot of manufacturing is export driven any which ways, right?
No, we don't. We are not an export driven country in that way.
A lot of manufacturing being set up export driven, no, Vishy?
I mean, there's also but you have to also consider the fact that there are external uncertainties also. So your export story might look good on the services front.
No, my limited point being that manufacturing thus far has stayed strong despite consumption numbers staying low only.
So consumption numbers staying low. Yes, true. Having said that, you still have to worry about where the globe is going.
Most certainly.
Because that's something that even the government, for example, the CA held a briefing last evening, and he was very clear to point out that there are certain uncertainties and there are elections around the world. So you don't know how things are going to pan out, let's say in 6 months or so.
Most certainly. No, I mean, if you are one of the top 5 economies, you can't be isolated from what the world is doing. But thus far, I must say, it does look. So from a market's perspective, I just thought I'll quickly throw in a quick perspective before we get to the other piece. I mean, how would equity markets probably perceive Q3? I was thinking that equity markets have this reassurance that there has been strong growth now, not just for 1, 2, but the last 3 quarters at the very least, right? So that is one reassuring part. And the HSBC flash PMI data thus far is pointing towards decent activity at the start of Q4 FY24 or Q1 CY24 as the case may be. So is that some reassurance that while we've had a very strong last 3 quarters, maybe just maybe the start of this 4th quarter as well has not been too bad. So that is the other piece. But will markets think that the tax buoyancy that we've had thus far, which has led to the GDP uptick, will that moderate? I think the markets would firmly believe that that will be the case. So in some sense, there will be some tempering of optimism or enthusiasm by this GDP data.
The base effect will play out in the next year.
As well. But yeah, just the fact that taxes buoyancy has been so strong, and at some point of time, you've got to give way to it because it won't continue. And private consumption, which I was telling Sajid, don't steal my thunder, 3.5% really, something needs to happen there.
You have to also look at the fact that there's a core sector sort of slowdown that's coming in for January. I mean, at least that's 1 month worth of data. For the whole quarter, we still need to see how that plays out. But there are sectors that are actually contracting within the core 8 core sectors, and doesn't look that great for the Jan-March period.
Yeah, it doesn't.
7.6 will probably come because of Q4. So let's see what happens for FY24.
Just very quickly, we have 30 seconds on this before we move to the next piece. But what I thought was, will markets worry about it? Specific sectors, electricity and other public utilities expanded 9% versus 10.5 QOQ, and construction 9.5 versus 13.5% QOQ. Maybe not that much of a worry because we know it was an exceptional quarter. Correct. Q2. A lot of spends happened then. This is seasonally also a weak quarter for electricity, etc. So maybe the markets will not read too badly.
Just to add,
20 seconds.
Thermal is not doing means that much, but renewable is what is driving the growth in energy growth.
Yeah. Well, thermal hopefully will pick up. We've spoken to the coal secchi, by the way, and I think that conversation will give some insights out there too. But so this is the GDP. 4 more minutes for the next piece, Sajid, and that is something that has been spoken about for the last 36 hours, at least, if not more. The SEBI caution. Now you have some exclusive details.
That's right. A stress test on a portfolio which is valued at 5.4 lakh crores. That's the headline. There are nearly 56 schemes within small and mid cap there, and the regulator wants a stress test on each and every scheme of that. It doesn't mean a riskometer like a very high risk or low risk. They want to do a stress test on liquidity, or how liquidity will pan out if someone is going to sell today, or the volatility and redemption comes into play. And that parameters have to be brought in by AMFI so that they are constant for every scheme, so that investor can know that they can map across the schemes and see which is a scheme they want to go in. Today, investor doesn't know about these risks. Many of the small and mid-cap schemes have stocks which are highly volatile in that sense. The regulator wants a long-term investment in small and mid-cap stocks. There are 65,000 crores of new net inflows that happened in last 1 year, and that's nearly and there's an appreciation in the small and mid-cap by most of the small caps have doubled in last 1 year, right? So that needs to be brought in and put out on the websites of all the mutual fund schemes and AMFI in a manner which is understandable for every investor. It should not be jargons or formulas, but it should be in a way saying that if your portfolio, if market turns 10%, your portfolio redemption happens by 10%, what is the kind of impact that may happen on your NAV? And you need to be very clear to the investors that this is the potential risk in a small and mid-cap fund, and you invest accordingly. They are also looking at exit load making it a little more difficult, in the sense the returns will be much lower if you are a small term investor or small term investor basically. So if you're investing for 6 months or 1 year, the exit loads are going to be higher. If you're a long-term investor, it may not be there. But this dynamic thing, it wants the industry to bring in, rather than it's putting his hand and saying that, no, you have to bring in.
Sajid, sorry, just 30 seconds before we wrap up. The piece that you mentioned about mutual funds having to mention that if there is a redemption by 10%.
I'm just giving a classic example. This is the parameters are not been set. It has to be set by AMFI. But it will be in those lines. The danger of impact on the portfolio because of a redemption. Or
can I just ask a question? Yeah. Nothing comes out of this, let's say. Aren't you panicking the markets then by introducing all of these stress tests? If let's say nothing comes out of it, it's entirely possible that the industry is pretty strong and these stress tests don't really show any kind of issues.
We have 30 seconds for this.
We have been speaking to a lot of fund managers on portfolio manager, and many of them are small cap managers, and they have a stress test for the portfolio, and they say that it takes almost a month for them to exit a stock, and they have to do it in a very gradual manner so that it doesn't impact the stock or the price. So if that is the case here, then mutual funds also have to have that kind of stress test for the portfolio, because a lot of new I would say majority of the new investors who came in the last 1 year, they have come into the small and mid-cap company schemes.
Fair call. 43,000 crores total, and then that value has gotten enhanced. And just that, Vishy, even if it's a new thing, it may take time to digest in the first 1 month. Then it becomes a norm, and therefore people may not get so spooked by it. Who knows? But great insights, both of you. Thanks for that. And do let us know in the comments section, viewers, if you like the stuff that we're doing on Editor's Cut. It's a differentiated thing that we're trying to do almost every single day. We take a quick break. Up next, another differentiated thing. My colleague Agam Vakil joins in to speak about the derivative space and give you some option strategies that might help you make money. Stay tuned.
Presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy along with 16 other district cooperatives formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run
Welcome back. You're watching India Markets Open. Quick look at the implied open before we get to our F&O coverage and where we seem to be sort of heading this morning. So a positive start, no firecrackers, but definitely up in the green. What are the F&O cues looking like as we begin the March series? Let me go across to Agam for more.
Right, well, a new series and a lots to keep an eye on, but not bereft of volatility because of the high wicks environment that we are in at the moment. Now, yesterday we did see marginal gains, but on an intraday basis, it was a relatively choppy one. We did see the Nifty's add about a 33% increase as far as open interest is concerned, but that is also on expected lines because we are moving into new series, and it's the same for the Bank Nifty, which did advance by around 0.3%. And nearly 34% added there as well. Now, yesterday was a day where we did see some amount of consolidation, though, of course, with some amount of choppiness coming through, but it was a 22,200 mark where we saw most amount of writing activity. And, of course, that also serves as a near-term resistance of sorts. But let's pull up the open interest distribution, and that'll give you an idea about how things are panning out there. So maximum open interest in calls stands at around 22,200, and that input stands at around 22,000. Though 22,000 is still a little bit of a pivot, I would reckon that we will likely see a little more support around 21,700, 21,800, at least based on the data that we're seeing as far as puts go. Of course, we are heading into another week, and it is going to be another volatile one. So keep an eye on this, a lot of these factors, especially given that option premiums tend to contract so much towards the end of the series that in fact also leads to considerable volatility. But finally coming down to stocks and those which have in fact seen a surge in open interest as we move into the new series. So we have Z Entertainment along with something like an ABFRL and MRF, which are under pressure, shorts coming in, and longs for Canara Bank and Chambal Fertilizer. So see, these are some of the stocks that we will be keeping an eye on. But what are our markets experts making of these cues? Well, let's get in Shivangi Sarda of Motilal Oswal, who's joining us on the show. Shivangi, good morning. Thanks for joining in. Your assessment on the benchmarks, how would you address them as we move into a new week?
Good morning. Thank you for having me. So we've seen that the rollover figures for both the indices have been quietly fair enough in line with their quarterly averages, but Bank Nifty has seen some sort of lower rollover as compared to the previous months. Now, talking about index-specific, Nifty, we've seen that there was good follow-up buying in the entire February series, and it kissed a lifetime high as well. The last week, we've seen that there was quite a lot of volatile swings and profit booking, but then overall, the support base is quite strong. So now we are, immediately expecting that the index should hold these zones for a good up move. Now talking about levels per se, index should hold and continue to move above 22,000 for an up move towards 22,222 and then 22,350 zones. Supports, on the other hand, are placed at 21,900 and 21,750 levels. Now, talking about Bank Nifty, we've seen that the index was underperforming. It continues to do so, and it was followed by a pause in the second half of the session. But then overall, the index has contributed in this series after a lackluster of quite a lot of series. It respected its previous series low as well. So overall, we are expecting the banking index to pick up momentum. Short covering was seen in the series so far, with an open interest reduction of 30% of the shorts. So overall, we are, indicating that there should be some sort of strength over here for the index to move as well, because overall, we've seen only the IT pack has been supporting. So levels per se, immediate basis, we are looking at Bank Nifty to hold above 46,250 for a bounce towards 46,500 and then 46,750 levels. Whereas support can be seen at 45,750 levels.
So those are levels to watch out for as far as the Nifty and the Bank Nifty go. But Shivangi, what about trading ideas this morning?
Trading ideas, I'm looking at Tata Consumer. This is the first pick on radar. The stock is looking quite positive with good amount of rollover over here as well in the previous series. Overall, we've seen that the consumption space stocks are picking up, from their lower zones, and overall, week-on-week basis, this stock has, performed from its support zones. So we are expecting a good up move over here. Now, one could actually expect this stock to go up and, initiate a bull call spread over here, which involves buying the 1200 call and selling the 1260 call at a net cost of around 15 to 18 points with a maximum reward of around 42 points. Now, the second pick on my radar is Siemens. We've seen a lot of action in the cement space as well. In fact, there is a lot of tailwind from the sector. Month on month basis, the stock has given a breakout and holding above its previous hurdle zones, which is now becoming its support levels, which is about 4,000 levels positionally. So overall, we've seen that this stock has continuously moved up with consistent buying at any small decline. And one can, initiate a bull call spread over here as well by buying 4,700 call and selling 4,900 call at a net cost of around 65 points with a maximum reward of 135 points.
Okay, so two bull call spreads coming in from Shivangi, and the first one is on Tata Consumer Products, where you are in fact buying a call and then in fact going ahead and selling a call. It's a very similar strategy for Siemens as well, where you are limiting your downside risk. Of course, you're limiting your reward as well, but the risk to reward stands at roughly around 1:3 in both cases. Shivangi, on that note, thank you so much for joining us and taking us through your views and also providing us a handful of trading ideas. And with that, it is back to you, Samina.
Thank you, Agam. Those, of course, trading strategies for the day. Agam also highlighting the F&O picture as we go into a brand new series this morning. Implied Nifty, like we said, is indicating to a slightly higher start, so it's actually not looking too bad in terms of trade. This comes in after a late recovery that D Street saw yesterday after a big sell-off that was seen the day before that. A start about 22,200 is what we're looking at in early trade this morning. Well, lots of stocks that will be in focus this morning, with CG Power topping that list. They've sign a JV to build and operate an outsourced semiconductor facility in India. Mika is standing by with more details on that. Mika, what do we have? What's the news on CG Power this morning?
Yes, so it's a management equipment and solutions provider. Now, CG Power, along with a Japan-based semiconductor solution power called Renesas Electronics and Stars Microelectronics, which is a Thailand-based OSAT provider, are going to come and join hands for a joint venture to build a semiconductor facility in Gujarat. This is a part of the 3 semiconductor units that the government, approved yesterday, which has an aggregate investment of 1.25 lakh crores. Now, the JV has been signed to build a outsourced semiconductor assembly and test facility in India. Now, CG will own 92.3% of the joint venture, whereas Renesas Electronics and Stars Microelectronics will hold 6.8% and 0.9% respectively. They will invest 7,600 crores over a period of 5 years, and the financing will be done by a mix of subsidiaries, equity, and potential bank borrowings if required. The manufacture facility will be set up in Gujarat and will have the capacity will ramp up to 15 million units per day. They'll manufacture various legacy packages and advanced packages that will cater to industries like automotive, consumer industry, and 5G. And that's what we have on CG Power as of now.
All right, thank you for that, Mehika, with that story on CG Power. In any case, semiconductors becoming a very, very exciting space. You had, presentation and a bit of news from Ashwini Vaishnav. He's Union Minister for IT as well, talking about how the semiconductor plan for India is now kicking off. Of course, the Tatas with that big investment there. So we should actually be, looking at a detailed sort of deep dive on what companies can bring you the best value in terms of their semiconductor forays. But meanwhile, Kush Bora is with us. He's founder of kushbora.com. Kush, very good morning to you. And, great to have you on the show. So, new month, new season. I mean, Feb has not been bad, but it has been rocky for sure. How are you seeing the index right now, the Nifty and the Bank Nifty pair through the day today? A lot of news coming in. You think the small mid-cap sort of pain has been digested?
Hi, Tamanna. First, a very good morning. Well, it would seem so, at least on the mid-cap and the small-cap front. However, my suggestion would be, as we've advised our clients as well in our advisory service, is to gradually shift towards large-cap. I mean, this year we've seen a lot of volatility. Interestingly, if I can take a minute or two to explain about, what's happened in the mid-cap space, at least from the technical standpoint. there's something called RSI divergence. Now, we've not seen such a big RSI divergence, which is for three peaks, which means for three consecutive times, the mid cap and the small cap indices have made newer highs, but the RSI hasn't really caught up. So I think some profit taking is inevitable rather. Then there is also the fact that there will be some pockets that will continue to do well in the mid cap and the small cap names. But I think on the whole, I think a gradual shift towards large caps is warranted in the portfolios. Now, as far as Nifty goes, it's been all over the place. But if you look at it from a slightly broad standpoint, 21,800 and 22,200, that's been the broad range, and we're still within that range. So as long as that range is maintained, in fact, if I can push it a little lower, 21,600 also, that will be my buying zone. Somewhere close to 21,800 and 22,300 again, and 22,500 are the targets that we'll be looking at. Bank Nifty, not so encouraging. Barely managed to hold on to its 20-day moving average, but until it takes out the 50-day moving average, which is close to the 46,800 kind of zone, I'll not be a big buyer in Bank Nifty, perhaps even consider some short at higher levels. But Nifty looks like a buy. And from mid cap and small cap, a shift towards large caps, is something that, the viewer should look at, at least for the year.
Then I have to ask you that follow-up. Okay, you're saying shift from the mid cap and small caps to the large caps, at least for the year. So which ones then, Kush? What's topping your list?
Well, if we just talk sectors, then I think the capital goods sector is one area where we could perhaps see some sort of an uptick. The finance space is something that could see an uptick. So these are a couple of names. I think the recent names like PSU banks or the railway basket. I'm not saying that they've run their course. Of course, there is still some steam left. But I think we'll have to get a lot more picky, in these spaces, in these names, in the PSC space, we'll have to get a lot more picky.
Stock specific, Kush, we're looking for stock specific from you and what's happening on the charts.
So the couple of stocks that I have on my radar, are Concor and HFCL. These are the two stocks that I have on my radar from a trading perspective and also from an investment perspective from, as I said, 3 to 6 months kind of a horizon. So Concor is something that traders can consider, and HFCL also. Both the stocks have seen a fair degree of rebound. So I think for a target of 995 and 1010, and a stop loss of 955 on Concor, and HFCL 111 and 114 are the targets, and 105 would be the near-term stop loss.
Quick follow-up from last week when we spoke to you. It was, I think, Geo Financials was a recommendation you had. We saw a big up move on the counter. It's cooled off over the last day or two, but still, I think, looking strong in the charts, right? At 310, Geo still on your buy list for a trade?
Oh, absolutely. In fact, I think, I don't know what the joke was, but, when the target 2 was hit and I said, let's hold this for an investment target of 350, it touched a high of 347 or 348 on the very same day. That was the exuberance that was, playing out. Now it's cooled off a little. It's again come back to, those buying territories. So I think buy on dips, the strategy that we talk about, it's the dip that the stock has provided and very much, on our buying list. In fact, this drop has made it a little more attractive for us. So again, with a target of 335 and 350, Geo Financial continues to remain a buy. And from a trading perspective, a stop loss would come close to about 275, 280 kind of zones.
Okay. Sorry, no, I just wanted to highlight one stock because I think it deserves some mention across the day band today, simply because not just because it's an individual stock which is doing it, but it's just it's astounding as to how this has happened. Agrotech Foods, the promoter entity, has decided to exit the business. They hold about 51% stake. We should get up Agrotech Foods on the charts. It was up on the screen. It was up about 3% in trade yesterday. The point is, while they have sold the entire stake to the PE investor, they have done it at a price of 515. Agrotech Foods. They have sold it at a price of 515, which is a 48% discount to the current market price. And the open offer for 26% stake further is happening at a price of 578, which is about a 40% discount to the prevailing market price. Suffice to say, nobody in their right mind would give or tender to this open offer. But the point being, if you are a minority investor who bought the stake yesterday, who's been holding the stock and is looking at a price of 1,000 right now, you very certainly are looking at a price much, much lower than the current market price over the course of the next few days, it's a bit of a no-brainer really, and expect the stock to open lower. But the question really is, how is it that some actions like these are allowed to happen at some point of time? I think the regulator will come up, or hopefully does come up, and questions a transaction of this nature, because you can't simply sell out a stake at such a low price and leave the minority investor holding the bag in some sense. You could argue that the majority promoter has sold it at 515 and the open offer is happening at 578. So in some sense, it's higher than that price. But that's the promoter's choice.
In terms of regulation, does it stop them from getting the best price? I mean,
even if in black and white regulation, this might be allowed, Tamanna, but it's just shocking that something like this happens and the minority investor who's got no inkling of something like this due to come
gets left holding the bag.
Exactly.
Yeah. No, so that's the point. Part of it is, of course, what you're allowed legally to do and not do, and the other part is corporate governance and how you want to conduct business which is equitable to all.
Yeah, this is just shocking, and Agrotech Foods most certainly today will start off on a lower circuit. I would be really surprised if it doesn't. So let's wait and watch. It was up 3 or 4% yesterday because the announcement that came in at 315 was merely about the open offer, etc. The pricing came out at 6 o'clock or thereabouts. Let's wait and watch what happens here. So yeah, just thought should bring it out that this is one stock that we'll keep on talking about during the course of the day, and we'll try and get in some experts who understand regulations very well to try and talk about this as well, but certainly will be in focus. Okay, Dharmesh Kant Johnson, he's head of equity research at Chola Sec. Dharmesh, just before we get to anything else, do you have a view here on something like this that has happened on Agrotech yesterday?
I absolutely agree with you. Well, absolutely, this should be looked into, and such kind of activity should not be allowed.
Yeah, most certainly. Okay, Dharmesh, quick thoughts. Are you buying any economy-linked sectors on the back of the GDP data that has come out yesterday?
Yeah, good morning. No, Neeraj. In fact, at higher levels, I would be a seller in this market. I do expect this market to consolidate for as far as time-wise correction is concerned. And GDP numbers was great, but if you look at the internals in the GVA, that was not great. But you have rightly pointed out, economy-led kind of sector stocks can be in action. But the problem here is the valuations are too rich. You can have a pop-up today in most of capital goods kind of a stock or construction infra-led, but that's a pop-up and it will be sold into. That is my reading of the market and the reading of the internals of the GDP.
Dharmesh, I just want to get your take on the solar play, and this is something we brought up in our trade setup as well. And I'm wondering if you think we will see some impact on the stocks today, where there is a clear outlay now from the government of 75,000 crore rupees for this scheme of rooftop solar panels in 1 crore household. So it's more than just talk right now. Do you see an impact? And if so, which of these renewable players do you think has the most upside?
Yeah, I mean, the best part about this government is whatever they talk about, they walk the talk and the execution also happens. So the 75,000 outlay was definitely will be deployed in the future. And the beneficiaries as of now, to my mind, would be more of a BHEL, NTPC. NTPC has already announced a subsidiary where they would be focusing more on the solar panel and solar related equipment manufacturing, and that is where the bulk of this order flow will come into. And nonetheless, like SW Solar, Borosil Renewable, Sterling and Vincent, they all will also benefit because some part of that will come into play. But the problem with SW Solar or Borosil Renewable is that they have already skyrocketed. The valuations are way too rich for them. So from that, the best play to my mind is still NTPC followed by BHEL.
We've also got a few more stocks that will be in focus this morning. We've highlighted a few already, but some of these counters had already started with the reaction in trade yesterday. For example, the Adani Group names. We've also got Mahima who's standing by with more on that, and then we'll take a technical and fundamental view too. Mahima, over to you now. What do you have on your list this morning?
Right, Samina, so as you rightly mentioned, the Adani Group stocks will be in focus today because the Adani Group overall has reported an EBITDA growth of 63% year on year, and this is on the back of their core infrastructure platform that has generated approximately 66,200 EBITDA. Their airports operated have also seen a year-on-year growth of 23%. The domestic domestic cargo handled have also seen a growth of 23% year on year, and the cements have seen a capacity increase of 15% this year, and the near-term debt maturities have also been fully funded. So the entire group of stocks will be on the watch out today. Then we also have MOIL, where the company has fixed or revised certain prices of the different grades of manganese ore, where the content of manganese ore over 44% will be continued as prevailing. However, the grade below 44% has been increased by 5%. So this will also be on a watch out today. And the third one being Chalet Hotels, where the company has acquired its partner's stake in Ayushi and Poonam Estates. The acquisition is for 315 crores. It's a 158 room hotel. Now this is important because Chalet Hotels is entering into the luxury segment of hotels, and this is the second hotel that it has acquired in terms of luxury and premium segment, and this will add approximately 40 crores to their revenue. So all of these stocks will be on the watch out today.
Right. Kush, quick thanks Mahima for that. Kush, very quickly, any trade on the Adani pack, Adani Enterprise, Adani Power, any of those counters that you are constructive on this morning? Some of them did quite well yesterday in trade itself.
We have on our radar, the stock hasn't really seen that big a dip, and it's held on to key support zones. So I think Adani Ports is something that I would pick as my trade for the day. 1340, and once that is taken out, 1375 are the levels that we can look at, and a stop loss comes in at about 1280 kind of a level, where there's the 20 DMA place. So Adani Ports.
Right. Thanks, Kush. And we'll just take a quick break. We'll come back and continue our conversation. The market is expected to open in a few minutes. It's going to be a positive start. We'll take a break. We'll come back and continue talking to both of you. So stay tuned.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth Rs 16,618 crore was sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for
All right, back with India Market Open right here on NDTV Profit. Amongst stocks that will have a big reaction this morning, aside of Agrotech Foods, which will start off lower, Welspun Enterprises could be in focus. I think as per an exchange release, they've probably gotten a very large order, northwards of 4,000 crores. We'll try and get the management as well, but that's one stock. Welspun Enterprises will come up on your screen. That's one stock that could be in focus as well. Could be an interesting one. Dharmesh, coming on something like this, a 4,000 crore order, presumably, for a company of this size, what would it mean? Because orders are still coming in thick and fast for a clutch of the companies in this sector.
There's a question to me.
Yes, Dharmesh.
Yeah, definitely orders are trickling in, and both from the private space and as far as government infrastructure system, that is also happening. So that is the catch point. I mean, the business, there's nothing wrong with all these sector businesses as far as they are concerned. Business is growing as usual. The only point is the valuation metrics where things are heated up. So that's the only concern out there. And that is why, I mean, for the timing, we are choosing to stay away from any investment bets.
Okay. Well, watch out for Wellspin. Could be an interesting one. Kush, have you looked at the charts recently for this one?
Well, only when you started the conversation, but here too, nothing encouraging. 305 is a strong support zone, but perhaps because of the news, there could be an uptick, but nothing really too big on the chart.
Yeah, well, 4,000 crores. It's an MLD water treatment plant at Bhandup in Mumbai. It's design, build and operate a 200 MLD water treatment plant. So watch out for this one. Could be interesting. The water space from an ion exchange to multiple other companies are getting some fairly large orders. So could be interesting as well. The other space, of course, and we are minutes away from the pre-open session, is IT. And IT yesterday had a bit of a pullback. Now Citi's come out with a note today, and amongst everything else, they've laid out their targets, especially for Wipro and Tech Mahindra, to be about 9-10% lower than the current market price. They're neutral on Infi, negative on the others. So this is the kind of downside that they see on LTI, Tech Mahindra and Wipro. Kush, up one day, down the next, down yesterday, IT, especially Tech Mahindra and Wipro. Anything on the charts?
Well, Tech Mahindra is a very clear avoid, has been for a while now. The rallies have not really been as sustainable. For me, the surprise here is Wipro, because after a while, this was showing some strength. I do continue to believe that, there will be some buying that, that will come in at slightly, lower levels or perhaps from here on as well. So Wipro, I'm still constructive on. Tech Mahindra is a very clear avoid, and as I said, has been for a while.
That's the call coming in on some of those counters. Dharmesh, you want to come in with stocks that you like? Fundamentally, anything that's looking good to you, and I know it's not a strategic buy call that we're looking for, something more tactical in nature. So maybe from a 1 to 3 month, perspective.
I think if I have to stick my neck out, private banking space looks still very attractive to me, because one fact being, a couple of stocks have not moved up in spite of very good set of numbers, and the case in point being Hindustan Bank and ICICI Bank. So Q3 numbers were actually good for both of these banking companies. But at the same time, the price action has not been that great compared to, say, if a public sector banking space is there. So this is one area where I am looking for from a trading perspective, as you said, 3 months. So ICICI Indian Banks does merit a case, along with public sector banking places like Canara Bank and Bank of Baroda. So weightage would be ICICI and IndusInd first.
Dharmesh, right now the mood, the narrative, the conversation is about whether we will see a bit of continued pain in mid-cap and small-cap stocks, especially considering the SEBI direction as mutual fund companies figure out what they want to do. If we see opportunities or cracks here, is there anything on your radar from this space? And before you joined, we were talking to Kush about how perhaps, at least for the next few months, the focus should be on large caps. Do you have that view as well?
Yeah, definitely. This is more of a technical and regulatory kind of bottleneck which can come into play, or a hurdle or break which can come into play. But if you look at the numbers of Q3, we did an analysis of top 500 market cap companies. It was all about operating leverage and operating margin play. Top line has not grown to that extent. It's at best it has grown to 12 to 14%. And if you look beyond 200 market cap companies, 201 to 500, it's a very dismal set of numbers. The aggregate PAT has grown only by 3%. And that is where the concern has been in the entire, mid to small cap segment. Few pockets of mid cap from 51 to 200 kind of a market cap rank wise, if you look at it. So only 25% of that basket has led to this 36-37% kind of a PAT growth. That too based on the operating profit pay. So I totally agree with even Kush's analysis that there would be some time correction and some, these companies have to come out with a top line growth to justify the valuations where they are sitting at. So as a overall basket will definitely come in for time bound correction, if not a price correction. Price correction, some of it is taken, some more leg may still be there. But large caps does look attractive, and there I think private sector banking space looks more attractive to me compared to others.
Pick, Dharmesh, banking space, top pick.
I just said, I mean, a couple of minutes back, it's ICICI Bank and IndusInd Bank is the topic out there.
All right, so ICICI Bank and IndusInd Bank. All right, another segment of stocks that has been in the news are hospital counters, which is because of a Supreme Court observation and actually a deadline that they've given the central government, that the center and the state have to come together for prescribed payments or prescribed costs of procedures and operations. And if they don't really come back with a solution, then within a month, the Supreme Court says it will implement the central government health services guidelines. Now, this was seen as quite negatively for a clutch of hospital stocks. What we're trying to understand today is, can this really happen? What would be the impact on profitability for some of these companies? There's a Jefferies note also today saying that it's unlikely anything will happen very soon. But to get a sense of it, I'm joined now by Viren Shetty. He's Executive Vice Chairman of Narayana Health. Viren, very good morning. Great to have you back on NDTV Profit. Just to understand the issue, now at the heart of it is a PIL that says, why is there such a disparity in prices between government hospitals and private hospitals? And they give an example of cataract operations, for example, that cost 10,000 in a government hospital, anywhere between 30,000 to over a lakh in a private hospital. So let's start with that core issue. Why is there a disparity, and do you see the Supreme Court observations as a large negative right now?
So the price disparity between the government hospital and a private hospital is that in the government hospital,
I think it's on. I think we just lost the feed with Viren Shetty. We'll try and get that going. The interesting thing is, guys, that Jefferies puts out a note today and says that such instances, multiple such instances have happened in the past, and we use these these corrections as they happen as a buying opportunity, because the overall business model stays the same.
Absolutely. Viren is back with us. Viren, just want to do an audio check there. Can you hear us clearly?
Yeah.
Yeah, all right. So let's start that point from the beginning, because, you know, you froze in the middle. Yes, go ahead.
Yeah, healthcare is free essentially in the government hospital. It shouldn't cost anything because all the costs are paid for, and it's paid for from our tax money. The land is free, infrastructure is free, all the costs are fixed, the salaries are paid for. So the cost really is not the embedded cost. And if you go to a private hospital, the costs are borne by the institution and it is passed on to the customers. And so that's why you see a price difference. But I would say there is a larger point, for sure. There are a lot of people are not able to bear the cost of paying for healthcare out of pocket. And in some cases, they may be paying a lot, but people always have choice. There are a range of options they can go for. There are large hospitals, smaller hospitals, organized, unorganized, non-profit, trust, large corporate hospitals. So there is, in a market economy, a tremendous amount of choice that a lot of customers have, which they can exercise. Now, granted, that is only for the big cities, not the small towns. There needs to be a wider expansion of healthcare, but that will naturally happen as the economy progresses.
Coming back to the point of, what impact do you expect from what the Supreme Court has said? If they've given a month's timeline and have urged center and state to come together, do you think in a month you will be seeing some regulatory news which could be negative for you?
Maybe. See, the truth also is that what is the nature of the thing that they want? Does the government really want a uniform price for every single procedure across every single hospital, no matter the quality, no matter the infrastructure? In which case, yes, there will be a tremendous impact. This will be impact on the scale of what this country went through in the 50s, 60s, and 70s, where the price of everything was fixed. So what happened is the supply naturally came down. There has been an explosion in private healthcare because there's an unmet market need. And there is, in our country, an ability for people to get healthcare at the price that they can afford for most people, not for everyone. So if you disincentivize investing in quality, investing in high-end infrastructure, then you won't see any more of that anymore. So it will be a massive impact if you fix a common price for everything, no matter what.
Come to what the CGHS prices are right now, because the Supreme Court has identified a specific sort of yardstick to make a decision. So give us a sense, are these massively lower than your current prices for standard procedures, for example?
See, the CTHS prices were fixed in 2014, and even by 2014 standards, they were much lesser than what was being paid. It is currently what the government pays for their own employees, and their own employees get a very good deal in most hospitals, but it is not what the common man has to bear. The price difference can be as little as 20% from what it actually costs to 60% of what it actually costs. So it's not a realistic assumption, nor will the amount of effort that it will take to do a rational pricing study to actually find out what the embedded cost of each procedure is. That is an enormous exercise. Now you can do that, or you can just say, look, let the market decide. Let's not, as a government, sit around and fix what the price of every little thing should be, because we're not in a communist type economy anymore.
Just the last, question for you over here, Viren. And what kind of a role has the growth of insurance or medical insurance had in terms of comfort of pricing? Is it becoming more comfortable to price higher because when given the coverage of insurance, people will prefer a private hospital, a better quality one, even if it's more expensive?
See, insurance is the only way a developing country like ours will be able to bear the cost of healthcare. It is unnatural to expect a normal person to pay upfront for the cost of their car. No one pays upfront other than the top 0.1% for the cost of their house. They pay through loans, through EMI, and they stagger out the payments over a couple of years. So healthcare costs are the same throughout the world, and there's no reason why in India it would not be the same. So healthcare affordability is it's very poor right now because people are paying everything upfront. But as more and more insurance starts to go up, as companies like ours start getting into insurance, then you realize that actually the costs are not this one big lump sum that you bear upfront, but a small premium that you pay over the years. And that is something that becomes much more affordable. So this problem will address itself. The observations of the Supreme Court are valid in total. They're valid in that people are finding it quite unaffordable, but the solution does not match the problem that they're trying to solve.
Perhaps increase insurance coverage. Thank you so much, Viren, for coming in and explaining that entire issue to us. Pre-open rates have closed, and I'm spotting Hindalco as one of the top gainers. We're looking like we're in for a positive start.
Positive start, and when you look at the BSE 500, the stock that stands out really is CG Power. Up 9%. This is after the 4% uptick yesterday as the news gets digested about the plan that they would actually 14%. I stand corrected. On the NSE, it's 14%. On the BSE, it's about 9%. So very strong start to this one. Clearly, it's eclipsed some of the targets that experts might have on the charts as well. But I'm inclined to ask Kush Bora about this nevertheless. By the way, the other one is Bajaj Auto on your screen. The total sales are actually 25%, so higher than the 22% that was anticipated. So watch out for Bajaj Auto as well. The pre-open rates have settled, then the numbers have come out, and the numbers are better. So maybe expect a bit of spurt in Bajaj Auto as well. But Kush, very quickly, CG Power.
Well, I think we're seeing what we call an emotional gap up here. I think, take some money, off the table. Fresh entry should be avoided. And, we'll look at buy on dips kind of a setup here. Although it's broken a few resistance zones, but as I said, it's already factoring in most of the news that's coming.
Gurmeet Chadda, Managing Partner and CEO of Complete Circle with us as well. Gurmeet, good having you. Thanks for taking the time out. What did you make of this announcement around this whole 3 semiconductors and a company like CG Power qualifying for it? It's clearly showing in the way there is enthusiasm around this, but have you tried to analyze what it could mean for this business as well?
Neeraj, hi. Good to be on your show.
Thank you.
I think it's as he rightly said, that could be a bit of a reaction to the semiconductor news which has come in. But, the company has seen significant re-rating post-ownership change. Now, they have 2 businesses, the traditional businesses, distribution and manufacturing of, transformers and other equipments. And then they are into the control systems and communication systems. The stock at around 500 right now probably trades at maybe 65 times FY25 EPS. So I think that's a reaction to it. But semiconductor we have seen is one space where the market really likes. We've seen what NVIDIA has done. I'm not comparing at all. And you take years to build that kind of capabilities. So it could be a reaction to that news, but valuations are pretty expensive. Otherwise, bulk of the re-rating because of the promoter as well as the this news probably, in my view, is in the price.
Right, we've got 2 minutes to go, and it looks like we're gearing up for a pretty strong start, at least in the first few minutes. Gurmeet, very broadly on the markets, a quick word. There was an up and down with that advisory coming in from the SEBI. The markets got freaked, made sense of it, and finally did a little bit of a recovery in the second half yesterday. But largely speaking, advisors keep telling you to rebalance your portfolio. Now the regulator's telling you, I'd imagine. So what really is the big deal to get spooked?
I think market has some memory of 2017-18. 2017, if you recollect, small mid caps had a stellar run, and there was some recategorization SEBI and MP did on small, mid, and large caps, and that led to some massive churn. So while the headline index did not show much pain, the indices fell like 20-25%. 2018 was very brutal for this space, and it has run up. It has run up almost. The index is up 65%, and mind you, now it's a much bigger category. So the small cap AUM is 3 lakh crores. That's almost equal to large cap funds, and bulk of the flows, more than 50% of the flows, are coming in this category. People always have recency bias, and I think regulator is right in terms of they're not really trying to saying that there is systemic risk, but they want to prevent. So what happens is that a lot of these small cap funds, one of the fund is now 50,000 crores. You hold about 200 stocks and you keep getting flows and you keep buying what you like. At some stage, if the redemption happens, the same liquidity then becomes a bit of a challenge. So I think what will happen is, if you see some of these small mid-cap funds, they have raised some cash levels because SEBI is also asking you to do not only restricting flows, but do some stress test. So in the short term, they will raise a little bit of cash levels, also do some rotation in some illiquid counters, which could lead to some interim volatility. But I think this is a timely step to prevent a larger magnitude kind of a things. If let's say some external event like a war, like anything, any credit event happen, the unwinding can be really quick.
Got it. Gurmeet, stay on. So much more to talk about. Kush, 20 seconds left. If I had to ask you to give one top call for the day today, which one would that be?
Concor.
Concor is your top call. It's a day trade or a short-term positional trade, you're saying?
The short-term positional trade, 995, 1010 are the targets, and 955 is the stop loss.
Okay, guys. So Concor, 1010 is the target for that one, 995 or 1010. And I heard 950 as the stop loss. So watch out for Concor in the session today. Bring up the markets this Friday morning and let's see how we're starting off. Should be in the green. Let's see how much. Well, 86 points, not bad. 22,069 for the Nifty 50. Sensex about the same levels, about actually no, not as much. So there is a disparity between the Sensex and the Nifty. We'll get the components of the Nifty to try and figure out what's causing this. Nifty, okay, we're getting some iffy rates, but this is the Nifty contribution. HDFC Bank, L&T, no. I think these rates I've stalled a little bit. Let's just try and refresh this. Let's say if we can get the heat map up on the screen, because these rates aren't quite moving. But yes, Hindalco about 2.81%. Guys, I think we have a bit of an issue with the rates because the rates aren't quite moving. However, suffice to say that Hindalco is very likely started off well. And suffice to say that not too many losers in the session today. So I think that's to be kept in mind. Let's try the single stock charts and see if we are getting some rates there, because these rates aren't moving. Some technical difficulty and can happen. Maybe pull up Hindalco individually and see if we're getting Hindalco or a BPCL or a Cipla, and just try and see if we're getting those stocks individually. Maybe not. I think we'll just try and get... Guys, are you spotting anything on the charts yourself?
The breadth looks as good as what we were showing a few seconds ago, but quickly take you through the big movers this morning. It is Hindalco and Tata Steel topping the list. It's not just Hindalco. You've got both those counters ticking in gains of over 2%. Bajaj Auto on back of those numbers for the month are looking good. More importantly, the counter went ex-buyback yesterday, on back of which it saw some pressure in trade. So a little recovery is what is playing out in trade this morning. 2% high on that one. Tata Consumer looks good. Auto as a pack really is having a pretty pleasant morning. Hero MotoCorp too, not too far behind. Aisha, Tech Mahindra, HDFC Bank are some of your other gainers. A handful of losers. You've only got 5 stocks that are seeing pressure on the Nifty 50. Of the Nifty 50, 45 counters are trading firm. The 5 that are looking weaker this morning is Apollo Hospitals, Sun Pharma, Nestle India, Infi and Cipla, both that are trading flat. So all in all, it's a good start. The Nifty is holding itself together, 136 point up move on the index, 0.6% gain for now. Tamina, broader markets?
Yeah, absolutely. You are seeing broader markets actually not doing too badly this morning either. And, here, let me just go across to Gurmeet very quickly for his view of what kind of a mood that we will see. Gurmeet, we're just beginning the new month and absolutely, we spoke about a bit of that uncertainty yesterday that has settled. But remember that the focus towards large caps in this year was widely expected. And do you think that that's what the market will reward now?
I think broadly categorizing, large, mid, small is restricting yourself. And I've said this, so, the largest depository today is a mid cap. The largest ethanol play is probably a mix of small and mid cap. The largest tile maker in the country is a mid cap. So I think it's just that a lot of the categories in India are evolving and, continue to grow in size. Look at the Reliance Disney deal. Netflix alone market cap is $260 billion. And we had this entire deal happening at 70,000 crores, right? At about $10 billion. So I think a lot of the categories will go, and it's important to be with leaders and where valuations are more reasonable. I think interest rates will take some time to come off. Yesterday, the core PCE inflation came at the lowest since 2021. So I think that's one sign of relief. And pending home sales in US is also, showing signs of slowdown. So I think at some point of time, rate cuts will happen, maybe May, June. And that's the time when, one part of the index which is not doing well, which is financials, will startly coming back. The rate sensitives will make a comeback. Remember, there were no takers of IT 6 months back when Infy was 1,200 and TCS was 3,000 and HCL was 1,100. Right now, there are not much takers for a lot of private banks right now. I think financials will make a comeback. Let liquidity ease. I think the 1-year T-bill, if you see, I saw yesterday, is 7.1 and the 10-year GSEC is it's around 7.05. So, and liquidity is really tight. A lot of this will start changing post-advanced tax and as we enter into April and election season. And I think financials, in my view, can make a bit of a comeback and rate sensitives. I don't want to be too, clubbing myself, with large, mid and small cap kind of categorization.
Do you think HDFC could take lead then in that case?
No, I wish and hope, personally been holding it for a very long time. So it's frustrating. I think what I am a little disappointed is that the management hasn't really come out with a more concrete guidance. I think there's also the leadership change. A lot of things happened. RBI had some actions on them. The credit card businesses had some issues. I think one issue which has not been highlighted enough in HDFC is the branch level attrition. They've been adding 1,200 odd branches year after year. A lot of the branches take 2-3 years to break even. So as they mobilize deposit and they can address, that's like 33% at a branch level. And I think that attrition is also leading to some kind of issue, even in the deposit mobilization and CASA. I think if they can address that more effectively, I think it'll come back. And, this problem is temporary in my view. If they've taken 6 lakh crore kind of a mortgage book, there will be pressure on CD and liquidity coverage issue. I think with maybe 1 or 2 quarters, this should have. And 14 times earnings, I think you don't get this kind of a franchisee at that valuations.
Guys, what's impressed me so much in the last few days, and yesterday when I took notice of that, Zomato. I mean, if you just look at the 3-year chart or a 4-year chart of Zomato, from 169.5 or 170, the stock fell down all the way to 45 rupees. It's recovered all of that ground, is at 171. You, I, Samina, I'm guessing all of us use that or Swiggy, either of the two. I'm not being saying that we use one or the other, but everybody uses these apps now.
The other one's going to have an IPO by the end of the year.
And we are not even talking about Blinkit as yet and the contribution, what was considered to be a drag. As per a lot of my friends who've got kids, maybe the two of you could be saying this out as well, maybe, is Blinkit is one of the top apps for all the youngsters who use Blinkit to order last minute groceries.
Luckily, our kids are not youngsters who are accessing Blinkit yet.
We are using it. And
you are, okay, I'm not using Blinkit, sorry.
No, I'm taking offense at all the statements. No, so Blinkit is fab, but what's happened with Zomato, I don't know if you all have noticed on the app, now you can book tickets on it. So they have moved into events as well. It's a beta rollout, I think, in some cities. They've not really quite announced it, but they've gone into book my show territory as well. So there are extensions, I suppose, that are coming in, and that may have
becomes a super app at some point in time.
And it's a striking contrast from what this was. 2 years ago, every single person in the street had written off Zomato.
Exactly the point.
So it's a turnaround of sorts.
And we're not talking about Blinkit, I repeat.
Yeah.
We're still not talking about Blinkit as yet. And what it could do.
Yeah, just a quick mention, Suvain, I don't know whether we talked about this one, but have you guys seen the up move on that deal? It's 10% on Suvain is what we have this morning. So that's pretty much what I wanted to highlight, but I think it'd be nice to get Gurmeet on this. Neeraj, you want to pick that up?
No, I mean, but the same thing. Gurmeet, any thoughts on Zomato?
Yeah, I think pretty constructive. I think what helped them was the guidance that even Blinkit will turn positive in first quarter of FY25. If you see, Neeraj, last quarter, which is what led to this surge, the delivery in Blinkit was 27% quarter on quarter. Obviously, that festive season, the coin deliveries, the other stuff which Blinkit was used on, nobody thought of that. And Zomato, the growth was 10% Q and Q. Thirdly, they have really worked on the food contribution margin. It's jumped to more than 7% now. And Blinkit continues to show progress. Remember, they have this almost 3 lakh fleet of own riders, and this can be used to very effectively for tomorrow logistics, or and plus kind of data they have in terms of analyzing how much biryani I have in a week and how much South Indian somebody has in a week, right? So I think a lot of that will happen. Also, the ad monetization on the platform, that's showing some progress. So I think it's all things coming together for them. My only risk is the take rate at 22-23% and ONDC causing any disruption due to that. One thing I noticed, and I don't know if you have noticed, as this could be a Delhi phenomena, that restaurants have started sending pamphlets saying that if you order directly with us, we'll give you more discount. And I think that's something they have to be careful about. These take rates of 23%, and especially the listings, I think that is the only risk in my view, if they can address that.
No, it's a Bombay phenomenon too, by the way.
But
just look at
I
it.
missed what Gurmeet said.
With restaurants saying that order
directly through us.
Yeah. Okay, that is.
You cannot compete with the efficiency. That's the
Maybe
problem.
not.
And the interface, they've tried it before. Restaurants versus
No, more
Zomato,
importantly, I need
on.
choices. I'm not going to Zomato because I know which restaurant I want to go to.
You want
I'm
Zomato
going to
to help
because
you decide.
in that sense. So, Gurmeet, that's a question, right? I mean, sure, restaurants will try to do that and other factors, but Zomato gives you choices.
Absolutely. So that's why I needed the ONDC too small right now. Can it reduce the take rates? Number one. Number two, in my view, is the structural reasons which supporting Zomato is we are cooking less as a nation. The average cooking time is down by 4 hours a week, and it's continued to go down as family becomes nuclear, as both partners work, and the new generation starts living more. We call them experience economy. They want to own less and avail more services.
Not good for health to cook less. Healthier to cook more at home. But I just want to quickly, Gurmeet, get your take on another couple of segments of the market. And you spoke earlier about how elections policy is going to, take uppermost mind space right now for the markets. And two things that have come just yesterday. One is the cabinet clearance on the solar rooftop scheme with a 75,000 crore outlay. You're seeing Borosil react in open trade as well. And the second is the semiconductor play, where obviously CG, because of its own foray, is up. Do you think that these are going to be the big themes to watch out for over the next few weeks?
I think energy overall will be a very big theme. Just look at the way most power companies have done, including PSUs. I think there's still a lot of value in NTPC and Power Grid. We need to add almost 200 gigawatts in the next 3 years to avoid an energy crisis, the way we have electrified and adopted energy, and that itself would probably entail huge demand. So even now the color of the power demand is also got diluted. Nobody's talking of thermal versus clean. NTPC has ordered almost 11 gigawatts of thermal power plants. That's work in progress for them. And there will be some monetization as they list their renewable arm. Very good valuations. Power Grid, again, we probably will see orders worth 2 lakh crores only on transmission lines in the next 4 or 5 years. So there's a lot of visibility there. And there's one leg of re-rating has happened, but they still trade at 14, 15 times. Another leg can happen if they can show execution, catch up with the order. I think that's where markets will get more comfort. Also, the EV charging, the solar panel was so pretty constructive there. I think one part which I want to be a little counter-cyclical is the agrarian and the rural economy. And I think closer to election, that will get a lot of fillip with more transfers, more benefits being given to farmers and the rural economy. So, some of the FMCG names which have not really done too well, except maybe Tata Consumer and Godrej. Some of the, the chemical names, so got to be a little counter-cyclical in my view, some part of the portfolio. Chase momentum, that's fine, but be a little counter-cyclical as well.
Kush, couple of stocks you want to come in on. Suvain, it's up 10% as we see it in trade right now. Borosil is up 6.5% and Dilip Bilcon is also up 3% on back of the order win. How are these three looking on the charts? Any intraday trades here?
So not on Suvain for sure. The stock was actually languishing, below its key averages, and today's just been a spike. Could well be a dead cat bounce. So for me, this is an exit opportunity. If I have any positions on this, I would rather exit. As far as Borosil goes, very similar story here. A slight rebound, but taking resistance at its 200-day moving average. So Borosil is also like a book profit kind of a setup right now. And as far as Dilip Buildcon goes, I think the space is doing well. The stock is a buy on dips for me. So this is one that I would add. So among the three, Dilip Buildcon is the only one that's looking strong. So with a stop loss of about 435, a positional target of 480, and then once that is taken out, 500 plus kind of levels. So Dilip Buildcon is the only one that's really standing out on the chart.
Okay, gentlemen, we'll leave it on that note. Thanks so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time this morning. Have a great weekend. Well, on the note that the markets are not doing all that bad. In fact, we're now trending and trading at the highest point of the day, led no doubt by Hindalco, but some of the others too. We'll take a very quick break, come back with more conversations. The management of Dilip Buildcon, which Kush Bora said looks the best on the charts, joins us on the other side. Stay tuned.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stemmed from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a big...
Welcome back. You're watching India Market Open. The markets are not doing too badly this Friday morning on the first day of the March series and the last day of the week. Well, one stock that's grabbing our attention this morning once again is the Bilcon. It's been fairly active in trade over the last couple of weeks on back of order wins and InvIT. Lots happening with this one. Like we did tell you, the stock's up about 2.5% on back of a 2,000 crore order win this morning. Let's not forget, we've been calling this Dilip Bilcon 2.0. After about over 4 years, we did get a chance to talk to the management of Dilip Bilcon, where we began by asking him about the company's business outlook, the quarter gone by, order wins, and more. So listen into what Rohan had to say as I caught up with him yesterday.
Today, during COVID, we obviously suffered a huge bunch of losses because our business model was around owning our own assets, having our own people, and building all the projects that we were doing on our own. During COVID, obviously, once we had people sitting idly on our sites, but we were still paying them their salaries, our equipment was sitting idle, we were still paying the EMIs. So all of them, caused huge losses to the company. Post which we decided that we need to rethink our business model and we need to kind of focus on being more asset light at the standalone level. So I think that's where the whole thought process started. So one of the things was we wanted to be asset light. Earlier, we used to invest around 500 to 700 crores of money every year in just buying new equipment. And we have a nice big asset bank because of which we are able to function across 20 different states in India. So today, we're doing work in almost 8-9 different sectors, whether it's roads, bridges, tunnels, water supply, dam, irrigation projects, metro projects, airport projects, or mining. And all of these sectors, we do it with our own equipment and our own people. But when we were kind of thinking about, we need to now consolidate our gains. We need to build stronger from where we have. We took a hit on our chin, and now we need to kind of sort of take the next couple of years, we're focusing on our cash flows, reducing our debt. So that was the strategy. So number one, we stopped investing in new equipment or almost only like replacement capex of 50-100 crores every year. Second thing that we did was we wanted to focus on building both short-term cash flows along with that long-term cash flow. For the long-term cash flows, we identified our asset businesses. One was the road asset business, which we had, where we were building these assets and selling them to to funds. And the second was the coal asset business that we had. So we decided that we need to keep some of these in-house and not monetize them as soon as they're completed. So in that regard, we are setting up our own InvIT for the road business along with an investor, Alpha Investments. So overall, that was the kind of strategy that focused on reducing debt, don't do new investments, and focus on finding a mix of long-term cash flows and short-term cash flows.
Wow, so you're obviously making it much sharper and operationally better. Let's start. We'll talk about the InvIT in a minute, but and monetizing those assets and creating the long-term cash flow. But let's talk about guidance. You've managed to do about 7-8% top line growth. Margins are looking also fairly healthy. If we have to look ahead in the next couple of quarters out, what is the sort of revenue guidance could you share with us? And in terms of margins as well, this 12 to 12.5%, 13% is possible, or is there an upside risk on both revenue and margins?
So, in our sector, it would be very unwise to give quarterly guidance, because, when you're doing these large infrastructure projects, whenever we give out guidance, we usually give out guidance in terms of years. So this year we had guided at the start of this financial year, we had said that we will grow about 5 to 7%, and that's where we are kind of going to be at. So about 10,500 crores in terms of top line is what we are targeting. The EBITDA margins, you rightfully said, would be around that 12-13% kind of range that we had also indicated at the start of the year. The biggest thing that we had indicated at the start of the year was that we would reduce our debt from the net debt levels of about 2,300 odd crores or so to, we'll reduce it by 800 to 1,000 crores. In the first 9 months, we've already reduced about 500 crores. And we're very confident that we will reduce it by the numbers that we had indicated. So by the end of the year, we would have a net debt of 1,300 to 1,500 crores. That would translate to a debt EBITDA of 1:1 times and a debt equity of 0.25 times. Now, going forward, the year after, if I were to give you rough estimates, we have only said we will grow around that same 5-7%. We are not chasing growth because growth with our business model came with a lot of capital investments. And because we are now focusing on cash flows, reducing that, so we are not looking at some massive growth. In fact, the growth will come from the bottom line. Now, again, next year, I could say that we are targeting about another 8 or 100 crores of debt reduction. So, which will bring down our debt reduction to, the year end, like when we look at FY26, we should be around, or like when we end FY25 rather, we would be somewhere in the range of 500 to 700 crores of net debt at an 11,000 crores or so of top line with a 12-13% kind of EBITDA that we've indicated. So that I should say would be the broad numbers.
You know, Rohan, I'm very intrigued to ask you because this is a tough business, and to be our aim to be debt free is the goal. The objective itself is noteworthy. You've successfully reduced your debt significantly, like you indicated. Give me a sense of what are you undertaking to improve your debt levels? Have you, I don't know, are you addressing your debtors quicker? Cash flows improved? Are you doing an equity infusion? How have you managed to reduce debt, and how do you plan to do that and come down to being a net debt zero company?
So a bunch of things that we've done, like I said, reducing investments that we are making. So that frees up a bunch of cash, not making investments in equipment. And the equity investments that we have to make for our PPP projects are now kind of tied up with our deal with Alpha. So we are getting a whole bunch of, cash flow from them as well for buying that 26% stake in the InvIT. And also, they're also investing in the company's warrants that we've issued to them. So in total, we've done a deal of about less than 2,000 crores with them. And that capital will keep coming over this year and the next couple of years. So that will be an additional kind of capital that will come and help us in reducing our debt. Then the internal cash flows are also pretty strong. All the different businesses are now doing well. In the last 2-3 years, COVID, like I mentioned, we had cost escalation because of, all those idle costs. And then there was also material costs which went through the roof. So all those things that caused, eventually for us, for our profitability to kind of erode. Now we're not seeing any kind of situation like that. The economic outlook for India, while it seems pretty good, globally the economic outlook is not good. So I don't think there should be a lot of inflation in terms of material pricing as well. So taking some comfort out of there, also because we've diversified our business fairly from different sectors. Earlier, we used to be almost 80-90% in the road business. Today, our road business constitutes only less than 40% of our total revenue. So I think all the different sectors where we have kind of deployed our assets, the cash flows coming from them, and then the cash flows coming from outside are all in total helping us achieve this goal.
Right. So for now, if I've got this right, Alpha Alternatives is invested in 18 road assets. Is that correct, Rohan?
They will eventually invest in 18 road assets. This year, we will put 8 assets into the InvIT. These are the assets that are completed. And over the course of the next 2 years, we're building another 10 more assets. The total AUM of these 18 assets, debt and equity total put together would be somewhere in the range of 13 to 15,000 crores, the eventual valuation. So that would be the initial InvIT size that both of us are going. So about 6,000 crores of equity or so of equity value, where we will be owning 76%. Now, so 2 years down the line, when all of this is complete, when we have all the assets put in, it would give a free cash of 500 crores plus to DBL every year. So that would sort of be a big support to DBL besides its already EPC business.
Right.
So
you're
something.
Yeah. So Rohan, you're clearly not buying any more equipment, like you said, and you're operationally being able to manage this efficiently right now. With that free cash flow that you indicated to us over the next 1 to 2 years, would that money be used for expansion? You've also talked about going into different geographies, reducing concentration risk, and we've heard about the project wins in states like Goa as well. You want to talk to us about that a little bit more, and also what will be the end use of this free cash flow?
So, firstly, in the next 2 years, the most of the free cash flow is going just to reduce the debt, whatever we're having. We're just making it a completely debt-free company at the standalone level. We will continue to take bets and debt on the consolidated basis, obviously, because all the asset business, the debt comes on the consolidated basis and on the SPV, specific SPV level. So we are comfortable doing that. So we'll continue doing. Besides that, we are already in 20 states, and the sectors that I mentioned earlier, we are looking at opportunities in all those sectors. So wherever we find there'll be an opportunity where it'll be a good place to deploy capital, we would definitely do that. I think so. But the next 2 years, most of the capital would kind of go to reduce that besides the equity commitments that we already kind of have.
And what is your order pipeline looking like right now, Rohan? I mean, the biggest story in India right now, elections around the corner, is infrastructure. And the proxy to play the India infrastructure story is through companies like yourself. You want to give me a sense of, you did say that revenue growth is what we are aiming is in that 7 to 8% range. But conversations that are currently underway, order wins, how is that piece looking?
So in an election year, always the ordering is slow. If you look at historically, speaking, all the election years we've seen, a gross dip in ordering. But post-election, it picks up pretty heavily. If I talk about NHI alone has floated about 1.5 lakh crores worth of orders that we are obviously looking at. But most of these would come out post-elections. We'll be pretty prepared for those biddings as well. Besides the road business, there is water, mining, metro, and like I said, all the other different things that we're kind of doing. So all those areas should give a good impetus. And as you also mentioned, that the government is very focused on building infrastructure. So I think they want to make sure that building long-term asset, which is very, very important for a growing country like ours, which has ambitions of the $5 trillion economy. So I think we're very confident that we will see a lot of orders coming in the next financial year as well. And currently, already we have visibility for the next 2 years, 21,000 crores of orders already in hand. And with our current run rate, 2 years of visibility is pretty much sorted.
Right. Very lastly, Rohan, we've talked about Dilip Bilkon 2.0, and you look at those valuations. Clearly, you're an investor favorite in this infrastructure space when compared to your peers. Next leg of growth, right? And I want to understand that. Of course, you're fixing the house. You fixed the house significantly already. Everything's going as planned. The two things that I'd lastly want to know is what keeps you awake at night when you think about Dilip Bilkon's growth, and where will the next leg of growth come from? You've got various verticals, various geographies, but anything else that we don't know and we should know?
So this is a very tough sector to be in, and all the different verticals that we've also gone. It's not a very easy job to build infrastructure in India because it's highly regulated. You have to coordinate with a lot of government agencies. So, the asset that people get to enjoy, they don't realize the pain and the sweat and the blood that goes behind it. It is, the biggest challenge that we also face when we're building any kind of infrastructure is actually managing stakeholders, getting the government to do everything on time. Hopefully, and over the years that has kept on improving. The government agencies have tried to be more coordinated. I can only hope and wish that the central government also takes notice of that and focuses on better coordination amongst all the different agencies so that these infrastructure projects, which usually get delayed a lot, and if you look at the last 20, 30 years of infrastructure project building in India, probably 75% of them have gone over the stipulated time that the government initially envisaged. And eventually it led to cost escalation. So that's, making sure that all the different parts are fitting beautifully. That's what probably is the biggest concern always. Nothing that is specifically keeping me up now. I think COVID was probably that time. But going forward, I think there are so many different levels of growth. I'm not particularly fussed about it. And also, I'm excited about this journey that we have embarked upon, where we are looking at building different asset classes and also building partnerships with, financial partners such as Alpha. So those are the things that I'm currently very excited about. And I think there is, all this transformative journey that we have kind of undertaken should showcase a very different deliberate one in the next 2 years.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one.
The co-founder of Microsoft and the Gates Foundation, Bill Gates, is back in India in an exclusive conversation with the NDTV network. Here's what Bill Gates has to say about India's digital infrastructure, the evolution of AI, and more. Listen in to a slice of his conversation with my colleague Vishnu Shaw.
Well, there's no doubt that being able to register citizens and get government payments to them directly, they don't have to go to a bank branch, nobody's asking for their part of that cash. The pandemic is a wonderful example where actually going to branches wasn't going to work no matter what. And so the amount that's been saved, and now the amount that the government's interacting in a rich way with citizens. For example, I saw in Odisha where they'd registered the farmers and they understood their land and their crops. And so they're sending them a regular bulletin and they're communicating about pests and what you need to do. So this is a case where India's been out in the lead. India did this thing at scale. They made it work, and the Gates Foundation has been involved in some of those projects. We're also involved in helping India show other countries. So right now, there's 15 other countries at various stages of adoption, which a lot of that was kicked off by the way that Modi made that a centerpiece of the G20 meeting.
It's ultimately about empowerment, right? It's not just about efficiency, it's about empowering people, women, young adults. And do you believe that's a model that needs to be replicated elsewhere?
Well, definitely. Paperwork in government and being confused about different policies and, having the powerful people sort of take away the payments that should come to you. These systems are really critical. Even like collecting the GST or understanding what's going on with the population. We'll see it get richer and richer in verticals like health and agriculture. And every time I come to the country, I get updated, whether it's by government groups like in Odisha, entrepreneurs like Nanda Neelankani sit me down and show me what he's seen. And, we're pleased to be a partner both here and in the global quest.
Could you tell us a little bit more about the Odisha visit? I do know that there was a lot that you were shown in terms of hard data backing agricultural growth. What exactly did you see, and how do you feel that that's something that potentially works or does work?
Well, you've got a lot of farmers, and you can never have enough extension workers. I love extension workers. They're very important. We can empower them to be more productive. But this idea, if you have a record of, okay, where is my land? What are the crops that I grow? Take the latest satellite data and see, okay, are they maturing well? Take all the reports of insects or other pests. Look at the weather forecast. The expertise that a big farmer can afford and almost takes for granted, we can now make sure that even the smallholder, is getting the benefits of all this expertise. And so it's digital farming, and it's all about equality.
And since we are talking about digitalization and technology, we are in an era when artificial intelligence is something which affects all of our lives at so many levels. I think the most obvious question to ask you is, there is a huge concern that a lot of jobs would disappear across sectors, and yet artificial intelligence at so many levels is indispensable. So how do we sort of handle this concern?
Well, we're not going to have anytime soon an excess of labor. We can reduce class size, we can take care of old people, we can take care of handicapped kids. If our society is so productive, we can even reduce the work week. But until we meet a lot of these needs, do we have enough doctors? No, we'd like to make them a lot more productive. Individual tutoring is the way to teach kids the best, but without more productivity, it's only affordable for a very narrow group. And so you have to go a long ways at upping productivity before you get to the point where you can say, okay, let's have a shorter work week. But that's a good outcome.
So fewer jobs as a result?
Not anytime soon. I mean, the world has more jobs today than it had 100 years ago. 100 years ago, you had to toil in a backbreaking way just to barely get enough to eat. That was 80% of people were farmers. Now we have these demands, people want manicures, people want time to be entertained, they want a lot of things, and so the advances we've had have made our life a lot richer. We've reduced the work week some, but that hasn't been the primary thing. Primarily, the food we're offered, the entertainment, is just way richer than what our previous generations could even dream of.
Presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth rupees 16,618 crore was sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties since the interim order of the court, which is April 12, 2019, to the Election Commission in 3 weeks by March 6th. The Election Commission will have to publish all these details on its website 1 week after, that is on March 13th, after it has received all the information. Electoral bonds that have not been encashed yet by the political parties will need to be refunded. For more such updates, stay tuned to NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
Or a long-term investment.
all you have to do
Is ask profit.
Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat today, in some sense, is fairly unique because we're talking about 2 or 3 very recent talking points. I mean, effectively, these are indeed the talking points of the session today or of the next few days. And if you just look at any of the things that we're talking about, be it what's happening in the EMS space and the resultant semiconductor push, be it SMIDs likely to be under pressure, it's a question that we're asking because of all the caution that is being thrown around, or be it the possibility of rate cuts at some point of time, bringing in FPI flows as well. Well, to talk about all of that, the perfect guest, Pramod Gubbi of Marcellus Investment Managers. We will no doubt talk to Pramod about some of their pet themes and what their views are on those. But Pramod, thanks so much for taking the time out and speaking to us. Lovely having you as always. Let's start off with whether the GDP print, the global cues, etc., make you sanguine about the prospects of our markets, or are you circumspect because of the valuations being high when one looks at the current year earnings?
Yeah, sure. I think, this is the point that we've been making that on the economy, clearly a lot of things are ticking the boxes. But as history suggests, the economy and the markets don't necessarily have to go together, particularly in the short run. In the long run, of course, economic growth supports corporate earnings, which in turns drives returns in the stock market. But in the short run, they can be fairly disconnected. If you take the next 3 to 5 years, I think the economy is in pretty good shape. There's absolutely no doubt about it. We all have to feel sanguine about it. But from a market standpoint, I think the markets tend to be forward-looking, and therefore there seems to be a lot of pricing in of these positives from a valuation standpoint. Given where we are, I think it's the next leg of growth will come when the promise of the economic growth translates into earnings growth as well. Remember, the last 4 years have been fairly unique in terms of the shape of the economy, given what all we've been through. The disruptions around COVID and lockdown and the massive rally in commodity prices, which put pressure on corporate earnings, and the deflation that's followed. So therefore, we haven't really had a clear period in terms of earnings growth to make a proper assessment of companies' balance sheets and earnings growth. So I think going forward, that will be the trigger. We'll have to fulfill the sort of expectations that the market has in terms of these earnings growth coming through. And corporates have to deliver that to justify the valuations today. Of course, there will always be pockets of mispricing in the market. That's what makes the markets interesting. But at the overall level, I reckon this is a reasonable assessment that the economy is in good shape. The markets are factoring that in. We'll need to see delivery in terms of earnings growth.
Pramod, the missing element for 2023, you could argue, was the participation from foreign institutional investors. Now, it could be an EM factor. And the reason I ask you is not by virtue of the previous hat that you wore, which was managing so many FIIs, but also the fact that you guys currently at Marcellus have a fair degree of global money coming in through your funds. What's your sense? When do FPIs make a comeback? Will it be dependent on China improving its performance and therefore EM as a basket getting money, or is it something else?
Well, I think it's a mix of a few things. The overriding factor has been the reallocation from China to India. That's ongoing. I don't think we've seen the proper beginnings of it. that will continue to play out over the next 3 to 5 years. Because as we speak to allocators, we get a sense that there is clear interest in India as the next big economy to bet on. Many of them have been heavily invested in China, and China hasn't particularly delivered in terms of returns. The policy changes have left them wanting. Now, if you look elsewhere, there are not too many alternatives which match up to China in terms of size as well as the growth dynamics, which is where the interest in India is growing and is in structural in nature, and we haven't seen the beginnings of that. That's perhaps likely to pan out over the next 2-3 years, because it's unlikely that that money will come through emerging market funds, because then exposure to emerging markets would mean that investors would get the same exposure to China. Instead, what we're seeing is people looking at India dedicated managers like ourselves and a whole host of other managers to get exposure to India. To that extent, they're preparing, they're doing the homework on India. At some stage, they will be in a position to press the button. The biggest hindrance to them making that call has been around valuation. Remember, India stands out in terms of its earnings multiple compared to most other emerging markets. It's always been the case. We have always traded at a premium compared to other emerging markets, and more so today. For them to make sense of why this premium exists, and therefore it makes sense to press the button now, it might take some time. In the interim, of course, there will be shorter term flows that might be dependent on interest rates. Although I'm not sure, given the sort of economic data that we're getting from America, particularly in terms of jobs data as well as wage inflation, I'm not sure if the Fed will be rushing to cut rates. There are pockets of the economy which are slowing down. We're also seeing that data in exports of Indian companies. Having said that, it doesn't seem like the situation is so dire that there is a desperate need for a rate cut. But should a rate cut happen, we can expect flows to pick up. But these are not the structural kinds. These could come in quickly and go out quickly as well. But the structural story around reallocation from China to India is the biggest driver we need to watch out for from a 3 to 5 year perspective.
Rate sensitives, Pramod, we talk about that every time with you, maybe because of the Kings of Capital portfolio or otherwise. I'm just tweaking that a little bit because it's pertinent today. Auto sales numbers, the way they've come out, and the way they've come out for the last few months, also how the auto index has fared for the last few years. I mean, it's had a positive return almost every single year since 2020, if you will. The numbers for February thus far as well don't look that disappointing for two-wheelers in particular, maybe for passenger vehicles as well. Now, juxtapose this. Economy buoyed no doubt by tax buoyancy, but 3 quarters in a row, economic print is okay. But the economic-linked CVs or tractors not quite doing well, but passenger vehicles and two-wheelers doing well. How are you looking at the auto pack per se?
Yeah, no, it is a bit of mixed data, even including the GDP print that we saw yesterday. Consumption clearly is not firing, but at least the second derivative seems to be changing, where it seems to have bottomed out. That doesn't tie in with the sort of exuberance that we've seen from consumers in terms of purchase of passenger cars and two-wheelers. There is an element of new launches which drives auto sales as it is, and we're seeing the auto industry, especially the cars and two-wheelers, being in a sweet spot on that front in terms of the launch cycle. That clearly is driving. And also, I think the banking system being flush with capital is also supporting credit-driven purchases, whether it's automobiles or mobile phones and so on. So to that extent, there is support from the supply side, which seems to be offsetting any sort of weakness, because discretionary consumption in general, which is where autos would come in, isn't particularly firing on all fronts. So there is specifics to the auto, especially remember two-wheelers had been through a long period of lull in terms of growth. So there is a little bit of bounce back. Plus, the other supply side factor has been the emergence of electric vehicles or electric scooters, which is again pushing through some of these positives as well. So to that extent, I think it's not that straightforward that we can see sustainability in terms of growth on these fronts. We'll keep our eyes and ears open on this sector. Our play has been around luxury, because clearly one aspect of consumption that has held up has been the high-end spending. So our exposure to two-wheelers has been through iShares, which makes the high-end bikes catering to the more well-off in the country. That's done well for us. But for the rest of the sector, we'll continue to keep our eyes and ears open.
Okay, well, keep eyes and ears open on most counts, really. And for any conversations around how Pramod thinks about the rate sensitives, both lending and non-lending financials, a previous conversation could also be good, because they invest for the slightly longer term and not very short term. We need to take a quick break. What we'll try and do is make the conversation even more relevant to the near and now, talk about some of the most recent developments with a longer term implication perspective with Pramod Gubbi on the other side of this very quick break. Stay tuned.
Presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy along with 16 other district cooperatives formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which...
Back with Talking Point right here on NDTV Profit. We are in conversation with Pramod Gubbi of Marcellus Investment Managers. Quickly run through a piece of news that came in earlier today, or maybe late last night. CG Power signed a joint venture agreement to build and operate an outsourced semiconductor facility in India. In fact, the Indian government has cleared 3 semiconductor facilities in addition to all the work that has already been done. Mihika joins us with the details. Mihika.
Yes, so CG Power, which is a equipment manufacturer, along with Renesas Electronics Corporation, which is a semiconductor solution provider, and Stars Microelectronics, which is a Thailand-based OSAT provider, have come together to for a joint venture. Now, they build and operate an outsourced semiconductor assembly and test facility in India, in Gujarat specifically, and this was approved under the India Semiconductor Scheme yesterday. Now, CG Power will own 92.3% of the joint venture, while Renesas and Stars Microelectronics will own 6.8% and 0.9% respectively. The joint venture plans to invest a total of 7,600 crores over the next 5 years, and it will be financed via a mix of subsidies, equity, and potential bank borrowings, that is, if required. Now, the plan is to set up a manufacturing facility in Gujarat, which will have a capacity of 15 million units per day, and they will, produce legacy packages and advanced packages which will cater to the industrial, consumer, automotive, and 5G sectors together.
Well, thanks a lot for that, Mihika. The stock was active today, and Pramod, it's interesting, that the kind of push that the government is doing on some of the things that relative to maybe some of the other nations who had an earlier head start, we were lagging, but now we're kind of trying to make amends for that. What do you make of this push around semiconductor, the policies, the parks that are being thought of, so on and so forth?
No, I think it's a great initiative, and in some sense, I don't think we have any other option because there is a strategic importance to this sector, given the ubiquity of semiconductors in our lives, whether it's in consumer electronics or defense, there is a strategic reason why we need to become self-sufficient on that. And also from an economy standpoint, given the sort of import bills that we get on our consumer electronics, the consumer goods, there's also another reason why we need to build that capacity in-house. Plus, I think we're due for a big pickup in manufacturing. That's been the case with this government, with a lot of initiatives around pushing manufacturing, both for self-reliance, import substitution, and also job creation. To that extent, getting into something as high-tech as semiconductors fits into that initiative as well. So multiple reasons to do this. It's a phenomenal initiative. It's not easy. I think we need to hold our horses, but given where we are starting from in terms of 28 nanometers, not particularly cutting edge, there's plenty to be done there and where we have the capabilities. But hopefully over the next few decades, we can move up the value chain towards the cutting edge semiconductor manufacturing and become powerhouse in semiconductors globally. But it's a great beginning. I think this is something that the economy and the country needs from a long-term perspective.
Most certainly. Okay. The other thing is, we mentioned about consumers and how consumption is weak, and presumably because of the large competition coming in, paints, Pramod, the last 2-3 months actually have taken a bit of a hit. I was looking at the performance of Asian Paints, the benchmark, right, which you guys probably still have in your portfolio, or maybe you don't, but at least you used to. An underperformance of 18% to the Nifty is not something that we are used to seeing Asian Paints do, because it's been this bedrock of performance all through the last decade and maybe even for the last 2-3 years. There's this wonderful chart that we have about how the multiples of Asian Paints have gone through the roof since 2012. And suddenly, Pramod, we find Asian Paints is available at valuations that it last traded at back in 2014. Now, my question to you is, are these concerns overdone, or is it fair to be concerned considering that the paint sector hasn't seen a deep-pocketed, large manufacturing competitor come in a really long time?
Yeah, I don't think there are easy answers. I think the two extremes are easy to bear with, that new competition will come in and disrupt the whole thing, nor is it fair to say that, look, Asian Paints has successfully faced competition throughout its history and will be able to overcome this easily? Truth, like always, lies in the middle, and that's what makes our jobs easier to figure out. On balance, where does this lie? It's not true that there hasn't been a competitor of this nature. Remember, Sherwin-Williams, the world's largest paints company, came to India and couldn't compete for whatever reason, left the country. This has always been the case, and this will always be the case. If you want to invest in businesses which make lots of profits, you'll have to be prepared to face competitive entry. Remember, that profit pool itself is a magnet for competition. Nobody would like to enter an industry where the incumbent doesn't make money. So in some ways, the continuous entry of new competition in this sector is testament to the attractiveness of this industry. And the fact that the incumbents have managed to hold fort, not just hold their market share, but also increase market share over time, also indicates a presence of entry barriers. Why have some of the world's best paints companies struggled to compete in India? This suggests there are certain moats or sustainable competitive advantages. And from our assessment, a lot of the moats lie on the supply side, supply chain rather, where it is a hard product to distribute across the country with so many SKUs. So you need plenty of data to drive efficiencies in the supply chain, which in turn are passed on to the dealers. The dealer economics become far more attractive, and that's what the incumbents have done to hold fort over the many decades that they've operated. Having said that, never say never. The next big competitor could have tricks up the sleeve, which are very different from those who tried to play this in the past. Our job is to keep our eyes open and see what those initiatives are, whether they actually threaten the dominance of the incumbents from the past, or will they continue to face challenges like the competitors of the past have done. The market seems to be suggesting that indeed this will be a tough ask to defend. Having said that, the market could also simply be saying that, look, unless we figure where this settles, would rather stay out of it, which is why you're seeing this play out closer to the launch or the entry of the new competitor, while the news was out for a couple of years now. In fact, the stock hadn't gone anywhere, but the correction has been much sharper in the last few weeks around the launch time. Our job is to act on data and evidence rather than anticipation. Like I said, it's easier to take the extreme stance and say that, look, we're not really concerned about it. Our job is to be concerned and watch it. But at the same time, we can't simply say that the competitor has come in, so let's get out of it. We'll need to make a more objective assessment of the situation.
Just wondering, Pramod, 60-second answer because we're out of time. But do you fear multiples, margins, and ROCs for Asian Paints and the Bergers, etc., coming under pressure?
Yeah, in the shorter term, yes, obviously, you've seen the actions from these players already, right? They've already started cutting prices. But to the extent they've already preempted some of these, they have invested in backward integration by bringing in manufacturing in some of their supply inputs in fold, which adds a few percentage of the margins, which becomes a little bit of an armor for them to cut prices without compromising on the margins. But having said that, I don't think we should expect status quo. A competitor of this size, a capacity addition of this size should definitely have some impact on ROCs and margins in the short run. But the longer term trajectory depends on how the incumbents react. Like I said, I've shared one of the strategies in their arsenal, which is backward integration. Some of them invested in new growth lines, which could offset some of the loss of market share or ROCs and margins crunching.
Right.
Therefore, longer term, we still remain quite positive.
Got it. Pramod Gubbi, so good talking to you. Thanks for taking the time out and being with us on the show today. Really appreciate your time. And viewers,
thanks for having me.
Out of
Pleasure.
time completely on this leg of the talking point. Thanks so much for tuning in.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the strategy.
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
join us as we put the spotlight on 6 stocks.
On your show, Hot Money.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
or a long-term investment,
all you have to do
is ask Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
welcome. You're watching NDTV Profit. We have with us a very special guest on a special edition of dissecting those GDP numbers and what it means for D Street. Manish Dangi, macro investor and advisor, now joins in. Manish, good morning. Thank you very much for joining us. Manish, lots of you and cry. We all got very excited last evening when we saw those GDP readings. But my very pointed and direct question to you is, these numbers are backward looking. What does it mean for the markets?
No, first of all, the numbers are sort of super good, right? You know, it's generation has been lost and forgetting the dream that we could get to 8% plus number. It's been 3 quarters of 8% plus growth in India. So at least, you know, those hopes are actually being revived and being relived, so to say. Markets, of course, as you said, sort of perfectly, that, you know, GDP numbers are backward looking. Some of the math which has gone into lifting the GDP is even more backward looking. So because of the taxes buoyancy, you know, GDP growth was sort of much faster than the GVA growth. Of course, there's a bit of a base effect kicking in there. So, but underlying GVA growth, of course, is only 6.5%. And as a matter of fact, you know, we knew when we were living October, November, December, there's something sort of seriously, sort of very strong going on in the country then, in the economy, so to say. As we speak, you know, some data incrementally is actually looking at a sort of slight bit of softening. Markets would actually not bother much about all of this as long as earnings are intact. And even this quarter's earnings have been sort of fairly decent. Small disappointment here and there, but otherwise fairly decent. So to that extent, as long as markets, as long as, you know, earnings actually are strong and steady, I mean, markets would rejoice this big macro data, but actually it's not that relevant from a market standpoint.
I'm so glad you said that, because while, you know, we all hope that this would draw the recovery and things would look great, I mean, I think best case it does it just justifies those valuations, may not provide an impetus for the next leg up. But we've also got with us Manpreet Gill of, you know, Standard Chartered, CIO for Africa, Middle East and Europe for the MENA region, joining in. Manpreet, good morning, or rather good morning actually. It's you're behind us in time. How do you feel? I know Manish did say that these numbers were breathtaking, but the impact of it on the market, I would also imagine, would be limited, given that these are backward-looking numbers for whatever it's worth.
Hi, good morning. No, you're right. I think the thing with GDP numbers is that they are backward-looking, and I think Manish made that point well. But I think the point here is they do help with the broader picture, right? Because when we talk about earnings growth as being one important factor that needs to come through to support where valuations are, GDP growth, of course, is one of the starting points. So it's not a perfect correlation, but it does help set a positive context. And I think what is more interesting is that we got a positive surprise relative to expectations. I think from a market perspective, I'd be more focused on that as opposed to the absolute level itself. But I think from a market perspective, it's still going to be a question of, you know, just how much does that feed through to earnings growth, because that, of course, will be the key positive. For us, directionally, we still think equities have room to outperform bonds particularly. But I think, obviously, the only thing holding us back from being more constructive is just that balance of, okay, how much optimism might be priced into the market already versus how much room for upside surprises we still have.
Yeah, I think it's lack of triggers and cues as well. That's what we might struggle with in the next couple of months. Manish, let's start with breaking this down sector-wise. Manufacturing consumption did really well. And I'll start with that. Do you think keeping that as your backdrop, infrastructure continues and should be the big bet for investors? And also ancillary to construction, right? So not just your real estate, but sectors like cement. Are these spaces that could continue to see growth for companies and hence better returns for investors?
I'll take a step back. Basically, if you see, manufacturing is generally a global manufacturing cycle proxy, and given what's happening to PMIs pretty much across the world, even last night's US PMI, the manufacturing PMI was actually below 50. So basically, it's likely that so far industry, which has done super well in India, if global manufacturing cycle were to have an effect on India, you know, that would mean deceleration there. Infrastructure is mostly a government proxy in India because large part of infra spend actually is done by central and state government, which actually has been growing very at a rock solid 25-30% CAGR rate for last 3-4 years. But incrementally, of course, in this budget, we know that this is decelerating. And finally, on the consumption, it's a personal disposable income proxy. And that part actually, if you see, the only disappointing piece in the entire GDP is the consumption growth, which is just 3.5%, personal consumption growth, that is. And so if at all sort of we are projecting future, and if you think that incrementally the rest of the world is not going to pulling us up, and of course, manufacturing cycle is slowing, and at margin, government is actually not on the spending binge, we'll have to rely on household finances and household spending. So that part actually may depress incrementally. So since, again, tying it with the first question that you said, what is in it for us? As far as future is concerned, the household sort of conditions is not as great. And incrementally, that may mean that, there could be some deceleration. Just sort of wanted to sort of highlight that.
Fair point. And please, I'll take a cue from that and ask you as well. Now, let's break it down. I know agriculture, economy is a concern. We've constantly, and I think Manish and me talked about this as well during the budget, where rural consumption is just not budging, right? How do you play that sector? Do you think this could still turn out to be the dark horse of calendar year 2024? Stocks like Dabur, Amarico, Godrej Consumers, ITC, HUL, good time to buy them, add them on hoping that consumption will come out, and if not now, but maybe a quarter down the line? Or too early?
Well, I think from a consumption perspective, I think it's one of those examples of where we need to be careful about how we extrapolate, the link between GDP data and actual consumption feeding through to earnings expectations from a listed market perspective, because sometimes the listed market does have a narrow perspective than the broader economy, right? Now, to some extent, yes, I think, having a broader base on consumption is important. I think we've seen more at the, large cap companies benefiting. We've seen, specific sectors benefiting more so. So I think that challenge will remain from a broader macro perspective, particularly when you think, agriculture, broad-based consumption, as you just described. But actually, when you think from a narrower equity market sector perspective, we'd still be reasonably constructive. At the end of the day, what we're asking ourselves is that consumption at an aggregate level sufficient to help from a consumer sort of spending feeding through to earnings perspective? And I think from a sector perspective, we do think that's sufficient. And is that likely to drive enough stock gains to outperform bonds or other major asset classes, bonds and cash? So I think there's a difference between, obviously, we'd all like it to be stronger, but we do think when you feed through and take a narrower view from an equity market perspective, is that sufficient? Or from a narrower consumer discretionary sector perspective, we actually think that, the outlook is sufficiently positive to still warrant an overweight on equities on those sectors, without getting into individual companies. So that's at the end of the day why we'd still hold the overweight, from an equities perspective and that sector relative to bonds and cash.
Manpreet, yes. Manish, talking about rural and agriculture, how are you approaching the auto stocks? Now, tractor sales has been a sore point for a very long time, and it may continue to remain sore going into the next few quarters, very obviously from the GDP number, the factors that went into that. Do you feel like this will remain a drag, and companies with an overexposure or a larger market size in the tractor vehicles are better off avoided for now?
Again, tying it with GDP, look at the numbers and you realize that, agri is doing sort of very badly. Also, tying it with the general business cycle dynamic for last 3-4 years during the COVID, urban sector did really well. Anything to do with luxury, urban wealth did very well, and rural did not, staples did not. I think of things markets as sort of cyclical. A lot of policy adjustments do happen when one part of the economy does not do too well. So I guess government also recognizes this. I think at margin, it's a fairer bet to make that it's two-wheelers would likely to do better than cars, or general staples would do better than discretionary. I'm talking of it vis-a-vis the general expectations in the market. So if you are actually doing a 3-year, you have a 3-year betting cycle, so to say, then it's better to bet on rural because underlying momentum as well as what has happened over the last 3.5 years has been pretty bad. And to that extent, I assume that there would be a decent policy reflex in play in next 1.5 year to ensure that rural economy get resuscitated. And so I would say that I would agree that very likely that proxies to the rural economy, the lower end of the consumption would likely to do better in India than the higher end of the consumption.
So you actually do think this is going to be the dark horse? Fair point, because it has to eventually play catch up. It's only a matter of when now, not whether or not it will. Manpreet, you alluded to a lot of the debt conversation in equities. All I want to understand from you is, after you saw that reading last evening that came out from India, did you go back to the drawing room and make any adjustments to your portfolio, or you've avoided that for now?
No, we've avoided that for now because we believe that we're already well positioned for the kind of data that we witnessed, and I think that applies at a couple of different perspectives we take. Right, one is of course do we own more equities or debt? We've always been of the view that equities outperform, but actually bonds still hold a reasonable allocation in diversified portfolios, not only because of where yields are, but also because we think there's room for those to fall. But that's where actually the global perspective does become important, right? Which is an equally important factor into our model sort of allocations, because whether you look at equity indices or indeed bond, domestic factors are of course important, and I said the positive surprise of course is the key factor here, but there is still a strong influence from some of the global markets. The correlation between equity indices and bond yields in India with those in the US, for example, is still surprisingly high. And we think that, of course, can be another tailwind that sort of feeds into the positive surprises we've seen, recently. I think the key one to watch, if I can just, add to that, and part of what we're watching in terms of future changes, of course, is the correlation, especially with Indian markets. Domestic factors, of course, are positive, but Indian markets, especially relative to North Asian equity markets, because I think from a foreign investor flow, that has been one big tailwind. We've seen, obviously, a divergence between Indian equity indices and North Asian, equity indices. But I think there's room, of course, for that to potentially extend. Especially in North Asian indices, we see momentum begin to pick up again. So that may be one potential trigger. But for now, we're quite happy with our current positioning, particularly being, still believing equity markets have further gains ahead of us.
You are still overweight India and Indian equities, Manpreet?
From a onshore perspective, yes. I think when we think sort of equities versus our options versus bonds and cash, I think from a regional perspective, though, we have been neutral and continue to be neutral relative to Asia ex-Japan. And I think some of that comes back to some of the other options on the table, because not that we're not constructive. I think we've discussed, obviously, the earnings side. Recent gains have been strong, and we think there's room for those, of course, to continue. I think the challenge is really saying, are we paying an attractive price for that positive growth earnings outlook, or are we potentially overpaying a little bit? So the valuation is the only factor that holds us back from being more constructive or overweight from a regional perspective. And the contrast is particularly with Chinese equities, where, of course, much more uncertainty with the growth outlook, but we're paying a much more inexpensive price. So for us, it's a balance between the outlook and the price we pay.
Right. Manish, one last question, and a penny for your thoughts, because it would be unfair to my viewers if I don't ask them for three sectors that you're big on. You've talked about rural consumption and a proxy to that for the 3-year perspective. Two more smaller sectors. Stocks would be great. I know you're not going to give it to me, but I'll still attempt. Or just, sectors that you think you're constructive on after what we've seen on the macro picture as well.
So two sectors that I think, I have a divergent view now relative to markets. One, of course, I've been extremely constructive on tech, but at margin, I guess valuations do not justify the at least the near-term cyclical slowdown that we see now. So both US, where I've been sort of super long on, but also India, I guess it's time to actually taper that risk. Second, of course, is in the financing. I've argued with you all many times that many other conditions which were actually driving earning growth momentum in financials. There again, I think from a credit condition as well as liquidity condition and regulatory restriction standpoint, you have sort of at margin obstacles coming in. So in general, in markets, especially in large caps, you would find it difficult that market in aggregate beat what you would get in generally bonds. So if you buy a 10-year bond at 7.15 today, and I think that at some point in time in next 2 years it would get to 6, you will get about 10-11% returns. I think the broader market returns also would be closer there. So to that extent, the equity risk premium that you ought to earn in equity is not going to be available. So that's my more sort of asset allocation level decisioning.
Right. Manish, Manpreet, thank you very much, gentlemen, for joining us. It was great to chat with both of you. I think the short of it is, while the number was heartening and was definitely a feel-good, it may not have too much in terms of giving us direction on the road ahead for equity markets and investors. Thank you. We'll hopefully see you both soon. With that, we'll take a quick break. On the other side, it's F&O show, so stay with us.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth rupees 16,618 crore were sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties.
Hello and welcome. This is the F&O show. I'm Agam Vakil and we take you through all that's happening in the futures and options space in Indian equities. A quick look at how markets are faring, and it certainly is a very positive start to this month of March. Well, we are looking at advances for the Nifty and the Bank Nifty, and well, good advances too, about 1% higher for both these indices. So, traders are going to take it with both hands, and investors too, of course. But what's contributing to these gains? So we're going to take a look at the contributors for the Nifty and what is in fact propelling this index higher back to the mark towards 22,200. That's the stiff resistance, isn't it? But let's pull up the constituents of the Nifty and see where we are in fact seeing that push higher. And what is it, if at all, which is pulling the constituents downwards as well? That should come up for you in just a moment. But besides that, well, we do have a whole lot of companies out there. Okay, so there you have it. That's what I was looking for. We do have ICICI Bank, L&T and Reliance Industries along with HDFC Bank finally contributing to that up move, even though it's not the biggest contributor. But a contribution all the same towards the positive is a good thing. And of course, Infi, HCL Technologies, among others, are perhaps weighing on the indices, but just marginally so. Today is clearly the day where we are seeing advances, and a lot of investors will perhaps heave a sigh of relief. Not as much volatility seen yet in today's day of trade, and perhaps also because we don't have any major NSE-based expiries today. It was quite a ride yesterday, at least on an intraday basis. But very quickly, taking a look at how things are faring in the futures and options space. In the Nifty future specifically, we continue to see a slight addition in OI, even as the index advances by around 1%. The Bank Nifty, the picture is more or less the same. Though not too much, in fact, not at all any increase in open interest, but the underlying is up around 1.1%. In terms of the options market, just the distribution, in terms of distribution, this is of course a change, but let's look at your overall distribution and see where there is max OI. And there continues to be max OI around higher levels, say to the north of around 22, 200, 300, 400, etc. And on the lower end, while we do have a lot of accumulation around 22,000 in terms of puts, there will still be substantial amounts added around 21,900 and 800 as well. So we'll be watching out for these levels as we move through the course of the next week, which also promises to be an exciting one, if not a volatile one. To understand what we can do with these indices going forward, let's get in our experts for today. We have Aditya Agarwal as well as Brijesh L, who's joining us on the show. Good morning to both of you. Thanks for joining in. Aditya, start with you. Your view on the indices. How would you navigate this upcoming week?
Good morning, Agam. Thanks for having the show. It's becoming very difficult, to be very honest, trading the index, because till a day before yesterday, you had a massive breakdown on the index. It looked like the hell will break loose. Markets will break 21,800. We're heading to 21,600. And come to today, Friday, and you're back to 22,200. So overall, if I take a look at a broader picture, markets are trading in that range between 22,200 to about 22,300 on the upside. On the downside, 21,800 to about 21,700 is the immediate support level for the market. My sense is heading into the next week, markets will continue to remain in this range, while you will have pockets of outperformances. So, Bhagam, what we are seeing is there is sector rotation which takes place every week now. So it could be the autos which participate 1 week, then the next week it could be banks, the following week it could be cement. So that is what we are looking at this current juncture. And I guess this will continue to take place till the time we head into elections. I don't see markets moving too much in either direction. Yes, there will be volatility, but the volatility will be bound within this range, at least for this next month or this month, current month, if I say so. So 22,300 on the upside, 21,800, 700. The downside is the range that I'm playing with. Bank Nifty is something that continues to outperform now and then. And then again, 47,500 is the hurdle for the Bank Nifty. On the downside, 45,500 is the immediate support for the day. If Bank Nifty maintains its neck above 46,700, then there's a case for a further short covering rally to play out, at least at levels of 47,800 to about 47,700 on the upside.
Okay, Brijesh, morning to you as well. Your view on the benchmarks?
Yeah, morning. So to be very precise, I believe we are going to see positive momentum. It's very clear that we are not breaking 22,000. Having said this, we always believe that there can be some corrections in the market, and Nifty may go back to 21,500, 21,600. But lately, whatever the trades, what we can see in the last couple of days, this level of 22,000 has been protected. And yesterday, the way the market recovered from the day's low and almost closed at 22,200 mark. So 22,000 mark. So I believe today's the extension of that particular move, and this momentum is likely to stay. I believe we should be heading for 22,500. So that would be the directional view for the Nifty. Even a lot of put writers are seen at 22,000. So I think that is going to act as a support, not very easily that will be broken. I'll play a long bet, and I'm closely watching the Bank Nifty, 47,000 strike price. Right. And if you see the option chain, the strike prices above the 47 on the call side. Sure. There are a lot of positions are getting unwinded. So right. There is a high probability that Bank Nifty might break 47,000. So okay. I think we should be taking a positive view, and I'm positive on the market.
Okay. Gentlemen, we just have a couple more minutes. So I'm going to quickly come through you on your trading ideas. Aditya, what are you tracking?
The first, so I'm going with two buy recommendations, Agam. The first is from the banking space because clearly there are outperformances there. ICICI Bank is looking very interesting. It's breaking into an all-time high territory. I'll go with a long trade on ICICI Bank for a target of 1120 on the upside with a stop loss at 1045 on the downside. The second stock recommendation is Dixon Technologies. Again, of course, stock continues to make higher highs, higher lows despite all the negative news flows. So a buy at current levels for a target of 7300 with a stop loss at 6650 on the downside.
All right, and Brijesh, your trading ideas for today?
Yeah, my first would be the BHEL. There's a good amount of buying what is seen in yesterday's session, and today the stock has picked up the momentum. I think this is going to stay for the next couple of days. The buy at the current price, stop loss would be 230 for the target of 248. So that would be the one level to keep a watch on. And secondly, today the metal space has started to move, and I believe SAIL, Steel Authority of India, that is one pick where I think once it starts trading about 130, I think there is the short covering will be seen in the SAIL. So that should easily take SAIL of 5-6 points on the higher side. So with the stop loss of 124, I will be taking a view for 138, 139 on the higher side. Okay. And one more stock which I'm liking is McDowell. So again, that is a trading back. So at current price 1176, it looks quite promising for the target of 1245.46 with a stop loss of 1150.
All right. Well, we are completely out of time on this particular truncated show. Well, on the note, taking a moment to thank both Aditya and Brijesh for joining us and taking us through their views in the markets. And with that, it's a wrap on the F&O show. But lots more lined up on the other side. Stay tuned.
Presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included.
welcome. You're watching the Small and Mid Cap Show. I am Mahima Vachrajani and with me is Harsh Saita. Well, before we move on to our guests for today, let's take a quick check at how the markets are panning out to be. Well, if you talk about the Nifty 50, well, Nifty is up around 0.9%. The top contributors to the Nifty 50 include Tata Steel, JSW Steel and BPCL and Hindalco, of course. And the top laggards for the Nifty 50 include Cipla, HCL Tech and Apollo Hospitals. Well, to take a quick check on how the broader markets are panning out to be, we have Harsh with us. Harsh, how are the broader markets doing?
Well, yes. So, Mahima, let's quickly pull up the Nifty mid-cap if we can. The mid-cap and the small-cap indices largely trading lower than where the Nifty 50 is trading at. In terms of the mid-cap index, I also want to quickly flag off the advance decline, strongly in favor of the advances overall within the Nifty mid-cap, and even overall, if you're looking at the advance decline ratio, not bad at all, completely in favor of the advances. In terms of some specific names, CG Power up 6% within the Nifty mid-cap, SAIL, Oil India are some of the gainers, up anything between 6 to around 6.5% in trade today. Max Health, Policy Bazaar, Voltus are the key drags on the Nifty mid-cap. Well, the small cap too, largely following similar trends, 70-30 in terms of advance decline on the Nifty small cap 100. You have Metropolis, LG and JK Lakshmi, top gainers on the small cap, while Jyoti Labs, Amber and Suzlon are some of the names which are in the decline, the top decliners on the Nifty small cap. Quickly on to some specific names before I move on. Biocon down around 1.3%. You have Vedanta absolutely flat, but Suven Pharma, that one's making the waves, 8% higher in trade. Dilip Buildcon around 5% higher as well on the back, all of this on the back of news. MOIL also up roughly 4%. MOIL and Wellspun Enterprises, can't take your eyes off this one either, 3.5% higher on Wellspun. 4,000 crore order win on a 4,000 crore market cap, difficult to ignore for Wellspun Enterprises. But, you know, we have another stock in focus today, Rashi Peripherals, among the leading national distributors in terms of global tech brands in India. For information communication technology, we have with us Kapil Pansari, who's the MD, and Rajesh Goenka, who's the CEO of the company. They're with us to speak to us about the quarterly numbers which have come out, and they're recently listed as well. So we'll try and break down on what we can expect going forward on this one. Kapil, let me come to you first. You know, talk to us about what exactly has happened in this quarter, because we've seen growth in terms of your top line, but your EBITDA on a console level was largely tepid, and your profit after tax has actually declined on a year-on-year basis. So talk us through what has happened here.
So one thing I would like to mention that in Q3, we've grown by about 21%. Largely, this growth has come on account of robust demand of the PC industry. In year 21-22, the PC market and the growth rates were much higher due to work from home and learn from home demand. And immediately after post-COVID, when the markets opened up, obviously there was some correction in the market. In 2022-23 year, after that correction, this year, from the first half of the year, the markets have started coming back on track. And as a result, in Q3, you see a strong growth for the organization, clocked at 21%. On the EBITDA and the PAT front, it's a little lower, but for us, it is business as usual, because one of our subsidiaries, which is into cloud distribution business, we've taken some impairment, and which is the nature and the cycle of the business, due to which this occurs during Q3 of the month.
Right. Mahima this side, Kapil and Rajesh. Well, my question to you, since you mentioned the PC, the guidance on PC, well, my question to you is that we've seen that there is a fall in share of Lenovo, and there's a rise in share of Samsung in terms of revenue. Well, is this maintainable, or is this expected to change?
Yeah, so specifically the PC demand, as Kapil also mentioned, in 22 and 23 went down. So therefore, you will see that in Lenovo, mainly we do PC, desktops, laptops, and servers. So overall demand was lower, therefore the share has gone down. Whereas Samsung, we are predominantly into tablets. And tablet demand is very high, not only into enterprise, but also in the government. So therefore, you see Samsung business little bit going up. But going forward now, as we said, that business is as usual, all categories now are firing. So both these categories also will continue to grow the same way.
Sure. Mr. Pansari, let me come back to you. So you've spoken about probably a one-off which is impacting this quarter's numbers. If I remove the one-off, what's the kind of number like? Would I look at a more normalized kind of a growth trajectory, which is, if I'm looking at Q3 revenue growth of 21%, would therefore EBITDA also have expanded by a similar quantum?
Yeah. So to give you a perspective about the business as usual, if you look at the standalone numbers that we've reported, the revenue has grown by about 17% in quarter three. And if you look at our EBITDA and PAT numbers, they've also grown similarly at 21% and 13.6% respectively.
Right. Also, so your ROC is maintained at 21%. I mean, sorry, ROE is maintained at 21% and ROCE is maintained at 15%. Where do you see this going in FY25? Will this stay in the same range, or do you expect to see a rise in this?
So IT distribution business is a very matured industry and distribution business where the margins are structured and the businesses have a very fine defined range of margins and earning potential. This is the range that is expected to remain similar in this particular trajectory and will continue to perform in similar manner.
Sure. And, with regard to your working capital days, working capital cycle, if I'm looking at the last maybe 4-5 years trend, it seems that working capital days, inventory cycle is getting a little stretched. Do you feel that we're coming off a low base? Is that what's happening? And where should we therefore normalize at?
Yeah, so definitely this is something that is not very ideal for us. We typically want to maintain an average inventory cycle between 50 to 55 days, which takes care of our growth potential. Ideal range, if you ask us, should be at about 45 to 50 days. And we are actively working on to maintain that. But that also means that we are reducing our inventory and growth potential. What happens is when we buy the goods, the nature of the business is we buy on credit, we hold inventory, and we sell on credit. So therefore, when we buy the goods, the growth factoring, the forward-looking projections on the sales, we buy the goods today in the previous quarter and the months. Therefore, you will always see a higher cycle of inventory. Probably if the growth is not there, this will obviously get corrected and we'll actively work towards doing the corrections.
Right. Also, in Q3, around 63 warehouses were added. Can you give us a guidance as to where these warehouses will go in terms of FY25? And will this, since warehouses will increase, your inventory will also increase. So how will this affect your working capital cycle?
So I want to clarify, these 63 warehouses are as on Q3. In last 2 quarters, there has not been any addition of warehousing. So for us, the inventory and everything remains the same. But the good thing is, out of these 63 warehouses which are present in 50 cities of India, we are able to deliver goods to about 8,400 customers in 680 towns of India. So while progressively, if there is a need, we may add warehouses, but currently we think that since we are able to cater to 680 towns already from these 62 warehouses, they look to be good enough at this moment.
Sure. And Mr. Pansari, with regard to your top line, what's the kind of internal targets that you have in terms of growth? Are you expecting growth to come in a bigger fashion going forward? Because again, last couple of years has been flattish of sorts.
Yeah, so I'll just give you the perspective. So FY21, we grew by about 55%. FY22, we grew by about 53%. And FY23, which was the post-COVID year, where normalization, everything happened, and the market degrew by about more than 20%, but we were flattish. So that is the past. Now the story of FY24 is that 9 months to 9 months, we have a 12% growth. But very importantly, Q3 to Q3, we have a 21% growth. So I think that is the trajectory that is for us to see. And now the IPO money also has trickled in just about 10 days back. So we are hopeful for a good, positive, consistent growth.
Yeah, so before I come on that IPO funds that you've come through, now talk to us about where the potential lies. You're probably increasing touch points, more distributorship that you're increasing. So where can I look at your top line now going forward? Is it a 20% growth that should reasonably be expected over the next 3 years?
So our strategies are very simple. One is we continue to get deeper into the country. So more customers, more coverage of city. So we call it as a deep strategy. The second is we continue to slowly add more brands in our portfolio, which gives us additional business opportunity. So in last few months, we have added ViewSonic and Anydex, 2 brands that we have added. Third is we keep on adding new product portfolios from our existing brands. So a recent story is we have added Samsung gaming monitors. We have added Google Pixel watches. So these are the new products. So deeper penetration within the brands, existing brands, we do more products and add some new brands. All 3 put together has enabled us to get a consistent growth of almost 20% for last 20 years, and we are hopeful to maintain the same.
And even post this capital infusion, would you continue to maintain your 15% ROE that you've done? Is that something like now a base of sorts, and what's the upside from here therefore?
So there are 2 perspectives on this one. The ROE definitely for the short term, because there's a capital infusion, will drop from our currently about 19 to 20% that we have, will drop because the base of capital is increasing. But over time, this business will continue to have a range of between 15 to 20% ROE, ROCE. The growth that we expect out of this capital infusion, the way it works is that we are a working capital driven organization. I mentioned earlier, we buy goods on credit, we hold inventory and we sell on credit. This translates to a net working capital cycle. So whatever capital that we've raised, the amount of turns that we are able to churn out of the capital deployed is the function of the growth that we are expecting in the next couple of years. So right now, the IPO money has just come in about 2 weeks back. So for us, the work really starts now to push the gear and take it forward.
Absolutely.
Right. So Mr. Kapil and Mr. Rajesh, thank you so much for speaking with us at NDTV Profit. It was a pleasure talking to you. Well, before we move on to our next guest, let's slip on to a quick break. See you at the next end.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the spurge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a
Welcome back. You're watching the Small and Mid Cap Show. I'm Mahima Vachrajani. Well, Apollo Microsystems is in focus. The company recently bagged an order of 25 crores and this is from IOCL and multiple orders from the Defense Ministry as well. In Q3 FY24, the company posted a good set of numbers and an investment, R&D investment of approximately 7 to 8% of the revenues. Well, the company is planning to establish a new subsidiary as well and a lot more in focus. We have with us Mr. Adepalli Krishnan Sai Kumar, the whole-time director, who joins us now. Welcome to the show, sir.
Thank you. Good morning.
Good morning, sir. So, sir, my first question to you would be that a lot on the plate, good set of numbers, but where does your order book currently stand at, and what is the mix for this order book?
We have a decent order book as the Q4 closure is going by. As we have given a guidance earlier that we would exceed the previous year, figures both in the top and the bottom line, and we also have, as the day stands, we have order book to meet the similar, say top line levels for the next financial year as well.
Sure, sir. So where should it stand in all net? Because your order book takes care of next year's numbers, but you're definitely looking at growing faster because you're a very small company and the scope is very large.
As the day stands, the total order book should stand close to around 400 crores.
Okay, and okay.
And execution, sir, and execution, how quickly will that get executed and what's the order pipeline looking like? Next 2 months, what's the kind of order traction that you're looking for?
We gave a guidance that we would do around 35 to 40% in excess of last financial year. And the same trend would continue for the next financial year. Probably we should be closing somewhere close to around 600 crores in the next financial year. And we have sufficient pipeline for the next financial year along with the existing order book.
Right, sir. Also, in terms of your new plant that is coming up, what is the capacity levels of that plant, first thing, and what will be the revenue contribution that you're expecting out of this?
The plant, the upcoming plant is not measured by the capacity or the capacity utilization. The number of programs that are going in for production are growing continuously, for which a larger plant is required for the programs to be executed in a much faster way. So the present facility, what we are having all the design and production facilities all in one place. So we are bifurcating this to be a dedicated design center, and the entire production facility we are moving to a new facility where we'll employ another 400 employees there. Which will cater not only to the subsystems that we are presently manufacturing, but also at a complete weapon manufacturing facility we are building up. That's how the facilities. So it's not about the capacity utilization; it's about the vision that we have to reach 1,000 crore top line. And this facility, the upcoming facility, is to actually meet that kind of projections that we have.
How quickly do you get to 1,000 crore?
Before Corona, we have aimed for 2025 to reach, but I think we may slip by a year.
Got it. And will that also include some amount of product diversification as you go around towards the 1,000 crore mark? And how will your product mix therefore evolve?
There's a lot of product diversification. We are transitioning ourselves from a tier 2 supplier, a subsystem and system supplier, to a complete tier 1 OEM supplying complete weapon. To the extent, the last couple of years, we have developed 3 different variants of weapons and sea mines, and which we are doing an extensive marketing internationally. We are also likely to be, chosen as one of the DCPP partners for some of the heavyweight torpedoes, for which we are looking forward for both domestic as well as international markets, complete as a weapon.
Right, so since you mentioned diversification, you're establishing a new subsidiary, Apollo Defense Industries. Where you've mentioned that this might signal a potential diversification. Does this mean that this will only be in terms of defense, or do you plan to foray into something else?
Both defense and space as well. The primary aim to float this subsidiary companies is to make international ties. We want to work in a collaborative mode with various international companies who would like to do a joint ventures. It would be convenient to do with a private limited company, so we have floated this company as a subsidiary for its parent company, Apollo Microsystems. In fact, we are talking to that extent with the 3 different companies, and you will soon get to hear the news that we would be acquiring few companies down the line in next 1 quarter.
So what is the kind of number you're looking at in terms of acquisition? How large is the size that you're looking for in terms of acquisitions?
Ticket size could be as small as 10 crores up to 150 crores.
Understood. And margin accretive?
So this includes both startup companies as well as matured companies who are looking for growth and who has good technology as well, both domestic as well as international. We are also looking to acquire some technologies overseas, who would like to do a licensed production in India as a make in India, and also for the global markets.
And your current margins, 20% plus, maintainable post all of these acquisitions, and even your ROC numbers, etc., maintainable in double digit post these acquisitions?
Absolutely, it will. They are maintainable, but mostly these acquisitions will be done through Apollo Defense, not to the parent company.
Fair.
So the balance sheets of that is totally different to that balance sheet, although it will be an aggregate balance sheet. But if you take an average out of the consolidated balance sheets, yes, the numbers will improve as well.
Fair. And with regard to the way in which you're progressing on R&D, what's the thought process, and how much are you going to be spending on R&D? And second, I also want to understand, it's a disruptive industry, right? What are the kind of moats you have?
R&D is a constant investment that we do every year. In the last quarter, we took an approval from the board to invest 50 crores for up to 50 crores for the upcoming financial year. For which the new initiatives that we are taking both in the defense and space domains, we'll be doing continuous R&D, both for the upgrading the existing technology as well as for the development of new technologies. But the markets are growing, and in this growing market, updating the existing technology is something which is very vital for us to sustain in this market. So that's the spree with which we are going in.
Okay, and also, can you just guide us as to what mix does what mix does it stand at, domestic versus export?
As of now, we don't have any export orders, but in the next financial year, we have already started bidding internationally. So probably in the next financial year, definitely we are sure we'll be able to clean some good projects.
All right. Thank you so much, Mr. Krishna Sai Kumar, for joining us today, giving us all of that perspective on both defense as well as Apollo Microsystems. Let's talk. Let's quickly pull that up and see what that one is doing in trade. There you go, 5% higher. But with that, I believe we're completely out of time on this edition of the Small and Mid Cap Show. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned for more news on NDTV Profit.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy along with 16 other district cooperatives formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phases of Amul do you remember.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the strategy.
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
Join us as we put the spotlight on 6 stocks.
on your show, Hot Money.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell
Whether it's a doubt about a short-term trade
or a long-term investment,
all you have to do
is ask Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager. listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. Some make a career in a
Good morning. You're watching Ask Profit. I'm Smriti Chaudhary, and this show is all about your stock-related queries. You can write to us on any of our social media channels, or on the YouTube live chat, or on the WhatsApp number that'll be on your screen. But before we dive into the questions or the focus of the day, let's quickly take a check on where the markets are currently at. We have the Nifty 50 that's up over 1%, a good day for the markets after seeing a couple of weekdays. It's trading at about over 22,200 levels. If you look at the chart of the day, it's constantly been going up, so we're close to the high point of the day. Let's also look at the contributors in the Nifty 50 and see what's pulling the index higher. We have the likes of ICICI Bank, L&T, HDFC Bank and RIL that are contributing the highest in the index, and we have Infi, HCL Tech that are kind of pulling are in the red, but nothing to complain there. A good day definitely for the markets. If you look at the broader indices, we have the Nifty mid-cap index that's up about 0.5%, so it's trailing the benchmark indices. If you look at the small cap index, that's also up about 0.5% in trade. Let's also pull up the market breadth. It's and where we're currently at. There you can see it's clearly in the favor of the advances today, and that has been the case since morning. So a decently good day for the markets. It's around and let's look at some of the contributors to the Nifty mid-cap as well. We have the likes of SAIL that's up about 6.5% in trade. Vodafone up today after seeing weakness for the last 2 days, up over 4.5%, with the likes of PFC and REC that are also up over 3% as we speak. However, the focus for today is Suven Pharmaceuticals. That's up in trade at around 8% as we speak, and that is on the back of the merger that they've announced. They are going to merge with Cohance Life Sciences, and if you look at the details of the merger, the transaction will conclude in the next 12 to 15 months. And the swap that they've given is every shareholder holding 11 shares will get 295 shares of Cohance. Now, the rationale behind this is to enhance their capacity and also create a diversified CDMO business, and the markets are liking the announcement. The key outcome expected from this merger is it'll be a double-digit EPS accretive from first year itself. So that's quite big in terms of what's going to come out of this merger. The ROCE will also be seen at 30%. Now, on that note, let me introduce you to our guests for today. We have Rohan Mehta of Total Wealth and Kunal Rambia of The Street joining in. Thank you to both of you, and we'll quickly dive into the focus. Now, Rohan, Suven Pharma, a big announcement there. The Street has taken very positively to it. From a longer term perspective, what do you think this will look for the shareholders?
Yeah, if you see the Suven, when I was seeing the thing which was happening, if you see it was a very muted performance from last 2020 till today, and this would be a key catalyst for a turnaround story into the company, and very positive for it. And I think so. What if you see also that this company has been into a structural range from again 4 to 5 years, and that is again going to break, and this is where the turnaround you find it. So Suven could be a very big contender of turnaround with a profit expectation of 650 crores roughly in FY 25-26.
Suggest entering at this juncture. The stock is up about 8% as we speak, Rohan.
Sorry? Yes.
Would you suggest buying?
Yeah, I think so. It's a good time. We had seen a bit of good correction in the stock for a shorter period of time. I think so. It's a good juncture for getting along in the stock, and wait for a 1 to 2 years, because there can be an as you rightly told, a return on capital employed. We may see some great enhancement in the profitability also.
Now let's quickly dive into the questions. The first one's from Arvind Prajapati. He's talking about Patanjali Foods. He's bought the shares at 965 a piece. The share is currently trading over 1500 rupees. Kunal, let's take a technical check on this one. How does it look on the charts, Patanjali Foods?
Hi, very good morning to all of you. So if I look at the overall formation on the Patanjali chart, see, it's been December so far. This counter has consistently taken the support at around 1500 levels, and it's been almost 6 to 7 times it has bounced from the same level itself. But at the same time, on the higher side, we can see 1650 to 700 kind of level being the resistance. So at this point in time, I would advise our viewer to hold on to this counter with the trailing stop loss of around 1500. If the counter manages to break that level, then we'll have to take an exit. But otherwise, the journey which we have seen from the extreme low level so far might just continue even on the higher side. So hold on with the stop loss of 1500 as of now.
All right, understood. Next up, we have a question from Shri Kishore Sharma from Bihar. They're talking about Asian Paints that they've bought at 3,100 a piece. The current market price is slightly below that. Rohan, now in the paints business, a giant like Grasim has entered. What kind of impact do you see from a longer term perspective on Asian Paints?
You see, Asian Paints is the greatest, right? We don't have to, debate on it. But greatest can be paid to this value, seeing the growth, because there has been a stiff competition which will come from, bigger players. We have seen a lot of players, inclusive of, as you told, Grasim. We believe that in this point of time where the capex is growing and the growth is there. See, we are into the market of high growth, flat interest rate, a good interest rate, and decent inflation. So rather, I would go forward for an investor, look forward for a different stories than invest into Asian Paints. If you are a typical person where you don't see ke 10 saal, 10 years, nothing will, I don't care, then it's still okay. But as a performer, I don't think the Asian Paints still will take 1 to 2 years to cool off their earnings, and then the trajectory will start.
All right, right. Next up, Rohan, we're going to talk about a news that came yesterday on hospitals. And this question is from Babu, and he's specifically talking about Apollo Hospital. We saw the stock tanks yesterday and today as well. We're seeing because of that judgment where the Supreme Court has directed the central government to look into the rates of the procedures that these hospitals charge. Otherwise, they will put CGHS rates on these hospitals, and we're seeing that impact on the stocks as well. Now, specifically about Apollo Hospitals, first talk to us what impact this is going to have on hospitals, and specifically about Apollo Hospitals after that.
Yeah, see, we have always been in our portfolios. We have never have been very, positive onto hospitals because of this specific issue. And in the global space, we have seen this, where the rates are being curbed because healthcare is one of a very important part of a government agenda. And that's what we are seeing in India also. And our healthcare was specifically not very costly, but over the period post-COVID, the thing has done a U-turn. So in that space, we need to again see that what government intervention will be done on the private space, on the public space. So that still the things looks gloomy. So for the time being, I think so it's a part to wait and watch, being neutral. It's a great business, Apollo Hospital. There's no doubt about it. But I think so onto that space currently at this valuation. If anything goes a bit of negative, you will see a steep correction. So if you're holding, you can hold on, but new buying is not recommended.
Next up, we are talking about CAMS. This is from Vinod, and they bought the shares at 2,800 a piece. Kunal, now they say they bought it from a purpose of swing trade, but they're still holding on to it. So, what kind of prospects do you see for the stock in the next couple of months?
So now, if you look at the overall trend which emerged from May 2023, where the counter was trading at around 2,000 levels, and right now it's at 3,125. There were multiple swings in between. And what is the bad part about this counter is that the swings are very, very high. So this counter should not be actually taken for swing, but rather should be taken for trending trade. This trend is definitely very much intact. Definitely hold on to this position. The trailing stop loss on this can now be 3,000, and the targets can be as high as 3,800 to 3,850. So if viewer is comfortable holding for a little long period of time with the trailing stop loss of 3 down, 1,000, one can certainly hold on to it. If someone wants to take the fresh entry, can also consider this counter.
All right. We'll now talk about Yes Bank, and this is a popular question, Rohan and Kunal, and we'll take both a fundamental and technical check on this one. A lot of people are holding on to Yes Bank, and one of our viewers, Mohit, bought the shares at around 13 rupees a piece. Their time horizon is 1 year in the space, but because we have got so many questions around this, let's talk about the longer term perspective of the stock. Now, from a price point of view, Rohan, the stock has doubled from the buy price at which Mohit bought. Would you suggest holding on to it? Is there more upside in the longer term?
Ma'am, I don't track the company, honestly. I don't track it. So I can give you an alternative for it, but I can't say about it.
Okay, and what's the alternative that you'd suggest?
I think so. It's a great thing. See, Yes Bank also, it wasn't held much by SBI, right? So eventually SBI is one of the contender of the other. So I would tell that, SBI is a great value with a great balance sheet, and, it is consistently outperforming Nifty 500. And also, please understand that, this is a habit of buying something which is very cheap is not a great habit for an investor. Just because the stock is into double digit or has been cracked down 90%, rather than buying a healthy balance sheet, which the company is doing good, is the right habit. So I would recommend not for a profit and loss, but putting a right habit for buying the right.
Very well said, Rohan. Let's take it across to Kunal. Kunal, Mohit is sitting on a considerable profit there. Would you suggest exiting at this point, or would you suggest holding on to it?
So this is one of the counters which can certainly be taken from swing trading point of view. The only reason being, whenever the swing emerges, this counter gives really good returns in very short period of time. Again, it goes into sideways negative consolidation and continues because our viewer is already holding. So let me just share one level, which is 25.25. If the counter manages to go about 25.25, I think we can see the previous high, which is at around 32. And if that level is taken out, again, the targets can be as high as 36. So for time being, certainly hold on to the position with the trailing stop loss at around 23.25. Fresh entry about 25.25 with the target as 32 and 35.
All right, got it. Let's talk about Indus Stars. This one's from Mr. Ansari. Now, Rohan, we've heard about the announcement that Vodafone came out and the fundraise. However, the stock has taken a knock after that. It's up in trade today. But Indus Stars is set to gain if the fundraise goes through. So for an investor who's holding on to it, is it a good long-term bet?
Yeah, see, what has happened is that considerably somewhere if the company is doing good, then the valuation is a constraint. Then if something company is not doing good, then the growth story comes into the picture. I think so. This is a very much probable of a contender of a turnaround. But how much time you have to invest, because return on time invested is also a very big factor. That's something which we cannot say. But if you're an investor, I think so. There's nothing to lose much on this price. But for a growth investor, I believe still it's the time. So if you've invested, be there. There is nothing too much to lose at this piece of valuation.
All right, got it. Now we'll jump into a short break. But before that, let me tell you that we spoke to the management of Narayan Hrudaya this morning, and we have a lot of questions on hospital space about the new development that happened yesterday. So if you want to know more about it, you can log on to our digital channels and watch the full conversation there. And we'll be back after the break and take all your questions. Stay tuned.
Presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the
Welcome back. You're watching Ask Profit. Let's quickly dive into the questions. This one's from Lavish from Indore, and this is for you, Kunal. We have two stocks that we're talking about. He's bought both of them. One is Borosil Renewables at 520 with a target of 1 year, and Amul India at 61 rupees a piece. What levels should you watch out for in these two stocks?
See, on the Borosil Renewable, I'm very bullish. The entire downtrend consolidation was taken out first on 3rd of January, and since then this counter is making a clear higher top, higher bottom. In fact, after yesterday's announcement on the solar business, again this counter was in limelight, and this counter spiked from almost 515 to 570 levels. From the positional point of view, certainly one can stay invested. Now the trailing stop loss on this can be 525, and the targets can be as high as 625 to 630 in the near term. And the second counter, can you please repeat the name?
It was Anmol.
Anmol India.
Yes.
Now, Anmol India, I'm just seeing this chart for the very first time. You can see the recent downtrend consolidation, and the counter is hovering at around 55. It's almost tired kind of counter. If our investor is comfortable, he can switch over to some other counter, and by exiting this Anmol. At this point in time, I don't think there is much momentum left in this unless and until it manages to cross 58, 59 on the higher side.
All right, understood. Next up, we're talking about IRCTC. This one's from Priya. She says she's bought the stock at elevated levels of 959 a piece. Let's pull up the chart and see what it is doing today. IRCTC, if we can. Okay. Let me pull up and see where it's okay. It's currently not doing much in trade today, around the same levels that she bought at, slightly below actually. And Rohan, now for somebody who has bought the stock at such elevated levels, would you suggest holding on to something like an IRCTC? We have already seen quite a run up in these in these PSU stocks, especially the railway stocks.
Yeah, but if you see IRCTC into a different juncture, if you see that then in 2021, this is like fourth year, IRCTC has been in a structural range. Just because I'll tell you, being an former investor of the company, at that time the valuation was extremely high, about 100 times of valuation, and today it has been eased down at 65 times, and still 1-2 quarter it will ease down to 50 times. With this monopoly, it's a great, great buy. Now we will see some great things. What we are seeing overall to the manufacturing. Overall to the making of the railway thing. I think so IRCT is a great buy and should be held for a longer period of time.
All right, understood. Next up, we have a question from Shiv Shankar from Bangalore. They're talking about Geo Finance. Now, from a shorter, I'm not sure if this is for the longer term, but let's take a short-term view on Geo Finance. Kunal, how does it look on the charts, and what are the key levels that you should watch out for, especially for somebody who's already bought into the stock?
So, again, this counter is forming the curve formation, and the first breakout came at around 260. And since then, this counter has consistently made higher top, higher bottoms. And look at the volumes, they're mind blowing. In fact, on every decline, there is a buying opportunity as of now. So one can certainly hold on to it if someone is willing to fresh enter the counter with the stop loss of 305. One can still think of investing in this counter. Till the time this counter continues the uptrend, just keep trailing the stop loss. So to our viewer, it's advisable to hold on with the stop loss of 305. As the counter keeps moving forward, keep trailing the stop loss and hold the position.
Right, understood. Next up, we have a question from Harshvardhan. And Rohan, I hope you have this stock under your coverage. This is AU Small Finance Bank. They've bought the shares at 580 a piece. What are the long-term prospects for the bank?
I've not been very closely watching the company, but whatever I have been knowing, I think there has been structurally some issues in the bank which we're not very comfortable with NPA and the growth factor. The company is making a decent growth, and price to book is also it's okay, like 3.4 times to the small bank. But there has been some issues which we are not comfortable onto the NPA side. That's the reason we've not been very bullish onto it. So rather, I would say in a very different way that there are certain banks like Credit Access, Grameen, Home First into NBFC, which are available at a better quality ratio, but better valuation than AU Bank.
Understood. Next up, we're talking about TCI Express. Now, this one's from Brind Pal from Delhi. Kunal, this one's for you. They've bought the shares at 1,500 a piece, and Cabra also, that they've bought at 475. What are the levels that you should watch out for, and any targets that you have on these two stocks?
TCI Express, what I can see on the chart is from 1700. This counter has clearly been in downtrend. And if you look at the overall journey, not even a single higher top, higher bottom within this entire decline. As of now, it's trading at around 1140 levels, but still, there is no ray of hope on the recovery or revival as such because the counter is not showing any positive sign. So because now he has already stayed invested for a pretty long period of time, I can just share one of the support levels, which is at around 1025. If the counter reaches that 1025 mark and consolidates, and then, these are all conditional things, and if at all it recovers from that level,
right,
advisable to revisit to our channel and come back so we can share some better view again on this.
All right. Kunal, now just interrupting you here because we can see Nifty has hit a fresh high today. It's up 1.5%. It's trading at about 22,200, very close to 300, just shy of 2-3 points of 22,300 levels. And if let's pull up the contributors as well and see what's pulling the index higher today. Yes, we have ICICI Bank, RIL and L&T. We have the likes of Tata Steel that's up 5% in trade, JSW Steel as well 5% up. There's L&T about 3.5% or thereabouts. BPCL, Titan both up over 3%. However, there are a couple of losers also on the index. Not much happening there. If you look at Cipla, that's down about 0.8%. Britannia down about 0.7% as well. HCL Tech and LTI Mindtree, a little bit of a weakness in these two tech stocks as well, down about 0.5%. Let's also take a look at where the broader markets are at. If we can pull up the Nifty 150 mid-cap index, that's also up about 0.6%, close to 18,000 levels as well. Small cap also up about 0.5% as we speak. All in all, a good day after seeing a couple of weakness in the markets in the last 2 to 3 days. And if you can also see what's pulling the mid cap, let's see what stocks are moving at the broader end. Can we have the Nifty mid cap contributors? Yes, we have SAIL. We spoke about that earlier as well. It's up over 6%. Vodafone also up over 4% in trade. There's PFC about over 3% in trade as we speak. So a life high for Nifty 50 again today. That's but let's get back to the questions now. We have all right. Seems like we're completely out of time on this edition of Ask Profit. Thank you so much, Rohan and Kunal, for joining and for answering so many questions for us. And viewers, if we were not able to take your questions today, we'll definitely try and take them on Monday. So come back, join us at 11:30 a.m. But don't go anywhere right now. We have a lot more lined up on NDTV Profit. Stay tuned.
Presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth Rs 16,618 crore was sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties since the interim order of the court, which is April 12, 2019, to the Election Commission in 3 weeks by March 6th. The Election Commission will have to publish all these details on its website 1 week after, that is on March 13th, after it has received all the information. Electoral bonds that have not been encashed yet by the political parties will need to be refunded. For more such updates, stay tuned to NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small
Hello and welcome. This is Hot Money. I am Agam Vakil. We start off with the markets which are at a life high as we speak. And it has been a tremendous run, hasn't it? And you know, we've seen a lot of consolidation over the course of the last couple of weeks, but it does seem like the Nifty has taken out that stiff resistance of 22,200 and currently inching towards 22,300 as we speak. It's up around 1.4%, and this time it is on account of a sector none other than metals and mining. It's largely aided by something like a Tata Steel, JSW Steel, as well as Coal India. These are some of the key gainers which are contributing to the up move as far as the Nifty is concerned. I want to take a look at the metal index because that is essentially one of the top sectoral gainers in today's day of trade as well. You know, a lot has been said about the kind of weakness and a lot of volatility expected, but it really hasn't come through. In fact, as you can see, the Nifty metal index is around 2.7% when one of the key up moves. But I also want to very quickly take a look at the contributors to what is in fact keeping the Nifty higher. And in terms of percent points, we have ICICI Bank, Reliance Industries and L&T along with HDFC Bank. Now HDFC Bank finally, considering the size of that particular bank, even if it advances marginally, we do see a substantial contribution of that particular bank in the index, and which is why it is up as much as 300 points at the moment. That's as far as the Nifty is concerned. Let's take a look at the Bank Nifty as well. How are things panning out there? Well, again, good gains coming in, a near 800-point up move as far as the Bank Nifty is concerned, and some solid gains coming through on account of, how things are panning out. Very quickly taking a look at the broader market indices too, to see how things are shaping up there. So a little bit of an underperformance at the moment. Mid-cap index up around 0.5%. And the small cap index, I reckon, will also be up about 0.5%. So today is the day where we see the lead clearly from the benchmark indices. So yet another big day for the benchmarks, and we'll continue to see where they are in fact tracking. Well, I'm sure a lot of these bulls will hope that there is no profit taking, or at least not a significant amount of profit taking towards the last 1 hour of trade. That said, the gains being seen on the last day of the trading week, even though today is not technically the last day, because we will still have 2 small sessions coming through tomorrow, even as the exchanges test certain systems out with respect to the backup. But that said, we still have a major trading day tomorrow. Today is the last major trade session. But again, we're going to keep an eye on these indices. But we're also going to talk about a handful of stocks in hot money today. And we do want to address what's happening with Suven Life, Suven Pharmaceuticals. We also have CG Power in focus. We're going to talk about a whole host of companies from the infra space. So specifically in this case, of course, the road sector and what's going on there is any value here. And besides that, we're also keeping an eye on the EMS sector, that is the electronic manufacturing companies, and what we can do with Dixon, Amber and the likes. But we hit the note off, and we also discussed them with an expert here, where we have Gaurang Shah, Head of Investment Strategies at Geojit Financial Services, who's also with us at the moment. Gaurang, good morning. Thanks so much for joining in. Gaurang, before I come to you, I want to introduce Suven Pharma and the latest update that we have. And I am going to get in Varsha to tell us more about this one. Varsha.
Hi Agam. So if you see, Suven Pharma is in focus today. Company has gained almost 12% in trade today. Now, the reason behind this gain is its merger with Cohance. So if you see, Suven and Cohance Life Sciences have announced their merger, and the merger is expected to be complete over next 12 to 15 months. Now, if you see, the transaction for this merger would be 11 equity shares of Suven will get to Cohance shareholder for every 25 shares held in Cohance. Now, also the proposed merger, now the interesting thing is the proposed merger here would be double-digit EPS accretive in the first year itself. Also, if you see company, now let's look at the valuation from, now company is buying at 30% discount to its own multiple. So if you see the multiple for Suven is around trading at what, 45x, now 30% to that will go to around 30x. If you see the Cohance profit in FY24 is around 200. So the deal is actually completing at almost 6,000 crores. Also, if you see now why the rationale behind this deal is, this will strengthen company's CDMO industry leadership position. So Suven is already into CDMO and also specialty chemicals. Now this merger will enhance its CDMO capabilities, plus Cohance is also into API business. So they deal into low volume and high value API business. So this will benefit the merged entity as a whole on the back of their CDMO business, their specialty chemical business, and also API business. Now if you see, the merged entity capacity will be expanded to almost 2,600 KL, and the merged entity platform will comprise of 3 distinct business units. One is their pharma CDMO, then specialty chemical CDMO, and the third one is API, which we recently spoke about. Also, now the very most important thing is, this provides access to their GNP facilities, which are already US FDA approved, and this yields revenue and cost synergies also, because there will be the merged entity cost will be reduced, the general and admin expenses will also be reduced, and their vendors will be consolidated. And the merged entity platform financial metrics, if you see, so they are guiding EBITDA margins around 35% of the merged entity, and ROC will be at 30%. Now, EBITDA margin, if you see for Suven, as of, if you see the trailing 12 months EBITDA margins around 40%, and now the guided EBITDA margins of the merged entity will be around 35%. And moving on to see, now let's see the Cohance Life Sciences. What is it? What is the overview of this company? So it offers products and services from development to commercialized products. So end-to-end service Cohance gives. Also, so as I spoke, so provides end-to-end CDMO services to global innovators, which is a high margin product, of course. And if you go ahead, so one of the things, they recorded total pro forma revenue of around 1,330 plus crore in FY23. And the special thing, the interesting thing about this business is, if you see their CDMO business, they're growing CDMO business at 30%, which will help Suven Pharma and the overall merged entity as a whole. And the revenue growth, if you see, is almost 16% CAGR organically in last 4 years. And if you see the stock performance, also one thing that I want to mention is, the expansion potential is almost 1.5x on the invested capex. Lastly, if you see the stock performance of Suven Pharma, so in last 1 year, can we have the chart please? If you see the stock performance in last 1 year, company has given almost 42% returns to its investors. So overall, this is we have on Suven Pharma. Yeah.
Right. Well, Varsha, thank you so much for getting us those key insights and updates with respect to the latest news around Suven Pharma. I'm going to go across to Gaurang to take his view on this one. Gaurang, firstly, it's the mid-cap space in the pharmaceutical sector, which has actually taken a quiet but a very positive route over the past 3 to 6 months. A lot of this is, of course, on account of the improving earnings, and a lot of that was to be seen in the third quarter gone by as well. Your view, if you track one, Suven Pharma, and otherwise, if there are any other names as well for you as far as mid-cap pharma is concerned.
Thank you, Agam, for having me on the show, and good afternoon to all of you all. We had a coverage on Suven Pharma, and with this close to 8% uptick this morning on fallback of the news with Cohens, our targets are in place. So we have given out a sell recommendation on Suven Pharma. Yes, the synergies are likely to evolve once the process comes to a decisive end, and that will be value accretive also. There is no doubt about it, as your colleague was also mentioning certain parameters. But at current levels, since the target that we had set aside is already in place, we've given out a sell recommendation. We'll possibly review it as the deal evolves going forward from here on. Other than this, if you would like to look at some other mid-cap names, then there are two names from the same corporate, which is Zydus Life and Zydus Wellness. We have a coverage over here. Aurobindo Pharma, Natco Pharma are the other two names. Alembic Pharmaceuticals is the third name that we are positive on. And our sense is that companies which are associated with research as well as generics and APIs, they are likely to perform pretty well compared to the overall sector.
All right. Gaurang, stay with us. We, in fact, have the management of Suven Pharma who's joining us on the show. And, of course, we are talking to Mr. Prasad Raju. It's V. Prasad Raju, who is the managing director of Suven Pharma. Mr. Raju, good afternoon, and thanks so much for joining AID. My first question will, of course, have to do with the deal. Can you talk to us about a little more in detail about what this entails and what we can expect going forward, especially if you could also give us an idea about the swap ratio here?
Yeah, it's really an exciting time for us. And the way that we are looking today is Cohen shareholders to get 11 equity shares of Suven for every 295 shares held in Cohens. It's a pretty good deal for Suven retail shareholder, as it is likely to be a double-digit EPS accretive in year one post-merger. This is without considering any synergy benefits. With synergy benefits, obviously, it will be much higher. In addition, Cohens has been swapped at 30% discount to Suven multiple. In comparison, peers have historical trade at around 15% discount to Suven.
Right, and so what synergies can we expect from the amalgamation of this deal?
So primarily there are multiple areas that we are looking. One is definitely revenue synergy, because we always look for cross-pollination of the customers. Because in both the firms, the customers are uncommon, which are the predominant customers, and also cost benefits are going to be there. We are likely to realize around 10% of incremental EBITDA from both revenue and cost as synergies over 2 to 4 years' time.
Right, and finally, sir, what are the business segments that you expect the business to impact most materially?
So it's not the question of any adverse impact per se, but as opposed to having two engines of growth in Suven, the combined entity will have 3 engines of growth. One is definitely a pharma CDMO. Second is a specialty chemicals CDMO. Third one is API plus. This will help us to ensure sustainable and a stable growth profile with multiple engines of growth, which also creates a scale to us.
All right, Mr. Raju, we'll leave it at that. Thank you so much for joining us and taking us through this deal and the contours there. And on that note, it's time to slip into a short break. But on the other side, we get you more on the stocks that we intend to discuss. Stay tuned in.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stemmed from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which has severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Welcome back to Hot Money, and we have CG Power as well, which has signed a joint venture agreement to build, operate an outsourced semiconductor facility in India. We have Mihika who's joining us with more details. Mihika.
Yes, so CG Power is in focus after the government approved 3 semiconductor units. Now, the units were approved under India's semiconductor scheme yesterday, and this it aggregates to a total investment of 1.26 lakh crores. About the CG Power joint venture, now CG Power will enter a joint venture with Renesas Electronics, which is a Japanese-based semiconductor solution provider, and Stars Microelectronics, which is a Thailand-based outsourced semiconductor assembly and test facility. Now, a little bit about the joint venture. It is to set up an outsourced semiconductor assembly and test facility, and this will be set up in Sanand, Gujarat. Now, the capacity of the plant will be 15 million units per day, and it will produce legacy as well as advanced packages, which will cater to sectors like industrial, consumer, automotive, and 5G. The construction is expected to start in 100 days, and it has a direct employment of 20,000 advanced tech jobs and 60,000 indirect jobs. About the contribution and the investment that will go in regards to the joint venture plans to invest 7,600 crores over the span of 5 years. Now, the financing will be with a mix of subsidiaries, equity, and bank borrowings if required. And CG Power will own 92.3% stake in the joint venture, whereas Renesas and Stars Microelectronics will own 6.8% and 0.9% respectively.
Mika, thank you so much for getting us those updates on the latest with respect to CG Power. Gaurang, coming back to you, a lot of traction now around semiconductors, sector in general, of course, CG Power being one of them. I believe we've also had another update from the Tata Group company where we are looking at another partnership that coming up there as well. Your view on, firstly, the semiconductor theme and, if CG Power is in your coverage, how would you go about it now?
So let me answer the second part first. CG Power, we had a buy recommendation here again. Like Suven, our targets are in place. We have a sell recommendation on CG Power currently. See, Agam, this entire semiconductor chip augurs extremely well. And I think India as a country, because of its dependency on semiconductors and chips, we are almost 10 to 15 years behind. Thanks to whatever initiative this government has taken, now possibly very soon, possibly by end of this year or early next year, we'll have a made in India chip ready to be available for use. It's going to be a huge potential, undoubtedly, Agam. There is going to be a lot of relevance as far as India's economic growth story is concerned, whether it is going to be high-end consumer goods, whether it is going to be high-end automobiles, everything will get catered. And we all know, because of semiconductor shortages and chip shortages, auto sector had to kind of end up with the kind of dependency it had. But now with these manufacturing facilities coming up, I think it will augur extremely well. The only thing is CG Power currently, since it is short above our target price, we have a sell or a book profits recommendation.
Okay. All right. Gaurang, the other sector we wanted to address was hospitals. And based on the kind of updates that we've seen yesterday, a lot of these hospitals were under pressure. The reason, of course, is that the authorities are looking to rein in on the pricing power of hospitals, because of which we saw a sharp correction yesterday. But that said, we also have breaking news this morning. Jefferies, of course, one of them, which suggests that concerns do look overdone. And they are of the opinion that the recent weakness could in fact be an enhanced buying opportunity, and recent PLI by NGO to establish regulated fee structures for patients could of course be a positive. Where do you stand here, Gaurang, when it comes to these hospitals in the long run as well as in the near term, considering the latest updates that we have here?
Well, give me 30 seconds more to answer this question. We have three coverages, first of all, Apollo Hospital, Narayan Hrudayalaya, and Fortis Healthcare. Out of these three, Narayan Hrudayalaya and Apollo Hospital, which is more an outperformer kind of a stock, over the last 1 year or 1.5 years, if you actually go to see Agam, Apollo Hospital and Narayan Hrudayalaya have been performing very well. I guess the government is trying to rein in the excess fees that are charged by the private hospitals, only to make healthcare facilities available to each and every person, whether it is going to be the lower end of the pyramid or the high end of the pyramid. So my sense is that, and of course, there is already a lot of deviation in terms of fee structures when it comes to even one private hospital to another private hospital. So I think reining in and bringing in a little bit of discipline is the need of the hour. And of course, you are serving humanity by doing what you are doing. So why charge something more than what you can? It's time to look at humanity first rather than your PLN balance sheet.
Okay. That's as far as your hospital sector is concerned. Of course, Gaurang is very clear on his views here. From there on, we move on to the road sector. The reason why I picked up the road sector today was because we've had an update on one of the companies where Dilip Bilkon has in fact advanced by as much as 4%. Besides the fact that, it's the order flows are coming through. this company specifically is also changing its strategies. Let's not forget that Dilip Bilkon is not without challenges over the past 3 to 4 years, and in terms of execution, in terms of several other challenges with respect to law and order as well. But it seems like the company has taken certain remedies and has moved out, and that's also the reason why over the last 12 months it has advanced by around 132%. So with these measures, Gaurang, how are you placed here? Because it's not just Dilip Bilkon, we've seen gains in RB Infra as well. So road sector infra companies, what's the way forward here?
So I think with the kind of road network that the government has lined up, of course, the Honorable Minister, Mr. Nitin Gadkari, has been, and his team has been burning the midnight oil to achieve the per day kilometer target. We are excited about some companies. Dilip Bilkon incidentally happens to be in our buy coverage. Along with that, Agam, we have names like KNR Constructions, we have names like PNC Infra, we have names like NCC Limited amongst the infrastructure plays, HG Engineering, Power Mac projects is something that we cover. And my sense is that last mile connectivity is also something that the government is very keenly wanting to resolve. So these sectors are likely to do well. The only problem, Agam, is that we are approaching a big event, the general election, that may lead to a lot of choppiness and volatility in the market overall, and even on this sector, given the kind of dependency it has on government tenders and orders.
Absolutely. Well, markets won't be bereft of volatility. That's a certain, even as we run up to the elections. And of course, the infra sector will be in focus under those circumstances. But on that note, we are running out of time on the show. So Gaurang, taking a moment to thank you for joining us and taking us through your views on the several stocks and themes that we've discussed. And on that note, it's also a wrap on this edition of Hot Money. But don't go anywhere. Lots more lined up on the other side. Stay tuned in.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to rupees 2 lakhs per month depending upon one's work and creativity with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions.
Hindustan Zinc is India's largest and the world's second largest integrated zinc producer. The company's fully integrated zinc operations hold nearly 80% of market share in India's primary zinc industry. It is also the fifth largest silver producer globally with an annual capacity of 800 million tons. The company's total production capacity of metal is 1.12 million tons. The company is a subsidiary of Vedanta Group and has the Government of India as the largest shareholder with a 29.5% stake. Hindustan Zinc's operations, comprising of lead zinc mines, smelters and captive power plants, are located largely in Rajasthan. The facilities are located in 5 districts of Rajasthan, which includes Udaipur, Chittorgarh, Bhilwara, Rajsamand and Ajmer, along with 1 district of Uttarakhand. The facilities include Zawar Group of Mines, Rajpura Dariba Mine, Sindeswar Kurd Mine, Rampura Agucha Mine and Kayad Mine, along with zinc-lead processing facilities which include a smelter at Debari, Chanderia and Dariba and a silver refinery at Pantnagar in Uttarakhand.
I have with me Mr. Arun Mishra, who is the Chief Executive at Hindustan Zinc. Mr. Mishra, thank you very much for joining us on NDTV Profit. This is a show, Know Your Company, and we are in your Dariba smelter complex. Can you take us through what this complex is all about?
So this complex is Dariba Zinc Smelter. So we produce 2 types of concentrates from the run-of-mines ore that we mine. One is called zinc concentrate, other is called a lead concentrate. The zinc concentrate comes to zinc smelter. The zinc concentrate has got nothing but zinc sulfide ore, which is taken to a roaster. Roasting is like burning in oxygen. So then zinc sulfide becomes zinc oxide. That zinc oxide is put into a solution of sulfuric acid. It becomes zinc sulfate. That zinc sulfate is brought here, and all you can see are the cell houses. In the cell houses, we have got electrodes called cathode and anode, through which electricity passes. Then the zinc sulfate ionizes into zinc ion and sulfate ion. Zinc ions, being positive ions, go to the cathode and get settled on the cathode. And after about 24 hours, the cathode plate will have a thick layer of zinc. The cathode is taken up. Then in the machines, there will be stripping of the cathode. The zinc is peeled off. And that peeled off zinc then goes for melting. After melting, we then purify and then make ingots. And we purify it up to 4 categories, the 99.99% pure zinc as a special high grade that we sell in the market.
So what we see behind us is the cells basically, right?
These are all cells. Okay. So the cells are full of vertical plates called anodes and cathodes. So they are all voltage given, electrified. So between that anode and cathode, a solution is there. And then the zinc ions move to the cathode, sulfate ions move to the anode.
So the Dariba smelter complex, what is the kind of capacity it has on an annual basis?
So we have got 3 smelting complexes, and these 3 smelting complexes together we produce about more than 1 million ton metal, out of which about 800,000 tons will be zinc and about 200,000 tons will be lead.
Lead. And these mines are nearby, right?
So we have got mines. We have got 8 mines, out of which Dariba smelting complex has got mine in Sindesar Khurd within about 4-5 kilometers, and Rajpura Dariba mine again within 6-7 kilometers. Similarly, we have a smelter in Debari on the way to airport, Udaipur airport, which has got mines in Jawar. We have got a smelter in Chanderia near Bhilwara, which has got the mines in Abuja.
How do you plan to increase the production capacity? Because that's something which street would also like to do. Because is it linked to the market dynamics in some way, or you will be increasing it? Because in India, you are one of the largest zinc producers.
So in India, we have got about 85% of market share is with us, and we produce more than India's demand. So about 20% of our product we export in any case. But cost curve wise, we are in the first decile. That is, first 10% of the total all smelters across the globe. Our cost is only within first 10%. So we got a very low cost operations being in India. So we want to increase capacity. In that case, we can replace supply from other smelters in other geographies and become a net exporter and get more dollar for the country.
I'll come to the cost of production part of it, because you have spoken about it at length, how you want to reduce the cost, which is there. But give me something about the demand for zinc and the silver going forward. How is the demand globally for zinc?
So demand for zinc is primarily used for galvanizing steel, which is protecting steel from corrosion. Most of the countries which are now developing countries, whether it is India or Southeast Asia, per capita consumption of steel is still lowest compared to the developed countries in the world. Like to give you the numbers, developed countries in the world would have 500 kg per capita consumption of steel, whereas in India it will be 150, 170 kg per ton. So that gap has to be bridged. That gap will be bridged by more and more steel-based infrastructure. So you have now more and more highways having crash barriers on the side. You have more and more airports which have got full of engineered steel structure. People will go for steel staircases in the houses, in the multi-storied buildings that they make, so that construction time is the fastest. So in such case, all will be galvanized. So zinc will follow steel growth. If steel production grows by about 10 to 12%, zinc production will grow by about 3 to 4%. And so our growth rate we expect will be about 4% to 5%. World over, the growth rate is about 1.5 to 2%.
How is the demand globally for zinc?
Demand globally for zinc is increasing day by day because because of sustainability. The people are trying to ensure that one-time put infrastructure lasts for a much longer time. So more and more bridges, culverts, railway lines are all being galvanized.
And does it also impact the pricing? Because prices have been very nominal.
The price depends upon the demand supply. So at times the mining production is much more than the smelting capacity. In that case, the concentrates are in surplus. Then the price drops. When the concentrates are in short supply, prices increase. For last 1 year or so, for various reasons, many mines have gone out of production, or many mines have come into production, but smelters have gone out of production. So right now, some of the smelters in Europe are into care and maintenance. So there is a excess supply of concentrate, and hence the prices are also low.
I was looking at your third quarter earnings, and the average zinc prices were around $2,500 per ton. You are looking at $3,000 per ton at some point. What will it take to move to $3,000 per ton?
So that is the spending on infrastructure by the countries. So we expected a huge spend in China, which has not happened. And if China starts growing at 6%, 7% rate, it will again increase the demand for steel and of course demand for zinc. India has maintained its growth rate, and fortunately Government of India has been spending hugely on the infrastructure. So we are seeing very good demand in the domestic sector.
And are there allied sectors which are now picking up zinc or silver or lead in that sense?
So these are three different metals. Lead, we are primarily into the storage battery solutions. So in India, storage battery solutions are increasing. It is against a function of weather and all that. So typically summertime we will have huge consumption. Also the growth of auto sector. The more and more cars being produced, more and more battery being fit in. So we will have more and more consumption of lead.
And as we go electrification of automobiles, will you have a role in it? Will it increase demand for you?
No, so we look at the application of EV will increase car sales because more people can afford cars because the operating cost will be lower. In that case, most of the cars will have maybe lithium battery as the source of energy for running the car. But for auxiliary functions of the car, which is pushing the window up or running AC, people will go for lead acid battery solution. So we don't see lithium as a threat to lead acid battery. It will continue like this.
Let me come back to the cost of production part of it, because you've been targeting $1,000 as a cost of production. If I'm not wrong, 1,095 was the cost of production in Q3 for you. On an average, for 9 months it was $1,100 odd. What will it take to bring down the cost of production to 1,000 odd?
So to bring it below 1,000, we have to work much more on use of either more and more domestic coal for power production or going to renewable completely. So our renewable will start landing somewhere around April or May, June. This year. So then by third quarter of this year, we will see more and more renewable power in the power mix, which will then reduce the power cost. And then our cost of production will also go down.
So give me a sense of what is the current power capacity that you have captive power, because that's thermal, right?
Thermal.
And you're going to replace that with renewable.
So we have about 500 megawatt of own power capacity. We have got signed power purchase agreement for 450 megawatt of renewable power.
And that should come in from April onwards.
From April onwards, not all 450, it will come in phases. About 1.5 years time, it will be 450 megawatt full.
So by the time you replace fully the thermal power with renewable power, the production cost will come down to 1,000 or below 1,000?
It may go down below 1,000.
Below 1,000. So we're talking about FY26, your production.
FY26, yeah.
Your production cost will be below $1,000.
Absolutely.
And that will be the synergy which is there.
Yeah, that will be the energy mixture.
What else you are doing for green manufacturing in that sense?
So one is the power is green, then automatically it becomes green manufacturing. We are also introducing battery operated vehicles, electric vehicles in the underground mine. We have got about 900 mining vehicles operating in 8 underground mines. And we have kept a budget of $1 billion to replace them over time. So we have already introduced a set of 4 or 5 equipment in the mine. First time in India, in underground mine, and first time in Asia maybe. So that are operating extremely well. And we are now negotiating with all suppliers going forward. One, how can we retrofit current fleet with EV, and how can we introduce more and more EV equipment.
And you've been very aggressive in pushing green and sustainable manufacturing. FY25, you have an aggressive target for that. Take us through that target as well.
So we are from COVID days, we are very clear that post-COVID world will see a huge push for environmental cleanliness. And second, as we move forward and zinc being applied to steel, the steel is also dependent on global consumption. In global market of steel, the consumers will start demanding from the steel manufacturer that the zinc that you apply must be green also. So it is a scope 2 and scope 3 compliance in the Paris Agreement. So we will fall under scope 3. So in that, the moment we make zinc green, then we become the prime supplier to steel companies. For them, net emission will go down by using our zinc. So then it becomes a product proposition in the market. It's not so much about green. It's more about giving you a value-added product. A value-added product, I am giving you a product. By consuming my product, your total emission goes down.
Does it give you pricing power also in that sense?
Of course.
What will be the differential pricing if the moment
I won't put a figure to it,
but give
surely,
an example.
No, suppose today anywhere between $30 to $40 kind of a number per ton we look at.
It will auto, because of the green factor.
Because of the green, something I'm helping you with, for which I have made the investment to become green, and you don't have to invest. Just by consuming my product, your CO2 emission goes down.
And that will be adding to your EBITDA levels going.
Yeah, of course.
So that's a one.
It's what in America they call the new green opportunity. And the Green Deal they talk about, that becoming green is not just about emission reduction, also gives you a business opportunity if you are the first mover. And that is why Hindustan Zinc decided to be the first mover.
There's one more thing which is there about the carbon taxes Europe is talking about.
Of course, but we are not so much dependent on Europe market. But I think world over, that carbon taxation will catch on. Every country in some form or other will. As of now, no. But we are becoming in another 1.5 years, our emission will be less. And we will go plant by plant. Suppose I have to sell 20,000 tons in Europe, I will sell from Dariba zinc plant because this will become green fast. And I will get it certified that zinc green is green zinc. It will go to Europe.
What is the kind of investments that you are planning for Hindustan Zinc? You are expanding plans.
Hindustan Zinc typically every year we spend about 2,400 to 2,500 crores for various sustenance projects and small debottlenecking projects. But from this year onwards, we will be more aggressive and we will be spending close to maybe 5,000 crores for one, sustenance. Second, we want to debottleneck, what we call quick payback initiatives. Any initiative which has a less than 12 months payback, we are sanctioning money, which will take our production from currently about 1,040 kilotons to it will take it about 1,225 kilotons, more than 1.2 million tons. Right? So for that also some money will go. Then we'll launch projects for taking it to 1.35 million tons. I have already started an RFQ inviting global tender for mining designers and mining operators to work with me to see how 1 million ton production can become 2 million ton. And once I have the conceptual paper ready by these big companies, then we'll take it to board and seek approval for converting that into project. If that project comes, it may be say another 15 to 18,000 crores of investment in the coming years.
In how many years?
So it will be maybe another next 3 to 4 years.
18,000 to 20,000 crores.
Yeah,
do you have,
provided board approves.
But do you have enough cash flows for that?
Our balance sheet has a huge power to get debt.
No, I know you're almost on a net debt basis 300 odd crores debt you have.
So with this kind of balance sheet and with this kind of 47% EBITDA level, any bank would love to give us money.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy
You are one of the largest dividend payers in the country. Not to the government, but to the promoters and the shareholders.
Dividend, or it's a question of what do I do with the profit that I make. And I think our shareholders will appreciate more that when I reinvest plow back the profit in increasing capacity and my market cap goes up. But that doesn't mean that we will not give dividend. It's a matter for the board to decide. Whenever that profit comes, they will.
Because in the 9 months you paid what, 5,500 crores?
Because we were concentrating on producing 1.2 million ton, we were not launching new production capacity. But now is the time, again we will launch new expansions.
So how much of the expansion will be in zinc, how much in silver?
So when we go from 1 to 1.5 million ton, the silver goes to 1,000 tons from current about 775 tons. But if I make 1 million ton to 2 million ton, of course silver will become about 2,000 tons or 1,700, 1,800 tons.
So it can go to 1,800 tons.
Yeah.
But that's what is the timeline for that?
So this is the 2 million ton concept paper is not ready.
Okay.
Once the concept paper is ready, I can talk about timeline and all.
So how much time does it take normally from a point of view board approval to
Anywhere close to 2 years.
2 years. So if the board approves your concept
if the concept paper is approved by the board, another 2 years. So maybe we are in 2024, we are talking about 2027.
27 you are
try to become 2 million
2 million tons basically in that sense. I want to talk to you about the proposed demerger in SZL. What was the thinking behind it actually?
So if you look at Hindustan Zinc, our current market cap is about $16 billion, right? And in that $16 billion of market cap, we have silver, which is the only producer in India. The EBITDA is to market cap ratio is still about 8. We believe that it can go up to at least 10 or 12. That will be possible if market understands our portfolio of silver properly. They still look at us as a zinc and lead player, and they think silver is just a byproduct. So if we bifurcate the company into lead, zinc separately and silver separately, we strongly believe another $2 to $3 billion of market cap will get added. Lot of focus on the world is coming on recycling, and we being a producer of zinc and lead metal, the tailing that we produce from the mills, that is getting stored. So we want to start a recycling company which will operate those tailings and recover lead and zinc, also recover a lot of minor metals with it. And that company can be spun off as a separate company, can be listed as well. And that company should get into not only mineral recycling, it can go into e-waste recycling, because entire India will be needing a good organized player with lot of technology backup who can recycle silver, gold, copper from electronic waste. So
what could be the potential of such a company? Because the street is not able to understand, as you said, they are not able to understand the silver potential, but recycling is something new. Because startups are doing, some of the startups are doing it, but not on a large scale like what you are proposing.
So we are also working with those startups. We are working on recycling. We want to bring that innovations under one platform, and then we ourselves, we have the money power, and we have got about 20-30 years of experience of processing of zinc. So we want to use our organizational knowledge, our money power, our ability of our balance sheet to take sanctions. We being top of the chart in Standard & Poor corporate sustainability assessment rating, we are on the top. So we will be able to attract ESG fund much better than a new startup. So we will bring in startup with their ideas, allow them to experiment with us, and then we will use that money, we will use our technology, we will use our factory for the trial or for the experimentation, and then we will make this recycling a very organized and very safe, environment-friendly recycling business.
Where are we on the demerger as a whole?
So on the demerger as a whole, we are with the government. So government is having their internal deliberations. We are expecting before the next board meeting of January, we will get that clarity, and it will be through in the board meeting. Then we'll register the Q4 board meeting.
April, May?
Sometime, yeah. So not January, sorry, April, May. And on the Q4 board meeting, we'll get that clarity, and then we'll go for listing of the companies and all.
So that would be a 9-month process, or 9 months or a year process?
We don't have any loan on us to be distributed. So it is...
But you have a gross debt of 10,000 crores.
That's nothing. That's nothing. Even if you allow the whole block to remain with zinc and lead, is good enough. I don't have to put any loan on silver company or any company. And as far as government is concerned, government holding is remaining same. They were 29% here, they will be 29% in all the three companies.
And in principle, are they okay with?
There is nothing. Only the concept is what is our belief, or what is the rationale of our belief that the market cap will go up.
And unlocking value for the government is
government. If the market cap goes up, government also gets the same benefit.
At one point in time, you wanted to buy out the government stake, or government wanted
now it is on the OFS route. So government is, recent discussions we had, they are working with the ideas of restarting the road shows and then coming out with some tranche of shares to be offloaded in the market.
By when will that happen?
I think very soon we'll have the road shows within, say, another 1 month or so. Once the road show is done,
you will have to go for the road show.
Of course, we'll be there. We'll be part of it.
But if the government is going for OFS and at the same time if they are doing demerger, will both of them go together?
So demerger may be a good attractive proposition to the investors when you go for the roadshow. Because they will see it will be very easy for them to pick up stocks of the silver company rather than picking up stocks of the whole company.
And then you get demerged shares basically.
Yeah, the demerged shares, and there will be different set of buyers for silver company and different set of buyers for the lead and zinc company.
In your opinion, your silver company, what could be the valuation for that?
I will not put a number, but overall Hindustan Zinc, if I say today's value is 16, we should go anywhere close to 20-21 billion. So that means I will apportion 3 to 4 billion towards the silver company.
Today the market is not valuing silver at all?
No.
And how about the recycling business?
Recycling will not start with a separate company. It may be a subsidiary of Hindustan Zinc. We have to bring it to a shape. With a pilot plant trial, this trial, that trial. Once it comes to a shape, then it can be a separate company.
So you are saying that it might be a two-way demerger and not
two-way deal, not three-way.
Three-way, because initially it was called about
three-way, but now we think that recycling will be a subsidiary, whereas the silver will be a separate company.
And you think that there will be much more incubation required for the recycling company?
Some more incubation is required for the recycling. As you yourself said, it's a more startups and all.
So that is a big thing, because you're now looking at a split between zinc and lead.
Zinc and silver.
Silver and lead will go, zinc and lead will go.
Zinc, lead will be separate, silver will be separate.
So two-way demerger.
Two-way demerger.
My final question to you is, sustainability goals, net zero. What are those goals for you, and by when do you expect that to happen?
No, so as I said that by 2027, my 450 megawatt power will be there. Then my power plant, thermal power plant will run only on technical limit, maybe up to about 50 or 100 megawatts, right? So largely I am green. And then by 2030, all my mining equipment will be EV. So while the Vedanta commitment is 2050, I am sure by 2035 or so we will be net zero completely.
And emission, there won't be any emissions basically?
No, there will not be any emission of any kind.
Mr. Mishra, it was a pleasure talking to you today. Thank you very much for joining us.
Thank you so much. So nice meeting.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? there should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of
Markets extend gains after hitting fresh record high. Nifty rises over 1% to over 22,300 levels. The Sensex above 73,500. Broader markets slightly underperform. India's economy is ahead of its own expectations. GDP grows at 8.4% in the third quarter. Shares of Paytm extend gains. Sources say Yes Bank is likely to acquire the company's merchant accounts. That's an NDTV Profit exclusive. The Adani Group reports record EBITDA growth of 63% in Q3. The 12-month EBITDA stands at over 78,800 crore. Bill Gates says India has opened the digital window to the world, praises scale and success in an exclusive interview. Hello and welcome. You're watching Market IQ and I'm your host Pallavi Nahata. Now, before we can begin with the show, let's take a very quick look at where the markets are at. It's been a phenomenal day of trade. The Nifty 50 and the Sensex are both up by nearly 1.5%. Nifty 50 up by over 320 points, currently flirting around the 22,300 levels. Let's have a look at what have been the key movers in the Nifty 50. Steel clearly having a good day. Tata Steel and JSW among the key gainers in today's day of trade. Tata Steel is in fact up by over 5.5%. while JSW Steel is up by nearly about 4.5%. Broader markets too continue to perform well, though they continue to trail the Nifty 50 and the Sensex. But let's look at where some of the sectoral indices are at. Not surprisingly, most of them in the green, and the Nifty Metal continuing to lead among the sectoral indices. It's up by nearly about 3.5%. While Nifty Energy, Nifty Bank, Nifty Oil and Gas, Nifty PSU Bank all having a good day as well. But another important data point to look at, the seasonally adjusted HSBC India Manufacturing PMI Index rose from 56.5 in January to 56.9 in February. This data came out earlier today morning. The latest reading points to the strongest improvement in the health of the sector since September 2023. Production rose at the fastest pace in 5 months, fueling the quickest increase in sales since last September and the strongest expansion in new export orders in 21 months. Input costs have increased, but only fractionally, and prices charged by Indian manufacturers have also increased at a slower rate. Now, despite the uptick in growth momentum, employment is little changed, but optimism among manufacturers regarding the year ahead outlook continues. Now, GDP, we've spoken about GDP in the headlines. The headline GDP figure was substantially higher than expectations. And now that we've had some time to look at the finer details, we have with us Kaushik Das, Chief Economist at Deutsche Bank, to help us make a little more sense of the figures that came in last evening. Kaushik, thank you so very much for taking time out for us today.
Thank you, Pallavi. Thank you for having me on the show.
Yeah, it's your first time, I believe, on NDTV Profit with me, and it's exciting for me to have you. But, like you've mentioned in your report, that the GDP figures do require a closer look. GVA, in this case, clearly a better indicator that's come in closer to expectations, unlike GDP, which was substantially higher than expectations. You also explained that was because of the impact of net indirect taxes. But moving on from that, what I do want to start off by asking you is that on the expenditure trends front, we've continued to see divergence between investment and private consumption. What are you making of that divergence, and do you think that's sustainable?
So, Pallavi, first of all, no matter how you slice and dice the data, I mean, at the end of the day, even if you look at GVA, we are supposed to get close to 7% growth for FY24. When we started projecting, 12 months back for this particular fiscal year, we thought, at best, India will grow 6 to 6.5% in this fiscal year. So I think growth has surprised genuinely to the upside, and 7% growth, real GDP growth in this kind of a geopolitical environment, it just proves that how much resilient India has become, and the reforms that have taken place over the last 10 years, they're bearing fruit. So all these are very positive. We can keep on debating about 7% or 7.5%, which one to look at, GDP versus GVA, but it doesn't take away from the fact that growth is genuinely strong from a headline perspective. Now, if you look at the breakdown of that growth, particularly in GDP, you'd see that private consumption is growing at 3.5%, and that's close to 60% of GDP. Previous quarter was also 2.4%. So one way to think of it is that private consumption is on the lower side, the growth momentum, whereas investment growth is growing at 10-11%. We know that the government's capex push has been strong. The private sector has also started investing in some part of the capex, not a broad-based recovery, but we know that last 2 years the private sector is also investing. So investment growth is much stronger than private consumption growth. But if you look carefully at the data, there is one component called discrepancy within the expenditure side GDP that has contributed 3.5% to GDP. So what it means is that at some point of time, the CSO will be, adjusting that discrepancy and put that number somewhere in some component. So my belief is that 3.5% growth that you're seeing in private consumption probably would be, raised upwards, and you'd see the number closer to 4.5%, 5% at least, in order to make sense of that 8.4%. As of now, obviously, it's not adding up to 8.4. You have to add the discrepancy component to get 8.4. So, long story short, I think the numbers look on the lower side if you take it as it has been reported. But I think over the next few quarters, when they revise the data, you'll see private consumption data probably would be revised up.
Okay, all right. So essentially, going by what you're saying, is it fair to assume that we are beginning to see some signs of recovery on the private consumption front? Like this quarter, we've already seen slightly better growth than we saw in the previous quarter. And going by what you've just said, does it look like consumption is on the road to recovery?
It makes a little bit of sense, because if you see the data, first of all, these are backward-looking data. So April, December, we know that we had a patchy monsoon. So if you look at the production side, GVA numbers, you'll see that farm sector has declined minus 0.8% year-on-year in October, December. In July, September, also the growth was pretty low at about 1.5%, 1.6%. So the farm sector, the rural sector, obviously, was weak, and the growth that has been supported is mostly non-farm sector, and it'll be led by the urban sector. So I would guess that if this year monsoon is relatively fine and not as bad or patchy as last year, the rural sector should be doing well. There would be also support from the government's budget initiatives for the rural sector. So I think overall you could expect the rural sector to do well, but because the urban sector has done the heavy lifting in the last 2-3 years, particularly the affluent segment, it could happen that the momentum of that spending, which happened in the last 2 years, probably slows down from the next fiscal year, and therefore, growth could be lower than what we experienced in FY24. And remember, we had this growth of 7.5% in FY24, despite RBI having hiked interest rates quite aggressively. We've had geopolitical shocks. We've had a bad monsoon. We've had Fed increasing interest rates quite aggressively. So over a period of time, when you have this theme of higher rates for longer, at some point, you would have growth kind of slowing down. There, the mix could be different, that this time the urban kind of growth slows down a bit more into the next fiscal year, where rural looks a little better if you have a good monsoon. But overall, the trend could be a little slowdown in growth from what we've achieved in this fiscal year.
Right. Okay. So before I can move on to my next question, it's fair to say that a little bit of the recovery that we're expecting to see in private consumption is dependent on the monsoons and a pickup in the rural economy going forward, which in Q3, of course, underperformed. Agri GVA came in at about minus 0.7, minus 0.8% abouts. And we are expecting a better figure, especially given Rabi sowing trends. So broadly, is it safe to assume that the rural consumption picking up is expected to go and lift private consumption ahead?
Yeah, so rural consumption should improve on the margin, but we have to see along with that what is happening with the urban consumption, whether urban consumption is holding up at the same pace or is it kind of slowing down a bit. So it will be a mix of both rural and urban, which will decide the final, extent of growth for private consumption as a whole. So as of now, it looks like, the rural sector is kind of, picking up from the weakness that we had seen last year. So that should be a good kind of a story for rural sector in 2024. But we have to see what happens with the urban sector, with rates remaining high, liquidity remaining tight. Credit growth is expected to slow down from the next few quarters, with RBI keeping liquidity tight. So all those could have some impact on the urban consumption, even as rural consumption picks up.
Okay, got it. So thanks so much for that perspective. I do want to quickly ask you about investments as well. Of course, investments not entirely on unexpected lines. Did the heavy lifting when it comes to, the GVA on the expenditure side trends? What I want to understand is, looking at these figures and given that we know that the government did take a little bit of a step back, looking at these figures, is it safe to assume that we are finally now seeing signs of a recovery in private capex as well? Is there finally crowding in happening from the private sector on capex?
I would believe so, because we don't get the breakup of private and government investment when the quarterly GDP number is released, but we got close to 11% number. We know that the government is pushing capex from their end, so that is known to us. But I believe that private capex also has started, but it probably is kind of concentrated in into some narrow kind of group of companies. You could probably expect a broader capex recovery once elections are out of the way, and from FY25 starting or the second half of FY25, you could see a broad-based capex recovery. And therefore, over the next 2-3 years, if you think from a longer-term point of view, if the broad-based capex recovery takes place, the private sector capex, then the government actually can slow down on the public sector capex. They have done quite a lot in the last 5 years. But then overall, still the investment would look good, because the public sector capex is about 1/4 of the total capex. The private sector share is higher. So if the private sector comes in and that share starts growing at a higher rate, then investment should look good. Private consumption could slow down a bit because of the rate hikes that have happened and the lagged impact. But this would be good for inflation, because if growth is supported at 6.5-7% in the next 2-3 years, led primarily by investment and not just by consumption, then that should be also non-inflationary, and it will be easier for RBI to manage inflation in the 4-4.5% range over the next 12 to 18 or 24 months.
Got it. Okay, Kaushik, one last question. I quickly want to understand how do these figures change your estimates for FY25 and also any changes to what we can expect from the RBI in terms of monetary policy action, considering that growth, of course, continues to surprise on the upside?
So a couple of things. One is this particular fiscal year, we should be at 7.6%. Mathematically, the numbers that we've got for April, December, even if we plug in 5.8, 5.9% growth for January, March of 24, you should hit 7.6% number, which the CSO has given. So we are, we are agreeing with that number, and also the GBA number should be close to 7%. The CSO has given 6.9, so all that is fine. The question is about next year. My forecast is slightly lower at 6.5% compared to RBI is at 7%. A couple of things. One is because the base of this year has become, high, it will be challenging to, kind of get to the 7% mark because of the high base. So that is mathematical per se, one part of it. The second is you would expect over a period of time, the momentum that we've seen in the last 2 years to slow down from the urban side, and even if rural picks up, overall, you would expect some bit of slowdown to have taken place. And also, if the global economy slows down over the next 2-3 quarters, that would also have some impact on India because, we have some linkage with trade linkages with the global economy. So to that extent, I would be a little conservative starting with 6.5% for next fiscal year. But 6.5-7% kind of a range of growth in this kind of global environment, I think no other country would kind of come close to that, and India would remain the, fastest growing major economy in the world for a long time, not just this year or next year, but this is a structural development that will kind of play out over the next several years. On monetary policy, always remember that monetary policy is forward looking. So when you come to June or August of 2024, RBI will have to think about 1 year ahead, June 25 or August 25. If no policy actions are taken, then can you maintain this 6.5-7% kind of momentum? That's where if they feel that credit growth and GDP growth could be slowing down in 2025 and 26, if no actions are taken at this point of time, sometime in the mid of this year or second half of this year, then possibly the adjustment or monetary easing would start in order to maintain that 6.5-7% growth. So I think still easing is on the card. The timing we can debate, and it is very closely linked with when the Fed is expected to start cutting rates. So, depending on the Fed cycle and the quantum of the Fed cycle, RBI monetary easing also will be fine-tuned. But I think still there is a case for some rate cuts in this cycle, and we'll see that as time progresses.
Okay, thank you so much, Kaushik. Many more questions, but we're completely out of time, unfortunately. But cannot thank you enough for taking time out for us today. We'll reconnect with you soon. But with that, it's time for a quick break. We'll leave you with some commentary from Bill Gates as a part of NDTV Network exclusive. Let's listen into what he has to say about India's digital economy. We'll be right back. Stay tuned.
Well, there's no doubt that being able to register citizens and get government payments to them directly, they don't have to go to a bank branch, nobody's asking for their part of that cash. The pandemic is a wonderful example where actually going to branches wasn't going to work no matter what. And so the amount that's been saved, and now the amount that the government's interacting in a rich way with citizens. For example, I saw an Odisha where they'd registered the farmers and they understood their land and their crops. And so they're sending them a regular bulletin and they're communicating about pests and what you need to do. So this is a case where India's been out in the lead. India did this thing at scale. They made it work, and the Gates Foundation has been involved in some of those projects. But we're also involved in helping India show other countries. So right now, there's 15 other countries at various stages of adoption, which a lot of that was kicked off by the way that Modi made that a centerpiece of the G20 meeting.
It's brought to you by बनेगा तो बढ़ेगा इंडिया, अल्ट्राटेक, देश का नंबर 1 सीमेंट.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth Rs 16,618 crore were sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties since the interim order of the court, which is April 12, 2019, to the Election Commission in 3 weeks by March 6th. The Election Commission will have to publish all these details on its website 1 week after, that is on March 13th, after it has received all the information. Electoral bonds that have not been encashed yet by the political parties will need to be refunded. For more such updates, stay tuned to NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Hello and welcome back. You're watching Market IQ on NDTV Profit. Now, sources tell NDTV Profit that SEBI has now asked all asset management companies with small and mid-cap schemes to undertake a stress test of their portfolios at the earliest. Sajid joins us now. Sajid, what else are you picking up from your sources?
That's right. If you look at the entire industry of small and mid cap, there are nearly 56 schemes which are there, which are catering to the small and mid cap in the market, and together they have a portfolio or average asset under management of nearly 5.24 lakh crores. Now, what we understand from our sources is that the market regulator wants a stress test done on all the schemes of the mutual funds which are for small and mid cap. It basically means that the industry body, which is AMFI, Association for Mutual Association of India, will be bringing out with parameters which are constant and which will be those it's going to be those parameters which will be applying to each and every scheme of the small and mid cap category there. It also means that these stress test results will also need to be informed and disclosed to the investors either on the website of the mutual fund and on the website of AMFI. So every scheme-wise disclosure needs to be there, so that the investor who is participating in these small and mid-cap funds get adequate information with respect to the potential risk the portfolio has. Remember, the small cap and the mid-cap stocks have run up in a significant manner over the last 12 to 18 months. And that has led to a lot of asset appreciation, and with the AMFI even calling it as a froth which is there in the small and mid cap space. In addition to that, the AMFI has also been asked to ensure that there is a exit load mechanism which has been imposed on investors who are coming into the small and mid cap from a short term perspective. So if they are coming for a shorter duration investment, there should be a higher exit load, so that it doesn't have an impact on investors who are staying on for a longer period of time. Now all this needs to be done within the next 1 month, and by the end of March there will be disclosures on the website of the mutual fund against each of the schemes which are falling in the category of small and mid cap, and also on the website of AMFI which will disclose these potential risk which is there for all the small investors.
Thanks a lot for that, Sajid. Now, moving on, ahead of the elections, in a high-profile meeting, the BJP's Central Election Committee has decided upon the seats of Lok Sabha across about 17 states and has sealed more than 155 seats, the list of which is expected soon. NDTV's Maria Shakil joins us with more details.
Yes, so the meeting began roughly around 11:15 is when the Prime Minister arrived at the BJP headquarters for the Central Election Committee meeting, and the meeting continued till around 3:30 a.m. when the Prime Minister left, and thereafter all the members of the Central Election Committee of the BJP were present. There are a number of members of the BJP Parliamentary Board, which includes Defence Minister Rajnath Singh, were in attendance, and of course B.L. Santosh, who is the Organisation General Secretary, Mr. Amit Shah, the Home Minister, and JP Nadda, BJP President, all of them were in attendance. What we are being told by way of sources is that core committee of 17 states met this group, which includes the states of Bengal, the states of Uttar Pradesh, also Chhattisgarh, Rajasthan, Tripura, Telangana and Madhya Pradesh as well. What sources are saying is that in a clear departure from the past, the first list is likely to be announced in the next 24 to 48 hours, much before the Model Code of Conduct is in place. And 50% of the seats in these 17 states have already been decided. The two states where the BJP did spring a lot of surprise in 2019 was the party winning 18 seats in the state of Bengal and 4 seats in the southern state of Telangana. They are hoping that they'll be able to win more seats this time. So seeing these two states as a potential catchment area, the BJP could announce more seats that the party did not win last time around, this time as first, before they go ahead and announce candidates for seats that they have already won. So in all, we can expect some, several MPs and ministers be dropped. Several union ministers be dropped from this list. That is not really much of a surprise, because the BJP has followed this pattern of sorts in which they feel that the anti-incumbency is against local MLA or local MP, because this election will be fought with the Prime Minister himself on the ticket. It will be a presidential election with brand Narendra Modi on the run. So that is the reason why what we are seeing play out is essentially BJP gearing up, sending a message that it has strategy in place, and the first list and probably the second and the third list also could come out much before the Model Code of Conduct is in place. But for the moment, we can expect a press conference when the first list is announced. When will that be? We'll have to wait and see.
Thanks a lot for that, Maria. That's all we have on the show for now, but stay tuned to NDTV Profit. We have a lot more coming up.
Brought to you by बनेगा तो बढ़ेगा इंडिया, अल्ट्राटेक, देश का नंबर 1 सीमेंट.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stemmed from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in...
Thanks for tuning into this very special conversation on the Mutual Fund Show. Now, why this is important is because about 7 to 10 days ago, if I'm not wrong, an announcement caught everybody's attention. Now, the release was that Kotak Blue Chip Fund celebrates 25 years of long-term wealth creation for investors. Now, while this is commendable that a scheme has completed 25 years, what also stood out for me really, or what really stood out for me, was that this has happened at a compounded annual growth rate, or CAGR. Some people understand CAGR now a lot more than compounded annual growth rate. It's a period of acronyms, isn't it? So the compounded annual growth rate of 16.36% for an SIP into that fund. Viewers, 16.36% over a period of 25 years can make you wealth like very few options in the world can. And therefore, we thought it best to welcome in the architects of Kotak AMC currently to talk about the history of this fund and what is it that mutual fund investing could do to wealth creation. The gentlemen need no introduction. Nilesh Shah, Asha Upadhyay join us on the show. Gentlemen, both of you, thank you so much for joining in. Nilesh bhai, in some sense, this is stuff that dreams are made of. People who would have been invested in this through the years would have been thanking their stars, and people who might have missed out on this because they got out too early or switched their investments, I hope they have done well too, but they will be ruining their luck that why is it that they didn't stay invested for the long term? The power of compounding.
So Neeraj bhai, thank you for having us over here. And it's a matter of great pride when you see a fund completing 25 years, doing well in securing financial freedom for its investors. At the same time, it is also a time for introspection. How many people have stayed invested for full 15 years? It's like we were running a train from Mumbai to Delhi, and people were getting in at Mumbai Central, getting out at Borivali, getting in at Borivali, getting out at Palghar, getting in at Palghar, getting it out at Surat, and so on and so forth. I think still there is a need to make people aware that, like that story of tortoise and hare, in the end tortoise wins the race.
Yeah. most certainly. But in some sense, and I'll get Harsha into this conversation for that purpose as well, but just an opening thought from you. Very often, the tenements of a scheme change with changes of fund managers, changes of people at the helm, the change in the policy that an AMC might have as well. 25 years, very few schemes would have had this longer runway, right? Were there some basic things that stood out for a scheme like this for it to be able to do so well, so consistently over such a long period of time?
So one, Neeraj bhai, we are standing on the foundation laid by my previous employees at Kotak Mutual Fund. They build a foundation on which we are building it further. Second, Harsha has been in this company for now more than a decade, and he's steering our investment process. Every day you have to learn, but in terms of principle, we are rock solid. We'll buy quality companies. We will pay respect to the valuation. So we are nor growth at any price investors nor value investors. We are growth at reasonable price investors. Third, every decision we take, there is a research behind it. Now, sometimes it works. There are times when it doesn't work, but fair enough. Those principles lay the anchor on which funds are managed, and which is why, of course, there are rough patches, but overall, we still end up reaching our destination.
Harsha, come in on this one. Before I come to what the fund could do as well, and you're steering this fund now amongst everything else at Kotak in terms of equity strategy, but what does it take for a scheme to do this for such a long period of time?
Neeraj, as Nilesh mentioned, we have stuck to our investment discipline. I think that's the critical thing. People have come and gone. There will be changes even going forward. But as long as there is an institutional framework and people stick to it, I think the experience is going to be reasonably strong. In this fund, although the name has changed over a period of 25 years, it started as Kotak 30, as many people would have known at that point of time. Then we called it Kotak 50, and now it's called Kotak Blue Chip. But the investment philosophy has remained the same, that we will invest in leadership companies, established companies, large cap companies. Even before the recategorization, we were investing more than 80% in the large caps, and that continues even now after the recategorization. So to that extent, the investors have not seen any change in investment philosophy or the discipline over the last 25 years and continues to be very, very strong. We look at established leadership companies in each and every space and try to assess the business in terms of where is the competitive advantage, whether the company can sustain that competitive advantage for the next few years. Is it a scalable opportunity or not? How is the management? Is the management bandwidth good enough to steer that company into a next level? And then finally, the final filter is always valuation. So we have always been following this approach, and that has paid dividends, I would say.
The cornerstone of most conversations in the recent past, and you could argue, Harsha, maybe at times rightly so as well, that it's become difficult, increasingly difficult, at least in the, say for the last 12 months otherwise, for large cap funds, active funds, to beat the benchmarks very, very convincingly, and hence this whole rise of the debate around whether on the large cap category is passive ETF investing a better way to go to. In such a scenario, this fund has done what it has done for so consistently. Just trying to think about as the base has grown, as the performance benchmarks have been set, etc., how difficult or how easy would it be for you and Kotak AMC to now do an encore, possibly, of what you've done over the last few years into the near future?
See, that will always be our endeavor. See, as the size grows, as the market matures, it becomes challenging to create the same kind of alpha that we were possibly creating a decade earlier or 2 decades earlier. But having said that, there will always be cycles, whether it's a large cap fund, mid cap fund, or a small cap fund. Every active fund will go through cycles, and the businesses also go through cycles. And end of the day, the portfolio is a mix of several businesses, right? So to that extent, alpha creation can also be cyclical. Maybe in the past, the cyclicality didn't exhibit itself so often, but now markets having got more mature, more institutional money chasing the same set of stocks, etc., probably those cycles are quicker ones. Nevertheless, over the last 25-year period, The fund has beaten Nifty 50 by almost 3 percentage points. So you can imagine every year 3 percentage point outperformance for 25 years. Yes, in those 25 years, there have been periods where it has underperformed as well. But what remains to be understood is, if you are sticking with a fund for a long period of time, there will be periods of underperformance, outperformance. But if the investment discipline and investment philosophy is robust enough, then the investor is more likely to get a good investor experience.
Nilesh, you want to add to this?
So as Harsha mentioned, there will be cycles now because our size has become big. I'm now no longer running a speedboat, I can take sharp turns. I'm now running oil tanker. If I have to take a U-turn, I'll still move 2 kilometers further and then take a U-turn. But eventually, will there be a place for professional fund manager to add value to the customer? We believe answer is yes. And this is when there is a non-level playing field. For example, a fund is kept at 10% in an investment in a stock. Index is not. Second, in index stocks, enter and exit at the closing price. Fund has an impact cost. Third, we are comparing total return index vis-a-vis net performance of fund. Globally, people compare gross performance with TRI. Despite those challenges, will we be able to add value? Answer is yes.
Got it. I'm glad you're not navigating the oil tanker through the Red Sea currently, as the case may be. But
so, Neeraj bhai, will there be periods when we will go through Red Sea? Answer is yes.
Yes, most certainly.
For a time like today, when so many low floating stocks has gone up substantially, there's tremendous pressure on us to go and buy those momentum stock because our funds are not performing. We are underperforming benchmark indices. If I didn't bother about my investors, I'll go and invest in those momentum stocks. But we have a process. We'll have to bear the pain of underperformance for a while because hopefully, eventually, we will be proven right.
Yeah, and we'll talk about this on the other side as well because there is a market goes through those cycles. But just a sneak peek into what we'll talk after the break, and both of you can quickly weigh in on this. But just wanted to understand, he mentioned momentum and how in some cases currently momentum is really beating or taking the pants off what could be considered conventional forms of investing, right? But it may be a cycle. I mean, are you guys of the belief that that is the kind of market we are going through right now? And while difficult to preempt when it will end, but it is a cycle that will probably see its course, and eventually what has held the age-old wisdom of investing will probably come back in flavor as well?
Definitely. I think end of the day, there has to be an earnings support, there has to be a fundamental support for stocks to reach certain level and sustain those levels. If they are going without support of fundamentals or for the reason that there is lack of liquidity and hence a small amount of money is driving those stocks, I don't think that's sustainable over a period of time. Sometimes it takes few months to see that cycle going down. Sometimes it takes longer. So, but finally the earnings have to support the growth. That's what we believe, and that's what has been proven even in the past. And I'm sure that even going forward, that's going to exhibit itself.
Okay. And market-wide, just before we take that break, Nilesh bhai, market-wide, either of you can come in, of course. But we've been talking a lot about Indian valuations and how expensive they are optically, etc., and stuff like that. Question is, do you guys, based on your research, your analysis or your assessment of the earnings commentary from companies for the last 3 quarters or otherwise, believe that earnings growth is in reasonable fine fettle to justify the kind of exuberance, if you will, that the market is in? Harsha?
If you look at not just the last 3 quarters, but if you look at from the COVID lows, the market earnings have grown at a CAGR of in excess of 30%, and even markets have given more or less similar kind of returns. So to that extent, if you simply look at last 3 years, this doesn't seem to be out of whack. This seems to be more or less in line with what the earnings growth has been. But the question is whether the same kind of earnings growth can continue for the next several years, that is only, in that case, the valuation can sustain. But if there is a moderation in earnings growth going forward, then certainly there will be some hiccups along the way.
So for now, we are predicting, or we are basing our valuations on the belief that this earnings momentum will sustain, right?
The market is basing
yes. Market is, yes. Okay, fine. Viewers, stay on, because we'll take a quick break. We'll have to do that. We'll try and come back and talk about what kind of constitutes blue chip as well in the current scenario, if you will, and the very interesting distinction that both of them made about between momentum and what truly constitutes earnings-backed investing. We'll talk about that on the other side of this break. Investors in this fund or otherwise, it's a must-hear conversation. Stay tuned.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than rupees 10,000. While high-end kits range from rupees 20 to 35,000.
Back with this leg of the mutual fund show, and in conversation with the A team at Kotak AMC, we're talking about under the pretext of talking about the Kotak Blue Chip Fund celebrating 25 years of its history. More importantly, through its history, an SIP investor earned a return of over 16% CAGR for those many years, and that's quite an astounding statistic. Now, we've spoken in the first segment about what are the basic tenements which went behind this. I'm just trying to understand, and this segment, Harsha, I'll start with you. What truly constitutes now components of a blue chip fund under the current scenario? Because the number of sectors that have come to the fore, the number of spaces which may not necessarily have the true blue Nifty 50 presence, but are large sectors in their own right. So how does a fund constitution now become relative to what it would have been in the past?
I don't think anything has changed because even earlier when the categories were not clearly demarcated in terms of the asset allocation pattern, we were investing more than 80% in the large cap stocks. Even today we are investing in more than 80% of our corpus in large cap stocks. The rest of 20% is available for you to invest into mid and small caps wherever you believe that there is an opportunity. Within the large cap space, it's equally split between Nifty and non-Nifty, which is the Nifty Junior as we call it. So the top 50 and the bottom 50 within the top 100 companies have more or less a similar kind of exposure in the fund. And it has exposure in a very, very diversified manner within the large caps. Almost all of the large segments of the market are represented in that. We do have a tilt towards the domestic businesses today, given that the global facing businesses or the export oriented businesses have some headwinds as we see going ahead. And India growth has also been more robust and resilient as compared to global growth. Yes, valuation in pockets have been expensive, but as you would know, the large caps don't have that valuation risk as much as mid and small caps. So we are well diversified within large caps, having a tilt towards domestic businesses. And the rest 20% goes into mid and small caps, where we will go sector agnostic and look at bottom-up opportunities.
Tejbhai, you've been at the forefront of talking about the innumerable number of new opportunities that India as a country has gotten as well. What do you anticipate the large cap space to be like as well over the course of the next 5-7 years? Because like I was saying, not everything finds its way into the Nifty per se, quote unquote, right? It's fashionable to quote about Nifty 50 or Sensex 30. Not everything finds its way there. So what do you think, or how do you think the constitution of the large cap universe in India will be like relative to what it is currently?
So one, Neeraj, there is a trend where innovators and disruptors will do well. At one point of time, Mumbai, Gujarati, Marwadi equal to stockbroking. Today, top 2 stockbroking company of India is not based in Mumbai. They are outside of Mumbai and they are a recent trend. What happened in stockbroking will happen in every industry. And as fund manager, if we can go and pick up those companies, that will be really good because they'll create tremendous value for investors. Now, will there be failures? Answer is yes. If you are innovator, if you are disruptor, you will fail. Today, Apple announced that they are pulling back from electric car.
Yes.
Someone can call it a failure. I will probably use Thomas Alva Edison's famous word that I haven't failed 1 lakh times. I found out ways of not doing that thing 1 lakh way. So, innovator, disruptor is the future. Will large companies be able to do it? Well, they have the wherewithal and resources to do it. But then they have to also remember that they don't become like Kodak. Kodak had all the resources to go into digital films, but they didn't. So essentially, you are trying to pick up companies which are investing for future, which are willing to forgo their present, reset for the future, and become an innovator stroke disruptor.
Where do you see these opportunities? Because they could form a part of the 20% of the blue chip fund as well. They could form a part of a number of other Kotak AMC schemes as well. So to you and then to Harsha, where do you see such opportunities within India?
So today we have invested in an explosive company which is exporting explosives to the home of explosive inventor. We have invested in an auto component company which has become the first company in the world to get a contract of making engine spare part for Toyota. These are all, some small, some mid, some large cap companies who are doing innovation and disruptor. It's not that the big guys are not doing disruption or innovation, they are also doing. So essentially, you are trying to future-proof your portfolio by investing in companies which are ready to face the future.
Got it. Harsha, you want to add to this?
Neeraj, if you look through the cycles, the large cap profit pool has been around 75% of the total profit pool in the corporate world, in the listed space. So it's not that every time there is a new entrant, they are able to move into the upper bracket and they are displacing somebody who is already there. Yes, there will be cases like that in the large cap, in the mid cap, in every segment. But end of the day, these top 100 companies are the ones who have established, who have seen cycles, who have the bandwidth to really manage many of the adversities that may encounter over a long period of time. So you can't really ignore. So if you want stability to the portfolio, you have to have some mix of large, mid and small because the opportunities will be be all around. So I think if somebody is looking for a little more conservative equity product, a large cap product is definitely one of that. And that's how we have been managing this over a period of time. And over a period of time, the returns are as good as you would see in any other category. So for a long-term investor, I think the opportunities are there in every space of the market. And depending on the valuation comfort, we have the flexibility to move between sectors, move between market capitalization patterns, and that flexibility allows us to really manage the volatility and also the valuation risk, etc.
Yeah, but still, I'm just trying to get clarity on my question, which is, Harsha, that thank you for answering that, but where do you think the next set of big opportunities come in? Because like Nilesh bhai said, that one, companies need to invest for the future. So some of your top holdings, for example, are the traditional banks, maybe IT services, oil, energy, upstream company, the behemoth, etc. Where do you see in the remaining 20%, if you will, where there are opportunities wherein companies have a chance, the highest chance of maybe being small currently, relatively, but having the fighting chance of becoming larger over the course of the next 7 years?
See, if you look back, India has seen cycles of 5 to 8 years in businesses as well as in stock markets where a particular theme does well from a business perspective and also gets re-rated over a period of time. Right? From the mid-90s to maybe 2000, 2001, it was the IT outsourcing theme, which did well in terms of business as well as in terms of how stock market reacted to it. Then there was a period where construction, infrastructure-led activities really drove the growth, and also the stock market really kind of re-rated the entire basket. Then we had 2 periods where consumption-oriented theme as well as banking were the next 2 big themes. Now we believe that over the next 5-7 years, manufacturing, when I say manufacturing, it will cover all gamuts of manufacturing. I think there is really a wonderful space where India can occupy a part of the global trade. There are geopolitical issues which are favoring us, and there is capability building that's happening, which will also allow us to really go and compete against many of the competitors in the world. And definitely, I think the policy push is also towards making sure that India comes out as a manufacturing hub. So there will be several plays within the manufacturing which will give that kind of attractive growth over the next few years in our mind. And that will be represented both in large cap segment in the 80% as well as in the 20% outside the large cap.
Got it. Okay. Final question, Nilesh bhai. And what is the one thing that, as the CEO of this firm, and as somebody who's doing countless these seminars, meeting investors, the one message that we want to give to mutual fund investors currently, something that you believe they should be doing but are not doing? I would reckon one of the easy answers is not staying invested for long term, but still, is there something else as well?
So, in a slightly lighter vein, in our culture, we have been told that money is not everything in life. Money doesn't matter. Paiso hathno mel chhe. My recommendation is what Warren Buffett mentioned. Money is not everything in life. Money is not important, but make sure that you have made enough money before you make such statement. Please, please, please protect your financial security. For our parent, we were their retirement solution. But let's leave sar utha ke jiyo. Secure your financial freedom, and if you are faithful to that, mutual fund will be your top priority. Then by definition, you will become regular investor, long-term investor, and also a disciplined investor.
Well, I certainly hope people are taking cognizance of this. But gentlemen, congratulations to the fund house at large for such a wonderful journey of one of the schemes, and I'm sure there will be many more during the course of its existence. And thank you for sharing such insights with us.
Thank you.
Thank you so much. And viewers, thanks for tuning into this very special episode of the Mutual Fund Show.
Presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh litres of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy along with 16 other district cooperatives formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phases of Amul do you remember.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles.
Hello and welcome. You're watching Large Trades, a show where we talk about all kinds of bulk and block deals, large trades and every kind of volume buzzer. I'm your host Mika Barve and with me is Agam Vakil. But before we go on to the buzzing stocks of the day, Agam, how do the markets look like right now?
Smoking hot, that's what they look like right now. We are looking at tremendous amount of strength, and even for a Friday when one might expect lackluster moves even as we move into a weekend. Of course, tomorrow is still a trading day, but you know how it is in terms of weekend. Well, that's not the case because we're seeing substantial amount of gains, and it's not every day that we see a 1.5% gain for something like the Nifty 50. The Bank Nifty as well is up as much as 2%. So a lot of strength coming in, and the strength is from across. It's secular from what it looks like. So we've seen good gains across sectors, but I reckon that it is also the commodities which are leading the gains today. If you just take the constituents of the Nifty 50 and see where the big push is coming from upwards, you'll notice that you will have contribution from HDFC Bank, as you can see on your screen there. Reliance Industries and ICICI Bank show the top contributors to the gains coming through. But and you don't have too much to speak for when it comes to weakness on account of a handful of those IT stocks. It's not something that you would want to consider because of the sharp 368-point up move against just a 27-point down move. But it's the metal sector which is also doing well today. We do have the names such as Tata Steel, JSW Steel, something like even Moil for that matter, the non-ferrous side of things. Well, that's doing very well and advancing in trade today, and also providing a lot of gains and given a lot of support to the broader markets. That said, the broader markets are underperforming, at least in today's day of trade, because we're just looking at about a 0.5% to a 0.7% advance as far as the mid cap and the small cap indices go. So not as great a day for the broader market indices, but a considerable amount of strength seen in some of your key benchmarks. Now, that's as far as what we're taking a look at. But, I'm going to also now go across to what we are talking about in this show. So we are addressing Suven Pharma. That, of course, is buzzing in trade today. We are also talking about CG Power and a lot of developments coming through from the semiconductor space. We're talking about landmark cars as well. And we are likely to, also address agrotech, of course. That's the other one we're going to keep an eye on. But let's start off with perhaps the biggest movers of today, and that is Suven Pharma. Well, they have announced a merger with Cohance, and Varsha is joining us to take us through all the updates here. Varsha.
So if you see, Suven Pharma has seen an intraday high of almost 13%. Now this is, first let's talk about the multiple large trades. So there have been multiple large trades of almost 35 lakh shares have changed hands. Now the largest trade was at 12.5 lakh shares at rupees 692, volumes were over 30x. Now this intraday high of 13% is on the back of deal announcement, that is company Suven Pharma and Cohance Life Sciences have announced a merger. Now the transaction is expected to conclude over the next 12 to 15 months, and if you see the transaction, almost a shareholder will get almost 11 equity shares of Suven for every 295 shares held in Cohance, and the proposed merger will be double-digit EPS accretive from the first year itself. Now let's look at the revenue split of Suven Pharma Cohance and how the merged entity will look like. So if you see the revenue split of Suven Pharma, so 68% comes from almost pharma CDMO, then 23% comes from specialty chemicals, and 9% comes from formulations. And for Cohance, if you see, 32% comes from CDMO and 68% comes from API and toll manufacturing. And the merged entity will have 3 business segments, that is pharma CDMO, specialty chemicals and API. Now what is the rationale behind this merger? So first is double-digit EPS growth is expected from year 1 itself, as we spoke about. If you see the trailing 12-month EPS of Suven Pharma stands at almost 14.6 rupees. And the second rationale for this is the growing CDMO business of Cohance, which is growing almost at a CAGR growth of 30%. And combined entity will have 1.5x innovator relationships and 2x manufacturing capacity. And if you see, the combined entity will have double the revenue what Suven has. EBITDA margin will be almost 35%. If you see, the EBITDA margin of Suven is almost 40%, but the combined entity will have 35% of EBITDA margin. This is because of low EBITDA margin of Cohance. Also, lastly, if you see analyst recommendation, 2 analysts are have recommended buy call, and yeah, so this is all we have for Suven Pharma as of now.
Thank you so much, Varsha, for those details. Moving on, we have a stock that's been buzzing since the start of the day, which is CG Power. Now it's sped some of the gains, but it did have an intraday high of almost 11%. There you have it. It's 6.23% now. Now, yesterday the government approved to set up 3 semiconductor plants with an investment of 1.26 lakh crores. And CG Power is one of the companies that did get approval. Now, CG Power will enter a joint venture with 2 other companies. One is a Japan-based company called Renaissance Electronics, and the second one is a Thailand-based company called Stars Microelectronics. Now they're going to set up an outsourced semiconductor assembly and test facility in Gujarat, and this plant will have a capacity of 15 million units per day, and it'll produce legacy and advanced packages that will cater to different sectors like the automotive sector, industrial, consumer, 5G and more. Now the joint venture plans to invest around 7,600 crores over the course of the next 5 years, and the construction is set to start within the next 100 days. CG Power owns 92.3% of the joint venture, whereas Renaissance and Stars Microelectronics will own 6.8% and 0.9% respectively. And that's what we had for CG Power. But moving on, we have a company called Landmark Cars, which is also in focus today after the company received an LOI from MG Motor India. We have my colleague Anushi joining us. Anushi, what are the details with the LOI?
Right, Mika. So Landmark Cars, as we know, it has a quite interesting business model, multiple brands in their focus. Now, over here, they have opened a dealership with MG Motors in Ujjain, which marks their 6th dealership in Madhya Pradesh itself. Now, if you have to look at this dealership is in line with their further expansion to add more OEMs and get access to more geographies going forward. So far we have 6 dealerships, as I've mentioned, with the MG Motor. Now, if you have to look at the total brands that contribute to the company's revenue, so Jeep continues to top here with about 23% of revenue contribution coming, then is the Mercedes-Benz, which is 16%. So overall, if you have to look at the company's mix, it is more on the premium side of the business that is quite evident in their trend, and that is what they continue to keep going forward. Now onto the outlook that they have given, more 10 upcoming outlets going ahead, while they are expecting to double their used car business in the next year itself, while this year they're targeting about 100 crore revenue over year. And the premium segment continues to remain on focus. Now coming, just to give a recap on the Q3 performance, the revenue was about 9% up. However, the margins and net profits took a beating here, about margins seeing about a 60 basis point of a decline, while net profit was about 29% down. Onto the stock performance of the company, in this 1 week period, about 5% of gains, while in this 1 month, the company has seen about 7.2% of stock price decline. Overall, in the 1 year period, 37% of gain. So that is all on Landmark Cars for today.
Right. Well, Anushi, thank you so much for joining us and taking us through that large trade coming through as well. And from there on, we shift focus to a stock which isn't doing so well in today's day of trade, and that's Agrotech. Now, the company's entity has decided to sell its entire stake and exit in its India business. We have Mahima, who's joining us to give us all the contours here. Mahima.
Right. Agam, so as you rightly mentioned, the promoter of Agrotech has decided to sell the 51.8% stake that it has. Now, the 26% of stake will be acquired by Samara Capital at a price of 515, which is at 48% discount compared to its closing price yesterday. And the remaining 26% will be done via an open offer, where the price is set at 578 per share. Now, if we see the investors' open offer is also at a 42% discount than as compared to its market price, that closing market price as of yesterday. And if we take the average price of the stock over a period of 1 year, the valuations are at 17% discount as compared to the average price for the last 1 year. Now, the question is that why is Agrotech shares valued at such a low price? Well, as per the press release, the reason that they've mentioned is that the average traded value of shares and the number of shares traded has been very low in the past 1 year. Approximately only 18,560 shares were traded per day, and as per SEBI, if this is the case, valuations will be done using parameters like book value, comparable trading multiples, and such other parameters which are customary for the valuation of the company. Now, if we talk about the stock performance, well, the total number of shares today have been traded in large volumes, around 3.4 times. The shares are touched an intraday low of almost 11.5%. Now, if we see the major shareholders, the free float market of shareholders, Tata mutual funds hold around 7%, Pari Washington holds around 11%, and Rakesh and Rekha Junjunwala hold around 8%. Now, this is important because if we see the free float market has around only 0.15% shares were traded approximately on an average in a span of 1 year. So that is why Agrotech has been down in trade today.
Thank you so much, Mahima, for those details. Whether you have it, Agrotech down around 11%, start and closed yesterday at 1,006 and now it's at 890. But moving on, we do have Heritage Foods, which is trading on higher volumes. Now, the stock has pared some of its gains. It's about 4%, but it did reach an intraday higher for almost 7%. Now, Heritage Foods is a company that processes and procures milk and milk products and also generates power through solar and wind for its captive consumption on its dairy plants. Now, stock is up 7.8% in the past month and around 14% in the past 1 year. And volumes were 3 times this 30-day average today. Total volumes were at 18.06 lakh equity shares, and sellers did outnumber the buyers. And the higher volumes was on a back of 2 large trades where 1.15 lakh equity shares changed hands, and the highest volumes were at a price of 348. A little about the company in its recent quarter 3 earnings. Revenue was up 20% on a year-on-year basis, and this was mainly driven by their value-added products. And EBITDA also was up 60%. Margins did expand, and net profit was up 86% on a year-on-year basis. The average milk procurement, where milk processing and procurement is 60% of their revenue profile, the average milk procurement was up 15% year-on-year at 1.62 million liters per day. In terms of growth strategy, the company is also going to focus on increasing their milk procurement, and this is going to be done by investing on a village level milk collection infrastructure and bulk coolers and chilling centers. They're also increasing their share of their value-added products, which is ice creams and most products, which currently forms only 29% of their revenue contribution. And they also plan to expand their manufacturing facility. Well, that was it when it came to buzzing stocks, and it's time to slip into a short break. But do stay tuned. We have lots more lined up on the other side.
Co-presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on Pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes,
माननीय मुख्यमंत्री जी का अभिनंदन करें। मैं उज्जैन की देवभूमि को प्रणाम करता हूं। भगवान कृष्ण के द्वारा 5000 साल पहले दिए गए गीता का ज्ञान आज भी हम सबके लिए मार्गदर्शन कर रहा है। भगवान कृष्ण ने भी अपनी शिक्षा इसी उज्जैन के संदीपनी आश्रम में आकर ग्रहण किया था। मध्य प्रदेश देश का हृदय है और मुझे ये कहने में कोई हिचक नहीं है कि आने वाले समय मध्य प्रदेश का समय है। हमारे यशस्वी प्रधानमंत्री नरेंद्र मोदी जी इस राष्ट्र को परम वैभव के शिखर पर ले जाने के लिए मेहनत कर रहे हैं। ये साफ दिखाई दे रहा है कि इस संकल्प को पूरा करने के लिए डॉक्टर मोहन यादव जी के नेतृत्व में मध्य प्रदेश महत्वपूर्ण भूमिका निभा रहा है। ऑनरेबल चीफ मिनिस्टर, I'm excited to share the confidence of our nation's business community that you will enable more growth and prosperity for Madhya Pradesh than ever before. And assembled here today are some of our nation's brightest business minds, the team that will build on your vision to transform Madhya Pradesh into India's Mukhya Pradesh. Looking at the range of supportive multi-sectorial policies, schemes and reforms that your government is now pushing forward, it is clear that the infinite potential of Madhya Pradesh is rapidly emerging into the light. I see infinite possibilities of infinite growth, especially in energy and infrastructure. And the Adani Group is excited about investing in Madhya Pradesh. Honorable Chief Minister, currently our presence in Madhya Pradesh spans a wide range of sectors from roads, cement, natural resources, thermal power, renewable energy and power transmission. Our cumulative investment in the state amounts to rupees 18,000 crore, and we have created almost 11,000 employment opportunities across the state. I am delighted to announce that not only will the Adani Group continue investing in these diverse sectors, but we will also more than double our investments in the Madhya Pradesh and contribute in our own humble way to the state's all-round development. Honorable Chief Minister, our faith in your visionary leadership will see us investing close to 75,000 crores in Madhya Pradesh. Of this, 5,000 crores will be utilized to build the Mahakal Expressway from this great city of Ujjain to Bhopal through Indore. We will also invest another 5,000 crores to set up a 4 million tons per annum clinker unit in Chorgadi and 2 cement grinding units in Devas and Bhopal with a combined capacity of 8 million tons per annum. In the natural resource sector, we will invest over 4,000 crores and another 600 crores to expand our presence in food processing, logistics and agri-logistics and the defense manufacturing sector. Our investments in fuel distribution, which includes our compressed natural gas, CGD, LNG, EV and bio businesses, will exceed 2,100 crores, the bulk of which will be used to strengthen our city gas distribution networks in 5 geographical areas of Bhind, Burhanpur, Anupur, Tikamgarh and Alirajpur. Honorable Chief Minister, the Adani Group's biggest investment will be in enhancing your state's access to plentiful, reliable and affordable power. We will invest close to 30,000 crores to ramp up our power generation capacity at our Mahan Energen plant in Singrauli from its current 1200 megawatts to a massive 4,400 megawatts. We will also invest close to 28,000 crores to set up 3,410 megawatt capacity of pump storage projects. In all, our total planned investments of nearly 75,000 crores will generate over 15,000 direct and indirect employment opportunities in a wide variety of industrial sectors across Madhya Pradesh. Honorable Chief Minister, the vision of our Honorable Prime Minister, Shri Narendra Bhai Modi ji, is reflected in your ambitious growth and development plans of Madhya Pradesh. I believe I speak for everyone present here today that under your decisive and inspiring leadership, this state will accelerate faster than ever before on the mission of transformation, industrial development and prosperity for all. The Adani Group is privileged to be a part of this incredible journey you are leading. Thank you. Jai Hind.
Thank you, Mr. Adani, for being...
Welcome back to Large Trades, and we now shift focus to the IPO market. My colleague Sajid Mangat spoke to the management of Gopal Snacks after the company announced its launch of its IPO at a price band of 381 to 401 rupees per share. Here's a slice of that conversation.
So this business started by my father, Mr. Bipin Bhai Hadwani, from very small town called Bhadra, which is situated little bit away from the main city Rajkot, and he used to sell gathia from village with ₹1 at the package of 40 grams, and he knows how to build gathia at the age of 13, and he started selling gathia from village only, and once he completed his 12th, and he asked his father to start a distribution business in village only. So they started distribution among different village in 54 village, and then he asked his father to move to Rajkot, but his father is not willing to let his son move away from village, because he built all these distribution networks. If he moves away, then who will look after the business? There were 3 brothers, but all were engaged in different business in village. So he asked very he was too aggressive for moving to Rajkot, so he then moved to Rajkot in 1990 and started a business of namkeen with investment of 4,500 rupees. So for he run that business for 4 years in Rajkot, and then the both partners, he and his cousin, got separated and started the brand called Gopal Namkeen, which is situated in 1994. And then from 1994 till 2023, we have started with making gathias, namkeens and everything by our own, and we have started with very few products, and then slowly, steadily we have added all the products into the portfolio.
Well, there you have it, Gopal Snacks giving us details about their business. But shifting our focus to another IPO that is coming out, Sajid also spoke to the management of JB Chemicals, Anirudh and Anuj Jhunjhunwala of the company's business outlook. Do listen in.
Yeah, so we are in the business of manufacture of zinc oxide. It's a key ingredient across various sectors, the number one sector being rubber and tire, which happens to be bulk of our business. Zinc oxide is also used by the paints industry, by the pharmaceutical and cosmetics industry, by the nutraceutical industry, by the chemical industry, specialty chemical. It's also used in batteries. Zinc oxide also finds its way in lubricants. So there are a number of uses, one of the other important uses being ceramics. So this is a product which goes in various sectors, and each sector, it has a specific role to play as a raw material for that. So as far as zinc oxide is concerned, the global market for zinc oxide would be about, say about 1.5 million tons, and the Indian market, it's about 130,000 tons per annum.
Right, and with that, it's an end to this edition of Large Trades, but don't go anywhere. We slip into a break, and on the other side, we get you India Markets Close. Stay tuned in.
Co-presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth rupees 16,618 crore was sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties since the interim order of the court, which is April 12, 2019, to the Election Commission in 3 weeks by March 6th. The Election Commission will have to publish all these details on its website 1 week after, that is on March 13th, after it has received all the information. Electoral bonds that have not been encashed yet by the political parties will need to be refunded. For more such updates, stay tuned to NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
or a long-term investment,
all you have to do
is ask Profit.
Welcome, you're watching India Market Close, and what a day it has been. If anyone was wondering this morning what the impact would be of India's GDP numbers for Q3, well, the markets are definitely standing up and celebrating. Better than expected Q3 number above 8.4% has seen the Nifty up 350 points. Right now, close to its day's highest point. The Sensex also up about 2%, 1,100, nearly 1,200 points up on the Sensex. So fantastic day. Now, what happens when you have all-round sort of faith in the economy. Well, the banks shine. Look at what the Bank Nifty is doing today. In fact, we'll pull up all of the indices to give you a sense of what has performed the best in this market, but 2.5% on the Bank Nifty. Metals also looking fabulous. Remember, when you look into the details of that GDP data, the mining sector has contributed the most, also responsible for that push to the headline GDP number. Metals up 3.5%. SAIL completely shining, 8% up on Steel Authority of India, but all of them really in a fabulous way today. Let's pull up the heat map and just give you a picture of what's working in the markets today. And there you have it, Tata Steel right on top of that, JSW Steel, Hindalco. There was a positive CLSA note on Hindalco as well. But overall also your, I would say, old economy, your infra plays are all doing very, very well today. Look at an L&T today. L&T about 4.5% up. Autos have also had a decent day. Remember, first of the month, so auto numbers are out. So M&M in fine fettle over here. Banks, obviously, an HDFC Bank, 1.5%. I don't know if you can quickly see key Nifty contributors, because that will give you an idea of what is moving in that sense. The markets today, and you have an ICICI Bank and HDFC Bank definitely on top of there, an RL and an L&T. Only one other stock I'll talk about is a Dr. Reddy's, which is at the bottom of your heat map as well, and maybe you can pull up that individual stock. There is a litigation that they're facing in the United States. The company has put out a statement saying that they will be facing and challenging all of these in court, that they've done nothing wrong. But that stock seeing a sharp slide in the last couple of minutes. It's all round, though, a good mood, isn't it, in the broader markets as well?
Well, yes, absolutely. Tamanna, that is the flavor of the market, whether news-based or otherwise. It's largely positive, but I'll pick out a few negative pockets as well towards the end of this one. Let me first pull out something like a Suven, CG Power, Paytm, all of those buzzing well in the green. All news-based announcements coming through on three of those. Yeah. There you go, 8%, 6%, 4+%. Dilip Bilcon, let's also pull up a Paytm actually, if we can, and a Wellspun as well. That one also doing quite well in trade, 5% up on both of those. But some pain in the market. Let's pull up the likes of a Biocon, which is down around 1% or thereabouts. Some observations coming through. Within hospital stocks, there is a pocket where there is some bit of pain. There you go, Yatharth, Apollo. They are Yatharth down 7.5% today, but outside of that, Apollo also seeing a mild bit of red. If we can also pull up some metal counters, something like a Moil, it's doing reasonably well. Again, let's pull up something like Tata Steel, which is doing fairly well in trade today. Again, it's, I think, the top gainer on the Nifty 50. There you go, 6.5% almost. So some commodity stocks doing fairly well. Also, if we can pull up a Landmark Cars, that one is also doing very well in trade. It's signed MG for a new distribution network which it's setting up. So that one is buzzing as well. Several pockets which are buzzing, both positive. Negative, lesser pockets, but nonetheless, we have a few pockets there as well, Tamanna.
There's a block deal in Tata Steel, which is why you're also perhaps seeing some activity, about 35.6 lakh shares. Not too much of the equity, 0.03%. But, you know, I was noticing what we're seeing in the mid-cap and small-cap indices. And we'll just pull that up and just compare with what's happening in Nifty and Sensex. Remember the news flow over the last 48 hours or so, with SEBI directing AMFI, that's the Association of Mutual Funds India, to, I would say, signaling a go slow on the vast amount of retail investor funds and that funnel going into small and mid-cap stocks. By force, per chance, you will see a rejig towards large caps. Is that the beginning of what we're seeing? We're going to ask this question to Chakri Lokpriya, Managing Partner, Red Strawberry, who's with us on the show right now as well. Chakri, very good afternoon to you. Great to have you. And what a day. What a day. You have just new highs on the markets. We've started March with a bang. We're ending the week, but we're starting March completely with a bang. Do you buy into that theory that perhaps what we're seeing is also an outcome of smart money looking to move direction?
Good afternoon. Yes, it's a nice day and a nice end to the week, I guess. In terms of how the market is distributed, is you have SEBI-directed large cap, mid cap, and small cap definitions of what should be a large cap and mid cap and small cap fund. So I guess now with in terms of a concentration risk, I don't think that risk actually is that much, given that every single fund out there has a stock and sector exposure limits. So you can't buy a stock more than 10%, etc. There are various limits which are already in place. So I think it's largely well under control. Second is what we can see is multi-cap funds. Now, these company funds could probably increase the proportion they invest towards large cap. But other than that, I think so that, and incrementally, they've also kind of underperformed the mid-cap indices, and for the right reasons. So some amount of flow, yes, to the large cap, I think we should see in the coming days.
Sure. Chakri, a couple of pockets which are doing fairly well in trade, one of them being the bank Nifty. No surprises after the kind of GDP numbers that we saw. Your sense at this point, we're seeing a solid 2+% rally on the bank Nifty.
Banks, both the public and private banks, actually public banks are probably better placed. The PSU banks, like the large cap, like the State Bank of India, or the mid caps like Union Bank, Bank of India, I think all of them are well placed. Now, in terms of ICICI and Axis, they're trading at about 2 times our book. But the growth is largely intact. Yes, you will see some kind of margin erosion going into the quarter, not just in the quarter, into the next couple of quarters. But as and when the interest rate cycle turns, that will be a huge leg up for both private and public banks, the government-owned banks. So I think, as a space, both banks as well as NBFCs are well positioned.
Yeah, maybe NBFC is better than banks at this time, Chakri, given the fact that they will benefit earlier from the rate cutting cycle, if at all.
Yeah, absolutely right about that. And many of the NBFCs, their valuations are all still very much in check. If you look at Shriram Finance, probably at about 1.6 to 1.8 times, depending on the year that you're talking. LT Finance, a number of companies out there whose valuations are very reasonable. And also, these are the companies like Financial Services has kind of underperformed because of the uncertainty towards commercial vehicle growth, etc. Now, all this, come July, after the elections, all various companies will start their capex programs, and therefore the NBFCs will benefit.
Right. And Chakri, one on the macros. Now that growth is firmly above 8 at least, that's the initial sense we're getting, and hoping that it sustains above 8. Do you now start to get a feel that the RBI may start actually cutting rates fairly quickly, or rather quicker, maybe one meeting quicker?
I think to an extent RBI is held hostage to what the US Fed does. And so until we see some kind of clear direction, which now seems to be probably about June, is when the US will start beginning to cut rates, hopefully. I think we will also wait, RBI will also wait until then because they have to take into account the real rate differentials.
The other big story, of course, apart from banks, is metals. Complete run-up over there. Before we go to the stock of the day, which is CG Power, Chakri, I just want to get a sense from you on what are we seeing. We know now there is, a block deal perhaps in Tata Steel, but SAIL up 8-9% today. JSW Steel, the entire pack. Is this a China play? Is this, again, if you are betting on a booming economy and obviously more infra spends, more construction, then steel comes into play. How are you looking at it?
Steel companies are, as you know, very cyclical in nature. And given the fact that we are close to the peak of interest rate cycles around the globe, and as the interest rate cycle starts to come down, which is probably May, June timeframe-ish, cyclically, these companies benefit the first, the metal companies globally. And I think, so that's why you're seeing companies like Tata Steel, Hindalco also participating. And yes, you're absolutely right. Infrastructure spend is taken center stage today in India, and that will contribute big time to the steel consumption volume growth, as well as steel and other metal volume growth in India as well.
Okay, so those are some of the quick buzzers in trade. Let me quickly take it across to another one which is absolutely buzzing, CG Power. Now, roughly 75,000 crore in market cap. It's signed a joint venture agreement to build, operate and outsource semiconductor facilities, say 7,600 crore to be invested. Mihika has all of the details on that one. Mihika.
Yes. So on Feb 29, the government approved 3 semiconductor units, and these units were approved under India's semiconductor scheme, and the investment outlay was of a total of 1.26 lakh crores. Now, 2 of the units were given to unlisted companies of Tata Group, but 1 was given to CG Power, and now CG Power will enter a joint venture with Renaissance Electronics, which is a Japanese-based semiconductor solutions provider, along with Thailand-based OSAT provider Stars Microelectronics. Now, a little bit about the joint venture. They're going to set up an outsourced semiconductor assembly and test facility, and this facility will be set up in Gujarat and will have a capacity of 15 million units per day, and it will produce legacy as well as advanced packages which will cater to industries like the consumer industry, industrials, automotive and 5G and more. Now, the construction is expected to start within 100 days and will have a direct employment of 20,000 advanced tech jobs and 60,000 indirect jobs. About the contribution and the investment, now the JV plans to invest 7,600 crores over the course of 5 years, and this will be financed via a mix of subsidiaries, equity and bank borrowings. Now, CG Power will have 92.3% stake in the joint venture, whereas Renaissance and Stars Microelectronics will own 6.8% and 0.9% respectively.
Right, thanks so much for that context, Mihika. Now, before I go and delve in more detailed or have a rather more detailed discussion on CG Power itself, let me welcome on board Ruchit Jain. He's the CMT lead research analyst at 5paisa. Ruchit, you know, again, before I go to CG Power, let me put this question to you. Markets doing extremely well this Friday. It's been a wobbly week, but we're doing very, very well. Of course, outside of the growth numbers that have come, which is a big positive overall, what's the sense with regard to charts now at this point?
Yeah, very good afternoon. Well, I think markets have gone through a decent consolidation phase of about 1.5 months. Markets were in an uptrend till the month of till the mid of January, when we hit that 22,120, 130 high. After that, although we had formed a new record highs, but if you look at the momentum was not very strong. So primarily the broader markets were not doing well. And this entire last 1.5 months, the index has gone through some time-wise corrective phase, wherein any declines which were there in between, they managed to find support around the 40 days exponential moving average, and we again used to witness a bounce back. So today clearly seems to be a resumption of the broader degree of trend. I think that 40 EMA which I am talking about, that is now shifted to around 21,800, 21,850. So positionally now that will be seen as a very strong support. And even if you look at the data, then the rollover data, if you look at the derivatives data, then rollovers in Nifty were in line with the average. A bit lower rollover in Bank Nifty indicates that more room for fresh long formations are there, and that's what I think we are witnessing in today's trading session. So I think broadly 1.5 months of time-wise correction is done, and we have resumed the uptrend. Now, until we see any kind of reversals or important support breaking again, I hope the momentum continues in the March series on the higher side.
And Ruchit, with regard to the Nifty Bank, what are the key levels?
So Bank Nifty, I think, would play an important role in March series. Primarily an underperformer, I would say, in last few months. Because if we compare the all-time high of Bank Nifty, then last all-time high in Bank Nifty was made in the month of December. While Nifty has made a new high, Bank Nifty is still far away from that level. So I think somewhere a catch-up move would be seen in the Bank Nifty index. Support has been formed around the 46,000 mark, and which is around its 89 EMA. And if this remains intact, then we could see a pullback move again towards 48,500.
Okay, so those are the levels. We'll have a larger discussion with regard to Ruchit's picks, as well as have a discussion with Chakri and Ruchit with regard to CG Power as well. But we'll slip into a very short break. We'll have all of that on the other side of this break.
Co-presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stemmed from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Markets in a fabulous mood. 22,300 conquered with ease, coasting along, no stopping the markets today. The Nifty about 350 points up. Absolute run up. Fabulous start to 1st of March and the series as well. We'll get you the FNO trade in a bit. But let's figure out what are the big news makers and volume buzzers in trade today. Anushi joining in with that list.
Right, Tamanna. So, right, We have Pharma as a top volume buzzers, about 32 times the volumes. It's 30-day average, while the stocks saw about an intraday high of about 13%. Now, this is on the back of the news that the company has announced its merger with Cohance, over which the company is expecting about a double-digit EPS accretive margins going forward to next year. Second one on the list is CG Power over here. Again, a 12% intraday high, about 6 times its 30-day volumes. This is after the government has approved 3 semiconductor units with an investment of about 1.26 lakh crore, over which CG Power will invest up to about 7,600 crore in a period of 5 years. Next, moving on to Jamna Auto, multiple large trades in this counter with an average traded price of about 129, 5 times of volumes in this counter as well. Next is Landmark Cars. Now, this was on the back of the news the company has received a letter of intent from MG Motor India for opening a dealership agreement in Ujjain, Madhya Pradesh. This now marks their 6th dealership agreement over there, and if you have to look at, the company continues to remain in its focus in the premium segment. Even if you have to look at its revenues, the company's Mercedes and Jeep brands mark the top revenue makers for the brand. Now, lastly on the list is Max Healthcare. Now, the hospital stocks continues to beat in red for the second straight day, with the stock being in negative territory. This is after the Supreme Court's crackdown on the government, asking about the discrepancy that we are seeing in the charges by the different sectors, that's the private versus the government. So these are the top volume buzzers we should be looking out for the trade today.
Perfect. Thank you so much for that roundup, Anushi. Now, before I go to some of the other volume buzzers, let me first take up CG Power, because I've been wanting to have this conversation since a while. Chakri, your views with regard to the semiconductor industry, a 7,600 crore investment, what's your sense?
It's a fabulous development for India. And, the semiconductor testing is a very large, long gestation market space. And so in terms of India offering, the government offering subsidies is very important. And that kind of, improves the margin profile for companies like CG Power who are entering into this space, which allows them to compete globally, because the cost of capital differences between India and other countries is quite significant. In the West, the cost of capital is far lower. And so therefore, the government subsidies play an important role. And second, the marketplace is truly global. So whether it's the Indian various consumer appliances, which all use various bits of semiconductor, so both domestic revenue and export revenue potential is huge. The lead time is fairly large, but I think, it paves the space way for the from fab testing to go on to the next thing of maybe fab building. But I think it's a wonderful thing, and CG Power will do well as a stock.
Right, Chakri, just want to try and play devil's advocate here. CG Power trading at, 80 plus times earnings. Is it a good time to be invested in a company like this, or is it time to take money off the table from a fundamental standpoint?
Good question. These kind of companies are clearly, one needs to look at it from a long-term perspective. Because fab construction and all the semiconductor space is first the investment phase, and which translates into revenue much later, a few years down the road. So I think that's the way to look at these stocks, but these are rather than looking at the near-term valuation multiples of the stock.
Fair. Ruchit, your views, how does this one look on charts?
The broader chart sectors are positive for the stock, and we have seen a good support base getting formed around that 420 mark. Now today, although we had a gap up opening, the volumes are quite strong post the gap up opening. So I think until the stock is trading about 420, I think positional traders did not worry much about that. So if any existing long positions are there for positional traders or investors, I think they should continue to ride this trend.
Sure. Thanks so much, gentlemen, for those views. Another one which is buzzing on the back of major news is DRL. I have Varsha standing by, who's with all the details on that one, down 3.6%, Varsha, in this market.
Yeah, Harsh. So as you rightly said, so this stock is under pressure. Now this is on the back of a complaint which was filed in New Jersey's district court. So the complaint was filed by Walgreen Company, Kroger Specialty Pharmacy. Now it claims that company has improperly restrained a competition, maintained a share monopoly. Also, there's a challenge agreement delayed generic entry entirely until 2022, and complaint alleges that challenge packs improperly limited generic competition through 2026. Now, if you see, they seek damages for purported overpayments and equitable relief, and court has consolidated lawsuit with several other lawsuits making similar allegations against company. Now, if you see, a company believes that allegations were against its lack merit and will they will actually defend the litigation. So we do have all these things as of now.
Right, thank you so much for that, Varsha. Now, I'm going to talk about DRL in just a moment because you have TVS Motors numbers flashing at the bottom of your screen in terms of where the sales numbers stand. The stock is up 4% on the back of that. If we can have the graph on that one, you'll see that the spike is in the last 10 minutes or so is where we've seen that spike. EV sales up 16%, three-wheeler sales up 16% as well. That's where we're at where TVS is concerned. But Chakri, back to you on DRL. Of course, this news may be a bit of a dampener, but what's the sense with regard to the overall business that DRL, I mean, fundamentally extremely strong. And therefore, at this point, what should your viewers look out for in terms of risks, given the kind of upside we've seen already?
I haven't really evaluated the current latest announcement, but, this is an industry which is fairly well litigation prone. And, pricing, because the generic prices keep dramatically falling depending upon patent expiry, etc. I think that is, and DRL has a very good legal team, very well entrenched and understand the space well. So I wouldn't, so that I would guess is a part of doing business in this space. Outside of that, I think the company's pipeline is very strong. It's well positioned. Yes, the stock has run up, but I think, in the US as well, right now you're seeing a slightly improvement in pricing over the next 1 year or so. That is pricing of the generic products, that is. So I think that way DRL is fairly well positioned. And this news, of course, I need to evaluate some more.
Absolutely. On the charts, anyway, there's a lot of pain that we can see. The stock 3.5% down, and sharpest bit of that fall in just the last 20 minutes or so. The rest of the market, they're doing very, very well. And those auto sales have actually, given that extra last rev that the market needs in a sense. So look at that bigger picture developing over there. You have an economy that is, booming right now, while the rest of the world is seen in pain. It's going to benefit construction, infrastructure, steel, cement. Of course, nothing moves without the financial pack moving, and auto as well. So all of that playing out today in positive sentiment in the market. We'll take a very short break, but on the other side, we get you the top BTST, actually buy today, sell Monday ideas, if at all, and what's happening in the F&O side of things.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article
Right, welcome back. You're watching India Market Close here on NDTV Profit. Thanks for staying with us. Let me quickly take it across to the big wig of the Nifty 50. We have Larsen & Toubro. Government has awarded a major contract for supply of high-power radars to the Indian Air Force. Stock is up nearly 5%. Now, HPR, which is the high-power radars, are a static sensor for long-range aerial surveillance with higher uptime. Also, they had won a major order for supply of indigenously developed close-in weapon system for the Indian Air Force. And it's also commissioned its first indigenously built hydrogen electrolyzer at Hazira. All of that really pushing the stock higher. I want to try and take in some inputs from Chakri. Chakri, Larsen, we know, has been investing in defense for quite a while now. It's not new that that they are big in defense, but essentially the orders have started to trickle through now. 4% higher. Does that merit the kind of rise that we've seen today, or is it also a lot of bullishness around the stock that we're seeing today?
Larsen & Toubro is clearly well positioned to benefit from the new thrust that the government is doing in defense. The company has invested a lot and now is beginning to see orders. And the good news is, we're going to see orders not just from the domestic, but also export orders. And the company's valuation is still, of course, if you look at some of the parts of the company, is still very, very reasonable. And it is a company, right from the infrastructure space, in one in almost every 4 orders comes the Larsen & Toubro way. So that way, if infrastructure of the country is growing, and we are seeing the actual numbers show up in GDP as well. So I think L&T is well positioned both from defense as well as the infra spend.
Point taken. Before I go to Agam for the FNOQs, half an hour from close, less than half an hour from close now. Let me take it across to Ruchit as well. Ruchit, 4% higher, 4.5+% higher on Larsen today. How is it looking on charts? Because we saw a sharp cool off in Larsen. If we can pull up the 3-month chart on Larsen & Toubro, we'll see that there was a bit of a cool off in the middle, and we've again seen Larsen start to gain traction. What's the sense now on charts?
So broader trend certainly remains very strong. We had seen some correction in the first half of February, but in this correction too, the 100 DMA technically acted as a very good strong support. The stock consolidated over there. The momentum readings which are overbought, they cooled off, and it has resumed its broader uptrend now. So I think the stock should continue to head higher. First, towards the previous swing high of 37.30, 37.40, and once that is surpassed, I think 3,900 to 4,000 could be expected in short to medium term.
All right, going all the way up to 4,000. Thanks for that, Ruchit. Agam, standing by with regard to FNOQs. Agam, what is the FNO data showing us today? We're 1 day post the expiry, and we're doing very, very well.
Yeah, what a day it's turned out to be. And well, It's about 1.5% gains for the Nifty, about 2% gains for the Bank Nifty, and surging ahead. And we have seen considerable strength in today's day of trade. In fact, 1.6% as we speak. So the Nifty has actually taken out the previous high. It's also taken out the resistance of around 22,200, the recent resistance. And along with that, we haven't seen as much addition in OI just yet. But, well, longs all the same. For the same as for the Bank Nifty is concerned. Let's move on and talk about that one. The March futures certainly looking at, so the futures itself are not looking at substantial increase or decrease. And mind you, the March futures are currently going at a discount as compared to the Bank Nifty, still, which is up as much as 2.5%. The question is, are we likely to see some profit taking, at least in the near term? That is something that we will keep an eye on. Now, in terms of how things have panned out, look at this unwinding as far as calls go in the Nifty. Even as you see it move sharply above the mark of 22,000, gaining well over 300 points, completely taking out all the call writers, all the writers who've written the 22,000 call. And of course, on the higher end, we're starting to see more and more put writing around the 21,100, 21,200 puts as well. In terms of your overall open interest, well, we are now suddenly starting to see a considerable spurt in puts as compared to calls. So, and once again, no prizes for guessing. Well, it will be around 20,000, 20,100 and thereabouts as far as puts go. On the higher end, we're now starting to see a shift well above the mark of 22,500, 22,600. In fact, now we're starting to see activity around 22,800 as well. So a lot of interesting levels to keep an eye on at the moment. In terms of stocks, watching out for sale, Torrent Pharma, ABFRL and TVS Motor Company looking at fresh longs, and short covering for SBI, Hindalco, IndusInd Bank and PFC. So a whole host of these counters advancing in trade with a favorable advance to decline ratio as well, and certainly turning out to be a tremendous Friday after what has been considered to be an extremely volatile week as far as expiries go. Well, here's to starting March on a bang.
Well, absolutely, it's a banger, and we're hoping that March continues this way. Thanks for that, Agam. And of course, Agam's going to join me as co-anchor shortly. But while we are at it, let me quickly also take it across to a couple of stocks, other stocks which are buzzing in trade. Let's pull up some of the hospital stocks which are doing fairly weakly in trade. In fact, we had Apollo Hospitals apart. There you go, 3% lower on Narayan Hridayalaya. We had the management as well talk to us earlier, and we'll pull out a slice of that conversation we had. Fortis Health is down 2% as well. So some of the hospital counters facing some pressure after that Supreme Court directive to the government. Medanta also seeing some pressure. Max Healthcare down 7%. Wow. So let me first take it to we spoke with Viren Shetty, who is the executive vice chairman at Narayan Health, and here's what he had to say. Here's what he had to, rather he told us about how this could impact margins, this Supreme Court directive to the government. Listen into that.
See, the truth also is that what is the nature of the thing that they want? Does the government really want a uniform price for every single procedure across every single hospital, no matter the quality, no matter the infrastructure? In which case, yes, there will be a tremendous impact. This will be impact on the scale of what this country went through in the 50s, 60s, and 70s, where the price of everything was fixed. So what happened is the supply naturally came down. There has been an explosion in private healthcare because there's an unmet market need, and there is, in our country, an ability for people to get healthcare at the price that they can afford for most people, not for everyone. So if you disincentivize investing in quality, investing in high-end infrastructure, then you won't see any more of that anymore. So it will be a massive impact if you fix a common price for everything, no matter what.
Sure. Chakri, give me a viewpoint of yours on this one. Of course, are we really headed in a direction where hospitals will actually have something like an MRP on some of these procedures that they have? Is that a realistic possibility here in India?
To begin with, it's a very unreasonable ask by because India has one of the lowest hospital beds in the world. Forget about in advanced countries. You look at a country like Taiwan, Korea. India compares very poorly in terms of, and that's simply because there aren't enough government hospital beds out there to take care of the patients and the population. So private healthcare clearly has a cost of capital which is far higher than what a government can do, and various things, right from infrastructure, quality, doctors, etc. And it is risk capital. So I think it is a very unreasonable ask. So it's doubtful that it can be implemented in its current shape and form.
Sure. Chakri, point taken. Let me also ask Ruchit. Ruchit, with some of these hospital stocks, how are technicals looking now that we've seen a decentish correction? How would you trade these?
Momentum readings has given some negative flows in stocks such as Apollo Hospital, Narayan Vidalaya. So this clearly indicates that there is a possibility of some relative underperformance in the stocks. I'm not sure whether we would see any significant price-wise correction further from current levels, because good amount of support is seen around 5,800, 5,700 range in Apollo Hospitals. So I think we have already seen some price-wise correction from the highs in last 3 to 4 trading sessions. Now the stocks might go through some consolidation phase where they would trade within a broad range, but compared to the market momentum, I think they would show a relative underperformance. They won't see any catch-up move, what we are looking in the broader markets. So I think a relative underperformance could be seen, and one can avoid the sector if one is looking from a very short-term perspective.
Okay, point taken, Ruchit. Let me also quickly check. We also had spoken with the management of Welspun Enterprises. Stock is rallying on the back of 4,100 crore rupee order win. Now it's a water treatment plant, and Agam, this is a 4,000 crore market cap company.
Yeah.
And they've won an order of 4,000 odd crore.
Yes.
And that's quite massive, right? Yeah. And you spoke with the management. You caught up with the managing director, Sandeep Garg.
Yeah.
Let's first go listen into a slice of that before we have a larger chat on that one.
Sure.
It's a 4,100 crore plus order. This order is also very important from a strategy point of view, because we want to build the company into providing solutions for all the water related matters. So we are already in distribution, we are already in the sewage treatment plant, and now it is an addition into water treatment plant as well. So this is strategically covering another sphere for us, which is important. In terms of this particular order of 4,100 crore plus, this order is divided in 2 phases. One is a design and build, which is 4 years, and then a 15-year O&M period. Important point that I would also want to mention is that these prices are escalating prices based on indices. So the current order value of 4,100 crores when we actually end up executing would be much larger.
Okay, so in the end of the third quarter, you had indicated that you're likely to get orders worth about 6,000 crores in the final quarter of this financial year. It just so happens that the final quarter tends to be fairly largish because a bulk of the awarding of these orders comes through in the last quarter seasonally, not for you necessarily, but for the sector in general. Now, from what I make is that at the end of the third quarter, your overall order book stood at around 8,500 crores. My first question then is that what is your current order book? And my second question is that does that mean that based on the kind of pipelines, and we have still a month to go, we could potentially see a higher than anticipated order flow for the fourth quarter?
So the current order book as it stands is about in the ranges of 12,500 crore plus. It is not accounting for the execution that has been done in the January and February. But yes, we would anticipate at least one more order before the quarter ends. So I would not say that I would want to change the guidance to any higher number, but I'll be happy if we are in the ranges of 6,000 crores and there around.
Right. Well, that's the management of Welspun Enterprises telling us about all that is in store in FY25. But we are getting the monthly numbers for Maruti Suzuki, and the total sales have risen 15% year on year for the month of February. And what's really standing out in this case, in this particular month, is the exports growth of as much as 68% year on year. The domestic sales, of course, have risen about 9%. So a bulk of the growth is being provided by exports. Now, remember that, and I am looking at the numbers right now, there has been some amount of weakness in the mini segment and the compact segment. On the other hand, what's really picked up considerably is the utility vehicle space, and well, vans have seen a little bit of growth as well, but it is essentially the Brezza, the Ertiga and the Grand Vitara which have provided the bulk of the growth on overall basis, and that's the reason why we're seeing that surge in volumes. I take that a lot of this will have to do with that 68% growth in exports, and we do know that Maruti Suzuki has laid out plans and in fact executed considerably over the past 6 months to a year, and that's probably the reason why you are getting the numbers that you are right now. Of course, Maruti is currently trending higher by around 1.5–2%. And okay, we also have the numbers from Volvo Eicher, where the total sales are looking at just about a 2% increase on a year-on-year basis. So not an amazing month as far as volumes go for Volvo Eicher. And remember, this is the commercial vehicles business, not the motorcycle business. We are still awaiting those numbers. And production has risen by around 8.7%. So we'll be keeping an eye on a whole host of these auto companies coming in. Among the auto pack, I'm just going to take up Maruti Suzuki once again and see how things are panning out. And maybe we can take this up with Ruchit, because what we are seeing is that sharp surge of as much as 3% at the moment as we speak, and it is moving towards the recent high it's made. And I need to still ascertain if it's a life high or no, but it's still moving up significantly high. Ruchit, if you're with us. Okay, I believe we have a technical problem here. Well, in that case, let me take this up with Chakri. Chakri, looking at reasonably good numbers as far as Maruti Suzuki is concerned, it's also inching towards a new life high. Hasn't made one yet, but it's it's nearly there. Your view on Maruti Suzuki, and what would you do with this one?
Maruti, I'd continue holding it. I'll buy it also for the longer term, simply because the volume. If we've seen the volumes have come through, I think the cycle will further continue as we go into the next quarter, because hopefully by the time we hit July onwards, interest rates will start coming down. And that will play also a big role, because EMIs, etc., for higher purchase vehicles will come down as well. And I think the auto pack is in itself looking strong, both for its existing vehicle sales and, of course, the future growth going to come from EVs.
Sure. Chakri, couple of other numbers that have, or rather a couple of other companies that have posted good numbers. You have the likes of a TVS, very, very strong in terms of export. That one is also flying away in trade as we speak, 5% higher now on TVS Motor. In fact, the whole auto pack is a buzz, and Nifty Auto is up now 2.3% almost. So clearly doing very, very well. Outside of Sona and MRF, pretty much all constituents in the green and well in the green. Look at Bajaj Auto, 1.7% higher. Now, domestic two-wheeler sales grew roughly 42% for Bajaj Auto, around expected lines. Two-wheeler exports, though, up 8%, much better. So export seems to be the flavor this month, Chakri. Can this sustain is the question in an environment which you had someone like a Bharat Forge come in and talk about how there is a little bit of apprehension for them, especially where exports are concerned. Do you think that this is sustainable, the export numbers that are coming through?
Two things. One is, of course, the domestic is always a function of, it is a multiple of the GDP growth. So as the GDP accelerates, the volumes of the domestic vehicles will accelerate faster, much higher than the GDP growth rate numbers. Second, globally, we are actually at a cyclical peak of interest rates, which means at a cyclical bottom of each respective economies. You take any of the countries that TVS and Bajaj and they all export into, all these countries have not done well economically. So, as interest rates are cut globally, their economies also will see a revival. And one of the first beneficiaries worldwide is autos as interest rates move down. So I think that way, the auto companies, both domestic, export is looking good.
Right. Chakri, we've been talking about GDP growth. We've been talking about consumer discretionary showing a lot of strength off late. Of course, the auto sector has also been one of them which has been seeing advances. But staples has not really, moved up. At a time when you do see GDP estimates beat, or rather GDP numbers beat expectations, the demand specifically from rural areas continues to languish. Under that backdrop, two of the largest FMCG companies like HUL and ITC haven't really done well of late, and in fact we are also seeing a little bit of a decline in terms of returns with respect to the Nifty. Is this a time where you could find some value in these FMCG stocks, or do you think that you want to wait before you start seeing improvement in terms of volumes going forward?
I think I'll wait before we take any fresh positions in FMCG for the simple reason that, one, as you rightly mentioned, the volumes are weak. And second, if you look at, of course, ITC is far more simpler. Cigarette volumes have kind of tapered off. So the expectation is there'll be a pickup at some point. At some of parts business, its FMCG business is doing okay, but it kind of is all reflected in the price. And the overall earnings slowdown that ITC is seeing is because of its cigarette business. Second, HUL, no major product innovation, rural is still hurting, and therefore the multiples are right up there. And, the consumption pattern in this country are changing. People are you see in autos. So incrementally, whenever there is an ability by the consumer to buy on these newer things like mobile phones, automobiles, or a new gadget, electronic gadget, so the consumption basket itself is changing, and we need to be aware of that. So I wouldn't buy into FMCG yet.
Right, Chakri not willing to buy into FMCG yet. Ruchit, what are the interesting counters within the FMCG space that you're liking on charts?
So I think relative underperformance has been seen in FMCG space over the last few months. I think still a bit of time-wise corrective phase could be there. But just if one wants to trade for a pullback move, then HUL can be one stock where one can trade from a very short-term perspective. But as I said, not for any significant up move, but just from a trading pullback move. Because the stock has been in the oversold territory since last few days when the stock has shown some correction. And now the momentum readings have given positive crossovers on the daily chart. So pullback move towards 2480, 2500 could be seen in the near term. So if one wants to take any trade from the FMCG basket, then HUL provides a good risk-reward ratio over here.
Okay, well, we're just about 6 minutes from close, and it's turning out to be a fantastic session for a lot of bulls out there. So I'm going to take a moment to take, buy today, sell tomorrow ideas, and we can, in fact, go ahead and do something like that, because tomorrow is, I would say a partially working trading Saturday, because the markets are open for two distinct sessions tomorrow. So Ruchit, any ideas for BTST?
Let me first give a disclaimer that shares that will be bought today cannot be sold tomorrow on Saturday's trading sessions, being the settlement being on the same day. So idea is from the banking space, but one can either buy in the future segment or hold it till Monday. I think that should be taken care of by a short term by BTST traders. And ICICI Bank would be my call to go long on. So Nifty Bank Index has given a breakout from its consolidation phase today. So I think a lot of the private sector banks which have shown a recent underperformance in last few months, I think they can show some catch-up move. And ICICI Bank, if you compare the stock within the other names from the private sector space, then clearly outperformance has been seen today, where previous highs has been taken out, good price volume action, long formations, everything is there to assume that the stock would continue its up move. So one can go long on ICICI Bank with stop loss below 1060 and expect targets around 1130 to 1120 range.
Okay. All right. Want to also address what's happening with Tata Steel, because that's clearly the stock of the day. You know, it really doesn't come through in terms of the key contributors to the Nifty, but it's up a whopping 7% as we speak. And it's not every day that we see Tata Steel advance so much unless there's some big news around the sector or the company itself. And JSW Steel is the other counter, the other steel counter, which is the second on that top gainers list for the Nifty. So both these stocks are a buzz. Richard, back to you on both these counters. Your view going ahead.
So broadly, we have seen that the metal space has been have shown a good outperformance today. And stocks such as Tata Steel has given a breakout from previous highs, indicating resumption of the uptrend. Even sales, the price volume action is quite strong post the recent corrective phase. The risk reward ratio is also favorable in for long positions over here. So I think for the coming week also, metals could continue to be in limelight, and we could see some decent outperformance, especially from the steel related names. Even if you look in today's trading session, from the entire market, from the entire metal basket, those companies, which are steel business, they have been showing an outperformance. So I think this outperformance could continue in the short term.
Chakri, your sense with regard to some of these metal counters, growth extremely strong. Does that mean metals will do well?
Metal companies cyclically have slowed down. The valuations also are very attractive as a result. EV, EBITDA, they're not trading more than 5 times the large cap ones. And if you look at Tata Steel or Hindustan, they're trading at about 5 times. If you look at the mid-cap companies like Lloyds, Metal and Energy, they're trading at only at about 4 times EV EBITDA. So in a cycle, as the cycle unfolds, as interest rates are cut and global growth starts reviving, etc., they start trading back at about the large cap at about 7, 8 times, the smaller cap at about 5 times. So there is still sufficient room for upside in these stocks.
Okay. Well, we are just about 2 minutes away from close. So I'm going to take a moment to thank both Chakri and Ruchit for joining us and taking us through their views on the markets. It's a working Saturday for at least most of us tomorrow. So that's something that we need to keep in mind as well. But, as far as the indices are concerned, what a whopping move for the Nifty. 340 odd points advance coming through, and well, clearly conquering the mark of 22,300 at the moment. That's likely where we are going to close, around there. The Sensex as well is advanced significantly, about 1,150 odd points moving up. I want to take a look at the Bank Nifty, because that's where we are seeing substantial gains, right? 1,100 points up move there as well, and on the back of and good contribution coming in from names such as ICICI Bank as well as HDFC Bank. Well, what do you know? So ICICI Bank is advanced by as much as 3% now, and HDFC Bank is once again above the mark of 1,400 rupees per share, and it is up around 1.7%. In fact, that is where the bulk of your up move is coming from. It's a key contributor there, because a 2% up move for something like an HDFC Bank would mean substantially for the key indices. But let's take a look at the heat map now and see where a substantial amount of gains come through. We've been talking about Tata Steel, and we've been talking about JSW Steel as the top 2 gainers on the Nifty, and L&T in fact is now starting to contribute too on the advances. We've started getting gains in Titan as well as something like a Maruti Suzuki as well. Of course, Maruti Suzuki reacting to the kind of volumes that we've seen for the month of February. This also does indicate some gains coming in, and we have over 2% gains for at least the top 20 of the overall 50 stocks on the Nifty 50. On the other hand of the spectrum, significant weakness in Dr. Reddy's after the developments that we've seen with respect to the US and one of the courts ruling Dr. Reddy's as a defendant in a certain case. But besides that, we've seen a little bit of weakness in something like an Infosys and HCL Technologies, and Sun Pharma and Cipla potentially looking at just a little bit of profit taking, even as we start seeing a lot of advances coming through there. So plenty of stocks out there to keep an eye on, of course, and we continue to keep an eye also on the metal sector, which has, of course, been moving from strength to strength. But what are you noticing in terms of the broader markets, Harsh?
Well, absolutely. Broader markets not as strong in terms of their rally today as the benchmarks themselves, Agam. There you go, 0.9%. Nothing to complain about though, because the broader markets have done very, very well over the last year or so. Let's, before I talk about some specific stocks within the broader markets, let's quickly also pull up the sectoral indices and see what patterns are playing out over there. You're seeing Nifty Metal doing very well, banking 2.5% higher, auto now settling in, or rather closing in 2.5% higher as well. So very strong close for auto. Among the losers are the defensives, IT and Pharma. Media also 0.9% or so lower, but that's been the state of affairs in media, isn't it, Agam? Quickly taking it to a few stocks which are on my radar. Let's pull up something like a Suvain. It's done very well in trade today. Let's see where that one is settling or settled down at close. There you go, 12.5% higher on Suvain. CG Power, Paytm, Dilip Buildcon, we can quickly have those flashing, 4.5, Paytm 5, not bad. Dilip Buildcon as well, 5, nearly 5% higher. Wellspun, and some of the losers as well, something like a Biocon, some hospital stocks. Let's quickly see where probably a Medanta is closing. Apollo Hospitals around 1/3% down. Medanta, which is Global Health, Vedanta up 1% as well, but there you go, 3.5% lower for Narayan. Global Health down 4.5%. Let's also pull up something like a Yatharth, because that was down nearly 10% when we started this show. Okay, so settling down roughly 6% lower. Among the gainers and losers within the mid cap, let's pull up something like a SAIL. Oil India Limited, it covers of course steel, Oil India, energy is done very well today as well, and something like a Tube Investments, that one also closed sharply higher in trade. Among the losers on the mid cap, you had Max Health doing badly, again hospitals, PB Fintech, which has done badly, and Z has also performed poorly in trade today. Data patterns, Metropolis, IFL, all three doing very well again in trade today within the small cap space, Agam. And then you had Medanta, Amber Enterprises and Jyoti Labs, which were the three key losers on the Nifty small cap.
Right.
But with that, we're completely out of time on India market close. We'll let you go on that one. But stay tuned to NDTV Profit. We have an exclusive interaction with Ashwini Vaishnav very, very shortly. So stay tuned to NDTV Profit. But for now, from Agam, myself, everyone who puts the show together, as well as Tamanna, thanks so much for watching.
Co-presented by Patanjali Honey, world's best Patanjali honey, 100% proven on more than 100 parameters of purity.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit.
And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phases of Amul do you remember?
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the
Don't listen to anyone and everyone.
Welcome, you're watching Market IQ this Friday evening on NDTV Profit. Thanks for staying with us. Quick check on where markets have closed. 1.6% higher on the benchmark Nifty 50. We've done very well after that GDP number of 8.4% that we got late last evening. In terms of the gainers, Tata Steel up nearly 7% in trade. Nothing really specific on the stock, but it was up and alive, 6.5% on your screen. Also, you had Larsen & Toubro up 4.5%. Plenty to talk about there. The defense play, which is starting to kick through. Also, the energy play, which is kicking through as well. JSW Steel doing fairly well. Those were the three top gainers, out of which two were steel, mind you. And that's how metals did. Let's pull up the metals constituents, the Nifty metal constituents. And what you will see, therefore, is a stack of green in front of you. Starting off, SAIL up nearly 10% in trade today. You had Welspun Corp, Ratnamani Metals, Nalco also contributing substantially. Hindalco was up 3% as well. So that's the metals pack. Let me also take it across to the Nifty Bank, which was up 2.5%. Who gains when the GDP does well? Well, it's the banking sector. Up 1,000 points on the Nifty Bank, 1,166 points in terms of the gain. And let's pull up the Nifty Bank constituents to get more perspective. There you go, led by IndusInd and ICICI, 3.5% nearly on both of those. And you also had the PSUs contributing 2.5% plus on both PNB and SBI. But outside of that basket, you had Axis, Kotak, Bandhan, Bob, HDFC, all of which were in the green. In fact, within the top contributories on the Nifty 50, you had HDFC and ICICI Bank, both of those contributing to over 100 points on the Nifty alone, only these two. So clearly it was a day for the banks where we saw plenty of cheer on that count. Let me also take it across to some of the other sectors. The Nifty Auto was in focus. Several sectors in focus really. One on the GDP side of things, the other on the auto data which came through, very strong exports data which came through, and therefore Nifty Auto was buzzing. Several of the auto constituents have done very well in trade today. We had just about 2 declines on the Nifty Auto, which was Sona BLW and MRF. But outside of that, you can again see a stack of green there on the Nifty Auto, 1.5% plus across the board, all the way to nearly 6.5%, where Tube Investments sits the highest gainer on, or the top 3 gainers on the Nifty midcap as well. Tube Investments has done very well in trade. Let's also pull up the broader market, see what's happened there. Let's pull up the BSE or the NSE 500 and see the top gainers and losers over there. There you go. You had Suve and Pharma. Plenty of buzzing stocks here to talk about. You had Suve and Pharma up 11%. And we had Metropolis Health up 6.5%. And in between those, you'll see several stocks, including Oil India. We'll talk about Nifty Energy in just a bit. But Oil India also up nearly 8%. Who were the losers? And this is something that we need to really mark out. Because you'll see those top 3 losers being hospital stocks. No surprise there, after a possible government intervention on pricing in certain procedures which may be capped, and that will definitely have an impact on hotel stocks. We had a chance to speak with Narayan Ridalai, and that counter was also beaten in trade, but not very happy with regard to the way in which the government was possibly trying to bring regulation to pricing there. But with all of that in context in mind, let me lastly just pull up Nifty Energy if we can, Nifty Oil and Gas, Nifty Energy, to try and see what's how that one has closed and what constituents seem to be suggesting there, because 2+% of gains on the Nifty Energy today, mind you. Petronet, you had Oil India, Petronet, BPCL, Castrol, all of which were gaining 2.5% plus in trade. There you go, again a stack of green. But let's head across to an NDTV Profit exclusive conversation where my colleague Tamanna Inamdar is in conversation with Union Minister Ashwini Vaishnav.
Can India be the next semiconductor superpower? We've definitely laid the foundation for it. A big decision yesterday with a cabinet approval to 3 major semiconductor projects. Now, we're in conversation exclusively with Union Minister Ashwini Vaishnav. Of course, he handles railways, telecom, but today we're talking in the capacity of electronics and information technology. The minister with us now live. Mr. Vaishnav, thank you so much for speaking with us here at NDTV Profit. Always a pleasure to speak with you, and of course the buzz right now is semiconductors and how you have shown on a whiteboard how it will work. You know, those videos and that picture has also gone viral. But let me begin by understanding why this is such a big deal, because all through the pandemic and afterwards, the world first learned about how crucial and vital these very little objects are. What we have decided yesterday and what we've done yesterday, how will that lay the foundation to truly be Atmanirbhar on semiconductors?
See, semiconductor is basically a foundational industry. Everything that we use in our houses today, in our offices today, during our travel, everything has semiconductor in it. For example, within the home, starting with your refrigerator, the light, the fan, the air conditioner, TV, mobile phone, going out of the house, the train that you catch or the metro that you catch or the car in which you drive or the bike or scooty, if you travel outside, practically every equipment that we see today, anything that requires a switch on and switch off, every such thing requires a semiconductor in it. So practically this is like a raw material which is required in every sector of manufacturing, whether it is steel making or car making, whether it is manufacturing aeroplanes or manufacturing trains. So this is very, very important for our economy. That's why our Prime Minister Shri Narendra Modi ji has put huge focus on getting the semiconductor industry into India. The first policy proposal, which was published in early 2022, After that, we kept on working on developing the ecosystem, because it's a very complex industry. It requires thousands of different types of gases, chemicals, consumables to be able to run a fab properly. So we focused on getting the ecosystem, and then came the announcement of Micron, and within 100 days of approval, the construction of the factory started. That gave huge confidence to the world, and yesterday our Prime Minister approved 3 more proposals: 1 fab of Tata and Powerchip of Taiwan, and 2 ATMP units, 1 of Renesas and CG Power, second one is of Tata Electronics. So these 3 projects combined and the Micron project gives us the foundation for setting up the semiconductor industry in India. This will basically cater to our automobile industry, our electric vehicle industry, power electronics, consumer electronics like TV, refrigerator, all these items, to our defense and space sectors. Practically every industrial and domestic application, consumer applications will be benefited by these 4 plants.
So I just wanted to understand the cumulative investment for these plants is 1.26 lakh crores. How much of this will be given by the government as part of the PLI scheme? I'm trying to get a sense of how much we are incentivizing and subsidizing these projects, as of course we need to. World over, the US, etc., everyone is doing it. It's high cost. But what is the sort of a breakup and picture when it comes to this fresh lot of plants?
So we have a very robust assessment process of the project cost. There are items which are admissible as expenditure. There are other items which are not admissible as expenditure. So, and this is a team of professionals who benchmark everything as per the global best and as per the actual cost which gets incurred. Basis that our policy is 50% incentive is there, and that incentive gets repaid significantly as the industry progresses. It's a very interesting structure and by which this industry gets set up, and our investment which was approved as the program was 76,000 crore. This is the first part of this entire journey. This is going to be a 20-year journey. We have to lay the foundation. We have to make sure that the entire value chain comes to India. We have to make sure that our strong design capabilities, they are further strengthened. The fab comes and ATMP comes. So this entire value chain comes to India. So that's the way with which we are working. It's a very long program. It will take for the coming many years. We'll continue to get the benefit out of this and continue to grow this program.
What is the outlay you see, sir, in FY25 out of the 76,000 crore rupees, and do you expect it to increase? We will have a full budget after the election.
I won't be able to get into those minute details. Okay. Broadly, the 4 units will lay the entire foundation because they bring the entire capability. I also want to point out a couple of more things. First, Northeast is one part of the country where our Prime Minister has put huge focus. More than 50 times he has personally visited. We have highway connectivity, railway connectivity, air connectivity, optical fiber connectivity, and now such a high-tech project is being set up in Northeast. That itself is a very big thing. 27,000 crore investment coming in Assam, and that will again boost the economy of Northeast. Second point which I would like to emphasize here is, today the ATMP technology has got developed in India, which basically gives us a huge capability. It makes us totally at par with the best in the world. And with these 3 projects, the way we have structured these projects, the fab capability also will come to India. The fab between design, fab and ATMP. When we have all the 3 value chain components, and we have the ecosystem, and we have the talent, India becomes the most attractive destination for future semiconductor manufacturing by any company in the world. So this is the way our policy is structured, creating that entire ecosystem, all the three parts of the value chain, the ecosystem for all the materials which go in, and the talent pipeline. Combined, all this will lead to, and then once we have the semiconductor industry, the immediate corollary of that is getting the manufacturing industry. For example, laptop manufacturing. For example, mobile manufacturing gets a quantum jump. For example, your automobile industry doesn't have to depend upon imported chips in case of any disruption, right? For example, during the COVID period, we saw the disruption in car manufacturing. That doesn't happen. So many different things fall in place once this basic foundational building block of this large industry is available. That's the way we need to think.
Okay, absolutely, sir. So, this is fascinating because if you look at what the world is trying to do after COVID, everyone realized that they better get, their semiconductor dependability lowered from China, from Taiwan, do their own thing. To my mind, and please explain this because you have, you obviously have seen this very in depth and you are the expert on this. Fabbing is the toughest part. Which India is now also trying to do. We are making progress in the ATMP part, which is assembly, testing, marking, packaging, design. We've always been ahead. Fabbing is the tough one because you need super specialized engineers, you need specialized gases, technology, etc. Give us a sense of that. How much of our focus is going to be on that, and how important or challenging is it to become self-sufficient in fabbing?
That's actually a very, very important point that you have raised. Fab is definitely the most complex. Close to 16,000 items go in making a fab properly running, up and running. Practically, if you look at the periodic table of all elements, practically every element that exists on Earth is used in a fab. And it's very, very complex, very refined process. So, for example, this is a wafer which is manufactured in fab. This wafer, it looks like a small disc, correct? In effect, this is like designing a very complex city on a small disc like this. The fabrication which gets done on this wafer, if you take the tip of the nail 1 lakh times finer, 1 lakh times smaller, that is the dimension with which this circuit is designed on this wafer. You cannot see with your eyes. You have to have very specialized equipment, not even the microscopes that you find in a lab. It has to be very, very specialized equipment which basically prepare the circuit on this wafer. That is fabrication. And it's like building, for example, within this small little wafer, there are 5,000 chips. Now each of this will be very, very small, very minuscule, you cannot see it. Then that is taken out, extracted out, and ATMP is done. So ATMP will basically take this small thing out, and then using a very complex process, that small thing is then converted into a chip. So this small little thing that you see is the chip. And chip can then again be like a multi-story building, right? So let's say a 20-story building. There will be a common lift which goes, there will be plumbing which is there in the entire building, there will be electrical wiring entire building, there will be some floors which are 4 BHK floors, there will be some floors which are 2 BHK floors, there will be some floors which will have parking. So all that complexity is there in a chip. A chip of this size can actually have something like 100 kilometers of electrical wiring. 100 kilometers of electrical wiring. There is cooling system in it, there is heat management system in it. It's very, 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 very complex. That's why only a handful of countries are able to master this technology. So we in India, under our Prime Minister's leadership, are now in a position where the design capabilities are getting complemented by fab and ATMP capabilities. ATMP compared to fab is simpler, but still it's again very complex. As I was explaining, something which cannot be seen with eyes has to be created into a chip like this, a small item, right? So then that chip goes into the circuits. This is a circuit board. So this circuit board then goes into equipment. That is the way it works. So once you have design and fabrication and ATMP, then the natural corollary is that people who are designing modules or manufacturing modules, they will come to India. People who are manufacturing circuits, they will come to India. Then once circuits and modules are there, then people who manufacture laptops, they automatically come to India. So that's the way this entire cycle goes.
Yeah.
So it's very, very important to first get the foundational things right. And this attempt, very successful attempt of getting 4 units, all of them very, I just wanted to show you a small chip. Chip is like this.
I'm going to
Can you focus on this?
I'm going to ask my cameraman to zoom in on it. Yeah, I'm going to ask my cameraman to zoom in on it. So
Please zoom in on this.
Yeah, if they can show it. This is just fascinating, sir. The way we're describing this, we're getting, I mean, for viewers of NDTV Profit, you're getting a live demonstration from the minister himself on how all of it works. And just to imagine billions of dollars of investment to make that one tiny thing that you have in your hand.
It's very complex, very, very complex. It's really complex. That's why only a handful of countries, and we are very lucky that our Prime Minister has very clear vision and a big focus on it, because India attempted semiconductor fab way back in 1962, 1970s, 1980, 1984, 2007, 2011, but all these attempts could not succeed, and finally we have a successful attempt where we are able to get the entire thing in place, the entire value chain in place.
So just to understand further, and thank you so much for, explaining and putting an image to this complex technology. How much of fabrication, I'm assuming that's the full form of when we say fab or fabbing, I could be wrong. How much of fabbing are we going to do as part of our current plan? Is that going to be a smaller portion or a majority of it? I assume that's also what needs the most investment.
You are right, absolutely. We will be doing 50,000 wafers of this type in a month. We'll be fabricating 50,000 wafers of this size in 1 month. That is 300 crore chips in a year. It's quite significant, but I can say with good sense of confidence that because of the clarity of policy, because of the focus on getting the ecosystem in place, rather than pushing the project, making sure that the entire ecosystem gets in place, and the focus on getting huge pipeline of talent. We have tied up with 104 universities where training in semiconductor design and manufacturing and ATMP is being given. We have tied up with international institutes as well as our SCL Semiconductor Laboratory Mohali to train the work floor, the shop floor people, the clean room people. So all those things in place will lead to at least many more projects, at least 4 times or 5 times the investment that we have seen today in the coming 5 years, because the base is there. See, this is the way world is looking. 10 years ago, most of the industry participants were saying, should we go to India? That was 10 years ago. A few years ago, as the entire policies kept on showing results, people started saying, when should we go to India? Now that the ecosystem is there, people will say, how soon should we go to India? That's the mindset change which is happening.
So I just want to understand that, I mean, I was reading a figure that by 2025, India's demand for semiconductors is going to be about $100 billion. And as of today, we have to import this. Am I to understand that by 2029, most of this will be made in India, we'll start exporting as well? What are the timelines looking like?
Yes, a significant part of our requirement will be made in India. We will also become major exporters, just like we have become major exporters in mobile phones. 99% of our consumption is today made in India in case of mobile. And we have become big exporter, close to $13–14 billion of exports, right? Same story will play out on semiconductors also. We'll become a significant manufacturer, meeting our own demand as well as exporting. Out of these 4 units, the unit in Assam will be exporting to some of the best, most prestigious automobile companies in the entire world, in Europe, in America, in Japan. So that is the kind of the Renesas plant and the Tata Power Chip plant. They will be supplying to some of the most niche and high-tech products like high-speed trains, like defense products, like aeroplanes. So these will be supplying to some of the most important products. They will also be supplying to a large volume base like televisions, like refrigerators, like consumer electronics. Practically every gamut will be covered.
So just last point from you, and I know you're busy, you've given us this time, thank you so much, but I just wanted to get a sense. Now we have four plants now. There's Micron, I think 2 by Tatas and 1 CG Power. How many more are we going to have? How many more in the pipeline, or are we now going to wait and see what happens with these 4 projects first?
This is a 20-year journey. This is not a 1-year or 2-year program. Creating a new industry in a country, correct? So our Prime Minister has given us a clear target that we should prepare a roadmap for 20 years. So the way we have structured this entire thing is get all the technologies, develop the technologies, start the R&D process, then move on to designing complete chipset, manufacturing them in India and exporting them, then come to advanced research. It's a very properly laid out 20-year program on which we are working, and we have a very robust team of technical experts. Some of the best global experts are working with us. They are the ones who are evaluating everything. They are the ones who are giving us the right advice. They are the ones who are structuring the entire journey. And these are really very well-renowned names in the semiconductor industry. And luckily, and this is something very interesting, globally, you go to any large semiconductor company, Chief Technology Officer, Chief Production Officer, Chief Procurement Officer, so many times the Chief Executive Officer, they are all Indians. So close to 30% of the semiconductor talent is Indian basically. So we are getting a lot of good support, a lot of good guidance from best brains in the world. And that's why the program is so successful. Clarity of thought at the Prime Minister's level, clear focus at execution level, and extremely good advice coming from best experts in the world.
Just a last question, sir, slightly off topic, but because there has been so much buzz about the telecom sector right now, and one of the players, Vodafone, has recently finally gone in for a fundraise. I just wanted to get your outlook on the sector. Do you see now stability coming in? There is, of course, hope for an investor. Anything that you can comment at this point?
So I prefer never to comment on any company which is listed as a matter of policy because of the responsibility, the position of responsibility that I hold at this point of time. But what I can tell you is, after the reforms that were done in telecom sector by our Prime Minister and getting most of the legacy issues behind us now and getting a new Telecom Act in place, at least 8 large investment funds have met me so far, and they want to explore investments in telecom sector in India because the market size is very large, the technological acceptance is very high, Our digital India, our India stack basically is so widespread, and that is the gateway to, telecom is the gateway to digital India. So combined all these factors, the investor interest in India is huge. So we will see a lot of investments, we will see a lot of innovations, we'll see new business models coming up, we'll see new technical advances coming up in the coming years.
So I know you will not say it, sir, but can I assume that if there are 8 large investors, Vodafone might see interest from one of them?
I can only say that from our perspective, we'll do everything that is possible to attract more investments in telecom sector.
Fair enough. Thank you so much. Thank you so much for your time, taking all our questions and truly explaining in such beautiful detail what the semiconductor journey will look like for India. Just thank you. Fantastic. Ashwini Vaishnav there, Union Minister, talking about India's journey to becoming a semiconductor superpower, and of course a lot more.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change?
Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good?
Close at record highs as they outdo the broader markets to end higher for second day in a row. Most sectoral indices close in green. SEBI asked all asset management companies with small and mid-cap schemes to undertake a stress test of their portfolios at the earliest, and that's what sources told NDTV Profit. Adani Group is at its healthiest in at least 5 years. Debt to EBITDA falls to 2.5 times in first half of FY24 from 3.8 times in FY22. Adani Group will invest 75,000 crore rupees in Madhya Pradesh, says Pranav Adani, to create over 15,000 jobs in the state. Google to remove apps from Play Store on non-compliance of service charge norms. The tech giant said in its blog post 10 apps to be affected by this. February auto sales come in mixed, strong growth in cars and two-wheelers, but CV and tractor sales are weak. Hello and welcome. You're watching The Reporter on NDTV Profit and I'm your host Pragati Oberoi. As always, the show aims to bring you market headlines along with national and international news. But before we delve deep, let's take a quick look at how the D Street fared during the day. My colleague Agam Vakil joins in with all the market action for you.
Well, what a start it's been for the month of March, with the indices climbing higher, making new highs, specifically the Nifty, which advanced by around 1.6% and closed at a lifetime high. But today's day of gains came through on the back of a sector which wasn't expected to do as well. In fact, it was the steel sector which provided the majority of the gains coming through. So Tata Steel, as the top gainer on the Nifty 50, advanced by well over 6%, and that was followed by about a 4.5% advance for JSW Steel. Moreover, we also had a lot of support coming in from the capital goods major L&T. On the losing end, however, there was some amount of weakness in Dr. Reddy's, which did take away some sheen considering some certain updates with respect to US court ruling it as a defendant in one of the cases. But save for that, and save for a little bit of weakness in a handful of IT as well as pharma names, we have seen an all-around advance. In fact, with advances as much as 30 as compared to just about 20 declines in today's day of trade. Moving on, coming down to your broader markets too, we have seen a little bit of an underperformance. So today was clearly the day where we saw the benchmarks take the lead and march forward. Remember, we are moving into a relatively volatile week, especially given several events coming through, as well as we're also keeping an eye on the fund flows and the kind of traction that has seen on account of the various economic data and factors that will come through. But it's a strong start to the week. Don't forget, we are also going to have another trading session tomorrow. That's Saturday, in fact 2 to be precise, and that perhaps will also potentially see the market see higher, but that's a wait and watch on that one.
Well, that was the market wrap for you. Now, on to the big story of the day. Sources told NDTV Profit that SEBI has asked all asset management and AMFI to test their small and mid-cap schemes at the earliest possible time. My colleague Sajit Mangar joins us with more details on this. Sajit, since it is obviously the big story of the day and we've been tracking it in and out, what exactly are the parameters of this stress on SMIDs that you can bring us?
That's right. If you look at the kind of run-up that has happened happened in the small cap and the mid cap space, the impact is being felt in the mutual fund industry. Now, in the mutual fund industry, you have nearly 56 schemes which are in the mid cap and small cap space, accounting for nearly 5.4 lakh crores in average asset under management, and that is bringing in some kind of concern in terms of the potential risk that is associated with the rising asset value as well as the fund flows which are going into these schemes. In the last 1 year, we have seen nearly 65,000 odd crores of net inflows going into small and mid cap schemes. What now we understand is the SEBI is trying to ensure that there is a stress test done for every scheme by every mutual fund, and AMFI would ensure that there are set parameters set out with respect to what kind of potential risk which are there associated with each of the schemes. AMFI will also ensure that all these disclosures or the results of the stress test will be put on the website of the mutual funds along with the scheme details and on the website of AMFI. Further, AMFI is also looking at tightening some bit of exodus or redemption that may happen as a result of volatility, where it wants long-term investors to be protected, and so it wants the mutual fund industry to put in some kind of exit loads which could be dynamic in terms of the short duration investors who want to come in for say 6 months or a year, so that they pay a higher exit load when they exit or redeem from the schemes, and thereby protecting the interest of the fresh investors and long-term investors who have come into the small and mid-cap schemes. Pragati.
All right, thanks so much for bringing us those details. Indeed, a very important big story, and we'll come back to you as soon as you have more on that. Now, let's take a step back to once again how the markets fared, because hospital stocks also came under pressure after Supreme Court expressed its reservations against the government's failure to implement the central government health scheme rates. Now, we spoke to Viren Shetty, who is the executive VC at Narayan Health, and he said that fixing the cost for hospital procedures might take India back to the license rush of the 1960s.
See, the truth also is that what is the nature of the thing that they want? Does the government really want a uniform price for every single procedure across every single hospital, no matter the quality, no matter the infrastructure? In which case, yes, there will be a tremendous impact. This will be impact on the scale of what this country went through in the 50s, 60s, and 70s, where the price of everything was fixed. So what happened is the supply naturally came down. There has been an explosion in private healthcare because there's an unmet market need, and there is, in our country, an ability for people to get healthcare at the price that they can afford for most people, not for everyone. So if you disincentivize investing in quality, investing in high-end infrastructure, then you won't see any more of that anymore. So it will be a massive impact if you fix a common price for everything, no matter what.
Well, that was a small take on how the hospital stocks reacted. Let's take a look at another big story of the day, and that was Google. Now, Google has come down heavily on some mobile applications in India. According to Google's latest blog post, the tech giant would remove 10 companies that have remained non-compliant with its service charge norms by seeking legal protections. And these developers have, however, complied with the payment policies of other app stores. In the same blog post, now Google said that it is offering 3 payment options for apps seeking to comply with the payment policies of the tech giant. It even said that the non-compliance with policies can lead to the removal of apps from its Play Store. Now, however, companies do have an option of resubmitting their apps by choosing any one of the available options or the ones listed by Google in its blog. Now, NDTV Profit also spoke to various affected companies and got to know that the notices were sent by Google only this morning, and these notices were sent to companies like InfoEdge, Truly, Madly, Matrimony.com, among others. InfoEdge founder also, like Sanjeev Bikhchandani, said that there were no invoices pending of Google and they were replying to the notice at the earliest. However, Matrimony.com may be suffering a little more than others, because CEO Janki Raman told NDTV Profit that its app Jodi has been removed by Google within a couple of hours of the company sending the notice. He said that Google's move shows how it is moving moving towards a monopoly and how it does not care about Indian laws. Well, we'll be bringing you more updates on Google's move and how it will play out for the fintech players in the country. Let's take a look at the auto sales numbers. Now, the February auto sales numbers have just been announced on the exchanges by various companies throughout the day. The commercial vehicle sales have seen a sharp decline before the elections, while two-wheeler sales have grown in double numbers. My colleague Vinay Kulve joins us with more details. Vinay, what can you tell us about these numbers? Because we're getting a sense that there's some sort of a slowdown in tractor numbers.
Yeah, you're right, Pragati. But as we expected that there could be a highlight in the two-wheeler segment, because we expected that it will grow in double digits, and it has happened. But rather, it has happened stronger than that. So the double-digit growth is driven by motorcycle sales, which is largely in the mass segments. So if you will see the difference between the growth of motorcycle sales and scooter sales, you will see that the motorcycle sales growth is higher, and that represents the rural market more. So we can say that the rural market is driving and the mass segments are driving this uptick in the two-wheeler sales. If we come to the car dispatches rise, that has been higher in the wholesale terms. But if we look at the retail levels, the sales have not been as high as we see in the dispatches. So that has led to the higher inventory at the dealership levels. And as you said, the tractor and the commercial vehicle sales have remained weak in Feb as well. There are different reasons for both the segments. So for commercial vehicles, the reason is the slowdown in orders coming in before the elections. As you know, that the tenders also slow down before elections come in. So that has affected the resales of commercial vehicles. In the tractor sales, we have seen a cyclical downturn in the demand, and the erratic monsoon has also impacted the output in terms of agriculture. So that has impacted the sales of tractors as well. So we are expecting an uptick in April because Navratri season will begin from there. Until then, the sales will remain weak.
All right, Vinay, thanks so much for bringing us those details. Now, a little more than a year ago, US-based short seller Hindenburg raised several questions on the Adani Group's credit profile. But what exactly does the picture look like now? My colleague Tushar Singh has crunched some quick numbers for us, so let's take a quick look at them.
The Hindenburg saga seems to be firmly in the past, as it has emerged that the Adani Group is at its healthiest in at least 5 years. At least that's what investors' presentation shows. Gross debt of the Gautam Adani-led conglomerate has grown by 20% over the past 18 months to 2.26 lakh crore rupees. Over the same time period, the cash balance expanded by over 60%. The net debt to EBITDA ratio has improved to 2.5x as on September 30, 2023, from 3.8x in FY22. The 18-month period is crucial, as it was in January 2023 that the US-based short seller Hindenburg put out a report raising questions on the credit profile of the Adani Group. There's positive news on the operational profitability front as well. Adani Group's EBITDA has clocked a CAGR of 27% over FY19 to 23 and is seen at 7 times FY19 levels by FY27. That's almost a doubling year on year.
Well, those were some very important numbers for you on the company's health. Now, let's slip into a short break, but please stay tuned because we have lots more lined up for you.
Electoral bonds have been deemed unconstitutional by the 5-judge Supreme Court bench headed by Chief Justice D.Y. Chandrachud. They were first introduced in 2018. An electoral bond is a means to fund a political party in India while maintaining anonymity. These bonds are available in multiple denominations ranging from 1,000 rupees to 1 crore in specified branches of the State Bank of India. This was introduced in the system to maintain transparency in political funding via a banking network and reduce black money. But on the flip side of this intention, questions have been raised on the basis of an important fundamental right of democracy. That's right to information. Is it constitutionally right to keep the source of political funding discreet? Why shouldn't the public know who is funding how much money to different political parties? As per the findings of Political Party Watch, a program under Association for Democratic Reforms, 28,030 electoral bonds worth rupees 16,618 crore was sold between March 2018 and January 2024. The Supreme Court's unanimous decision follows a petition filed in September 2017 challenging the Finance Act 2017, which introduced the electoral bond scheme for the purpose of electoral funding. The Act has also removed the previous limit of 7.5% of the company's average 3-year net profit for political donations. The Supreme Court has asked the following corrective actions to be taken immediately. State Bank of India will need to stop issuing electoral bonds immediately. SBI will have to submit the details of the purchase of electoral bonds and their encashment by political parties since the interim order of the court, which is April 12, 2019, to the Election Commission in 3 weeks by March 6th. The Election Commission will have to publish all these details on its website 1 week after, that is on March 13th, after it has received all the information. Electoral bonds that have not been encashed yet by the political parties will need to be refunded. For more such updates, stay tuned to NDTV Profit.
Welcome back. You're watching The Reporter. Let's take a look at another big story from the Adani Group. Now, the Adani Group has pledged 75,000 crore rupees investment in Madhya Pradesh, promising over 15,000 or almost 15,000 employment opportunities in various forms. Let's take a quick look at what this is about.
I'm delighted to announce that not only will the Adani Group continue investing in these diverse sectors, but we will also more than double our investments in the Madhya Pradesh and contribute in our own humble way to the state's all-round development. Honorable Chief Minister, our faith in your visionary leadership will see us investing close to 75,000 crores in Madhya Pradesh. Our total planned investments of nearly 75,000 crores will generate over 15,000 direct and indirect employment opportunities in a wide variety of industrial sectors across Madhya Pradesh.
Well, now to a relatively somber news from this afternoon. An explosion took place at a cafe in Whitefield in Bengaluru. At least 4 people are believed that they were reportedly injured, and while the forensics team reached at the site on time, there was still some sort of impact from the blast that was felt. The police said that they are trying to find out what caused the explosion at the cafe, and more details are still awaited. We also have another update from the football world that has rocked it recently. Now, the former Manchester United or the Man U star and French World Cup winner Paul Pogba has been handed a 4-year ban on the back of doping charges. And this verdict comes on the back of the earlier doping charges against the football star. Well, that's what we have for you on The Reporter, but please stay tuned because we have lots more lined up for you throughout the day.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stemmed from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the company.
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
Join us as we put the spotlight on 6 stocks.
on your show, Hot Money.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
Or a long-term investment.
all you have to do
Is ask profit.
You're watching NDTV Profit. Now, Google said that it will remove mobile applications from its Google Play Store if they are non-compliant with the tech major's service charge norms. Google also said in its blog post from this morning that also caused a lot of havoc throughout the day that there are 10 companies that have remained non-compliant, and NDTV Profit has learned that InfoEdge, Matrimony.com and Truly Madly are some of the companies that got these notices from Google. Now, for a quick chat and to understand exactly what is up, we are now joined by Snehal Khanor, who's the CEO of Truly Madly. Now, Snehal, thanks so much for joining NDTV Profit for this conversation. I want to kickstart this conversation first by understanding, you already told us that the notice has been sent to your company. So, what is the course of action from here? And has the team or your team thought about replying to Google?
Yeah, so they very cleverly sent this notice on a Friday, second half, right? So we are sitting ducks till Monday. We are trying to reconcile with our legal teams what should be the next step. And they said in their blog post that only 10 companies are left, everybody else has complied. I will like to highlight that that's a very big misinformation being spread. only 10 of us still have it in our stomach to keep fighting. Everybody else has succumbed to the monopolistic practices. So that's the real part.
But what exactly is mentioned in the notice? Is it asking you or telling you that the app would be removed from the Play Store, or is it talking about any unpaid dues on behalf of the companies? What exactly is there in this?
There are no unpaid dues. All the invoices have been settled in timely manners. They have been asking us to remove non-Google payment gateways like Paytm, Razorpay, PayU, etc., or UPI that we use. They are asking us to remove them and only use Google's billing system and give them around 15 to 30% of the commission to them, for which we do not get any service, and it's just purely extortion.
Oh, is it so? Because, so you're trying to say that the notice exactly mentions that you remove all those third-party applications or players that you might be having?
Yeah,
Okay.
so that is the policy. Then we have been fighting this fight for almost 2-3 years now.
Right.
CCI, in fact, gave them a very clear direct order that Google may not restrict app developers from using third-party billing services and may not take any adverse measure against them for using those third-party billings. And still they valiantly defied the CCI order while the hearing is still on. So that's the regard they have for the Indian law. And today we all got the notices, and within 1 hour our apps were delisted from the Play Store.
Oh, so even your app has been pulled down for Play Store? Because last when we spoke during the day, before this chat, till then that app was there, I believe.
Yeah, I think within few minutes, everybody's apps got started delisting, and ours also got delisted within few minutes of our last conversation.
Oh, okay. So since now the app is also down, what is the course of action from here? Is replying to Google's notice via the legal team the only or the right way to go, or will you go to some alternative app stores from here? Because this is clearly a latest update coming in if your app has been removed.
See, India is 96% Android. So that's the biggest monopoly in the digital space in India. Even in US, it is not, so much skewed that 96% is dependent on Google Android. And that is why CCI intervened, and that is why they passed that order. As per our next course of action, we are still, we still have some fight left in us. We are not going to succumb so easily. And we do know that Google has also been trying to reach some app developers, giving them side deals, etc. But I believe that this is a fight for the larger cause, for the digital India dream that we all have collectively taken and have had this dream for many years now. And now India is the third largest startup economy of the world, right? But we don't, we are being dictated by some, digital landlords who are trying to put these unnecessary demands on us. And, even think how very less businesses in India will even have 30% PAT, profit after taxes. How can one give 30% of the top line to Google, for which they are not providing any services? We are running it without them. We do not require their services. They are just using their monopoly in Android OS and Play Store to force us to create a monopoly in the digital payment space also, which I believe can be very detrimental for the whole digital startup ecosystem of the country.
I have two follow-ups to the answer that you just gave. One, when you say we, that we will still fight and we are fighting, how do you define we? Does it mean truly madly that is your company, or the entire cohort or the group of 10 companies that were fighting against it? That's my first question. My second is because in the blog post, Google has clearly said that you can resubmit your apps to Play Store as well, provided you choose either of the 3 payment options. So is that one option that you would want to consider going ahead? Those 2 questions for now.
So when I say we are collectively, a lot of us, we are trying to, because it is a fight which nobody can take on, alone. In fact, so many people who are affected or know that how bad is this are always afraid of speaking up against Google, right? Because in many ways, a lot of parts of our startups are somewhat, in some ways or the other, dependent on Google, be it ads, be it server, be it Play Store, be it anything else, right? Second part of your question, we are still contemplating, but we are not at all inclined as of today towards succumbing to those demands. We are thinking what are the alternate ways that we can get the business back up. Right now, we were very much dependent on the Play Store because, and see, we are the ones who send the traffic to the Play Store. We are the ones who upload the apps. We are the ones who pay around 30-40% of our revenue to Google ads or Facebook ads, etc. Then the traffic comes on our app. Then the user on the app listing page on the Play Store. Then the user installs the app and then they use the app, right? So it is not that Google was providing us with any distribution. It was just a listing page. And we have been on the store since 2013 or 2014. And this new policy they created out of blue in 2020, and then we have been fighting it since then. And now they are very adamant on implementing this.
Okay. So naturally, since you said that you were dependent on Google Play Store at the end of the day, there will be some impact on the business because since your app has now come down, even though your existing customers can use the app, you can't onboard new customers for now from Play Store. And naturally, the app updates would also not go. So is that the only long-term or short-term impact that you're seeing on the business, or in terms of numbers or financial metrics also there will be some impact?
A very big impact will be there on the financial numbers because we will not be able to acquire new users on our Android app in the country where 96% of users are Android. And see, the alternative Play Stores, are just there for name. For example, even Amazon used to have a Android store, till few years back. Even they had to shut it down because Google Play Store is so intertwined with the monopoly of their OS that it is impossible for any other alternate app store to even survive. Even a big company like Amazon could not do it. Imagine.
Okay. Also, another thing actually I want to understand from you, and please correct me if I'm wrong, because there's some sort of a disconnect here that I'm not able to understand. So if you can help me elaborate on this. Because in its blog post, Google said that, or the 10 companies that Google was talking about, it said that you all or the companies were complying with other app stores except Play Store. So what exactly is the disconnect here? That why just Play Store?
There is no such disconnect. There is no such thing. And I don't know. I don't understand because see, we are only on Apple and Google Play Store, right? And Apple also has this issue, but they have had this since the beginning when we signed up with them, right? Google, on the other hand, we have been on their platform for almost a decade. One fine day, they decided they want to change the policy, and today we are facing the heat of it.
Okay, so alternate app stores are still an option, or an easier option?
Because on Android there are no feasible alternate app store which will have even the so even if we are listed on alternate app stores, when we are running a Google ad or a Facebook ad, it only shows us Google Play Store for Android, right? Other app stores are not even listed there. So we cannot effectively run our ad campaigns. We cannot bring people on those app stores who can then download our app. And if we try, so another thing which we could have done was that we can directly send users on our website and ask them to download the APK directly. But because that is also controlled by Google Chrome, they show a warning saying that, the APK files can be harmful for your system, right? All of us have grown up downloading exe files when we used to use Windows laptop and download the exe file and then run it and install the software. Similarly, APK is the format for Android, but they have been running this propaganda to discourage users and telling them that APK files are harmful, right? So from all around, they have really that's the monopoly that they have, be it in search, be it in internet browsing, be it in apps.
So format could also be an issue indeed. I have one last question for you, Snehal. When we were previously talking, and even a part of this conversation, you were referring repeatedly to a particular CCI order that, despite CCI order, Google is doing this. But in its blog post, Google has specifically said that it gave all the time even after the Supreme Court's order. So it's becoming somewhat a situation of CCI order versus the Supreme Court order, the way I'm seeing it. So what exactly is going wrong here? Where did the non-compliance come from? Is it about the CCI order, Supreme Court order, or there's something else at play?
Sure. So I'll tell you the timeline. So earlier there was only Google Play billing system, right? And then the CCI picked it up. The investigation was done. They slapped a heavy fine on Google, not so heavy from Google's perspective, but still some 1,000 crores. Slap on the wrist for Google, company like Google. And they've clearly gave the order that you cannot, force them to use your payment gateway, or ask them to, or restrict them to use third-party billings, or take any adverse measures like delisting them if they are using third-party billing. Then what they did, Google, they came up with two new things: user choice billing and consumption model. User choice billing was nothing but kind of a loophole they created to circumvent the CCI order, but still they are restricting us for using the other gateways. Still they are taking adverse actions against us for using third-party gateways. They say that in UCB, you can connect to third-party gateways, but via us, but still give us that commission 15 to 30%, right? And the consumption model is that you can just have the app on Play Store, but you cannot make anybody purchase anything. You can tell them that go purchase from the website, because and that is as good as no purchases, right? Because who will go, and we cannot even have a link, direct link, even but these are the problem is, right? So we do not have an issue. You charge whatever you want to charge, but let free market forces prevail. Let us choose what we want to use. And that is the only way that the innovation can also happen. If you remember 8-10 years ago, payment gateways were not this good as they are today. Settlement used to happen at T+2, T+3 days. Competition happened. Free market forces were there. Innovation happened. And that's why today T+1, you get your money in the bank. By the way, Google will send us the money at T+45 days. So it will just so badly impact our working capital also, right? Because all the revenue that we have earned will keep getting logged at Google for 45 days. Once in 45 days, they will transfer the money to us. How will we run our businesses?
Got it. Fair enough. That was Snehal. Snehal, thanks so much for joining us for this quick conversation. It was great talking to you. At least we got to know your side of the story on this. Well, it's also time to slip into a short break, but stay tuned to NDTV Profit as we bring you some more headlines of the day.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the spurge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than rupees.
Welcome back. You're watching NDTV Profit. Now on to another big story of the hour. India's gross GST collection for the month of February has stood at 1.68 lakh crore rupees for the quarter. Now let's quickly go across to our colleague Janani for more details on this.
Thanks, Pragati. That's right. Just a few minutes ago,